guys. Cheers.
Yeah, awesome.
Okay. So
great. How is everyone doing?
Yeah. Oh my gosh. All right, we're up to 50 of you. All right, we're at half capacity, which is awesome. We'll hopefully get up to 100 with everyone that got signed up. So I'm Nate. This is Cal.
Nice to meet you guys. It's been a
journey.
A journey, to tell you the least.
We were up until 1 last night, probably just getting everything set up. We had to do all of the sound, all of the different cameras. You guys can't really see the 4 different cameras going on over here, but the entire point of this, the reason we spent so much time planning for this is because we wanted to teach you guys something new about finance without being lecturers, without being educators. I don't know about you, but I guess I did better in college, but especially in high school, I didn't grasp a lot of what everyone was saying, regardless of the fact that it was really important.
Yeah, definitely.
And so the goal of today is to give all of that information to you guys over the course of 6 hours today.
6? Yeah, something like that.
And hopefully you're going to pull away at least one thing that you learn that is completely new, and you can go apply that to your own investing and your own personal finance. That's the whole reason we're here.
Yeah. And we're also here to answer questions too.
Speaking of questions, I had one guy reach out to me, say he was joining us from Norway. Would you guys be willing to drop in the chat where you're coming from,
dude,
and where you're tuning in?
They're already dropping in. We got
UK.
We got Chile.
What?
Oh my gosh.
Okay, this is from Lebanon,
Oklahoma. Heyo, Las Vegas.
Miami. I love it.
Wow.
We're in Vegas right now.
Yes, sir.
Denmark. Awesome. So we are Hoskin Capital. We're a registered investment advisor. The job that we do is we manage people's money for them, and we also do financial planning, things like that on the side. I'm a certified financial planner. I'm the youngest guy to ever get that. We'll see.
That's what I've heard.
The only other guy that I've found who has a CFP is 24, and I'm 22. So
I think you win.
I think I win.
Yeah.
And then we have Tim. Tim is actually taking a call from Germany right now. He's our CFA. He's our Chief Technology Officer. He manages all of the technical stuff. And then we have Cal, who without him, none of this could have happened, because I don't know how a microphone works. But I'll make my value in the investment management side. And that's what we've been doing. So what we do,
it's a good team. It works.
It really does.
It definitely works.
And so what we do on the investment side is we manage people's money in a completely sustainable way. Our portfolios are the highest level of sustainable investing you can currently achieve. If someone has an ETF that's better, I really want to know about it, because I've done so much research, and that's actually why I started this company, was to offer that sort of sustainable investing. So I think that was everything. I want to talk about markets real quick.
Yeah, let's go for it.
I need my iPad real quick.
Yeah. Yeah. Only thing
it's a little rough.
Yeah.
What's up?
Only thing is, I think we should try to
talk more into the mic.
More into the mic.
It's so intimate, though. The sound quality is so good. I don't know if I'm ready for that. That's why I'm not wearing my headphones, is because I don't want to hear myself.
Well, I can just hear it on a whole other level, Yeah, vocal fry. Forgot about that.
So the Dow Jones is down 0.89%, I have, and the S&P is down 0.72. I would attribute a hilarious amount of that underperformance to the fact that that boat is stuck in the Suez Canal.
What is up with that?
So massive container ship stuck completely perpendicular in the Suez Canal. And for those of you who don't know, the Suez Canal is one of the largest ocean gateways into Europe and also into the Asian Pacific area. And so that's a big deal.
Yeah.
51 ships travel through that canal.
Someone definitely got fired.
Someone definitely got fired. And then I was just reading this morning at like 5 that they're expecting it to take weeks for it to come out.
That's ridiculous.
They have professional dredgers, professional salvagers trying to get this thing unstuck. And it just keeps digging itself deeper, because you can picture that the current of the canal is slowly wedging it further.
Yeah, no, definitely.
So we have a little bit of that. Tech is
400 million an hour, according to Dom. Oh my gosh.
God. Yeah, that's insane. And especially because we have so much oil passing through there. oil propagates that cost into pretty much everything else, into transportation, you name it. And so I think we might see a little bit of a rough patch. For the next week. The tech is selling off pretty intensely with the NASDAQ down 1.25%. Does anyone have the 10-year numbers? I don't, but I can go find it. Let's see. Top news.
This Zoom is sponsored by Koifin.
Dude, my entire life is sponsored by Koifin. For any of you guys who follow me on TikTok, I just swear by this stuff.
Yeah.
I think it's probably the most.
We're getting some 1.6s, 10-year 1.596.
Oh, that's actually not bad. Okay, so up a little bit, but not terrible. Okay, beautiful.
Yeah.
So overall, not an insane day. We're continuing to see the same trend that we've been seeing for the last few weeks, which is 10-year rising in spurts and technology moving pretty much in lockstep opposite.
Right.
Because those growth companies especially are so closely tied to their expected return. That expected return has the risk-free rate baked into it. And so when that grows, the attractiveness of those investments fall off a little bit. Don't worry, we're going to talk about all of this over the course of the day.
It makes sense. Trust us. Trust him. Trust us.
I don't know. Don't trust me on blind faith. So I think that's actually a great opportunity for us to just jump into the first part. But before we do this, will you guys tell me a little bit about your experience level of investing? We obviously have the survey, so I know that most of you have less than 1 year of investment experience. So would you be willing to tell me what is your level on a scale of 1 to 5 in terms of how much investing experience you have? Because what I'm going to do for this next hour and a half is I'm going to start completely basic. We're going to have poker chips, right? We got to do the ASMR. And we're going to actually walk through the transactions that occur on financial markets and within capital markets. Because I think a lot of people know what a stock is, and they sort of understand why they would invest in a stock, but they might not understand how that transaction actually functions. So that's what we're going to start with. Is this something you guys are interested in? Or are you like, all right, old news? Because if so, we can pivot. Let's see, we got 0.
It's looking like, so if 1 is no experience and 5 being the most experience.
We have a CFA level 1 in the chat. I love it. Okay, 1, beautiful. Then yeah, let's just kick it.
Let's start from the beginning. Yeah.
So that means you get to sort of be my target dummy on this.
I'm down.
So capital markets are the mercantile exchange on which we move money from savers' pockets into the pockets of people who are going to use it for productive use. That is the entire economic function of capital markets. And so what this means is that, let's say I'm a saver and I'm saving for retirement. And so I have an IRA. This is my IRA. I've built up a little pile of assets and I'm considering investing. So we'll talk about stocks first. Stocks actually have 2 different markets, the primary market and the secondary market. So in the primary market, let's say Cal is a company. So let's say Cal is GameStop. I'm sorry.
I'm not offended.
So GameStop, at the very beginning, when it IPO'd, which must have been 30 plus years ago or something.
Something
insane.
Crazy like that, yeah.
And so at the beginning, they issued shares in return for capital. And so the way that works is that I would give GameStop a certain amount of my IRA, and they would give me a stock, right? So this stock then tells me that I have a certain amount of ownership in GameStop. So then GameStop goes off and they do their business. Back in the 90s, they were selling games. Nowadays, I think they're working on transitioning to the electronic space.
Yeah, I think they're trying to go online. There's been a lot of management changes in the past year.
Yeah, and they just had the guy come in from, oh my gosh, I'm completely spacing it. Whatever, no, unimportant. I was trying to remember what company he came in from. So let's say you go make money selling games, right? Chewy. It was okay. It was a pet thing. I thought I was going to sound like an idiot for saying, oh yeah, it's a pet thing. So you go and you actually make more money, right?
Right.
So this is your profit.
Mm-hmm.
So what you could do now is you could give this back to me as a dividend, right? Or you could keep it and reinvest it into your stack to go hopefully make more money.
And
right?
basically making the company look better too.
Right. Yeah. So then you have more cash on hand, you can take on more debt, you can use that to lever up and grow the company. But for me, I might want a dividend. So there's kind of this trade-off that I think we're already sort of getting at, where if you keep this money, you're going to use it to grow the company faster. Right. So that means that my little stake is going to be worth more. And that's a good thing.
Definitely.
But if I need cash right now, I'm going to be really pissed if you hold on to that dividend because I'm trying to have income. So this actually creates two totally different types of stocks. We have growth stocks, and then we have dividend stocks. And so growth stocks will hold on to the dividend. As you guys know, companies like Amazon and a lot of smaller tech companies don't pay dividends at all. And the reason is because they retain every piece of their earnings so that they can make more money. But then you have the bigger ones, the Exxon Mobils, the Walmarts, things like that, that pay out a massive amount of their earnings to their investors in the form of a dividend. So what's the trade-off? What do you think? Like why would they choose to do either?
Well, it sounds like it's basically a matter of making the most money, right? So it's whether or not they want more people to invest or whether or not they want the people who are invested to be happier, and it sounds like there is a fine line in choosing which path you more or less want to go about. But it's funny because, the more prominent your company is, obviously the more like investors you're able to garner in basically issuing stock and, offering these dividends, especially if you're let's say AT&T, they have a pretty big,
they have a nice dividend.
Yeah.
I think they're like 1.5, something like that.
So, I would say it really comes down to what you can offer as the company and what really your investors are looking for. So
that's exactly what I was looking for, because at the end of the day, when I own stock in a company, when any of you own stock in a company, you are on the best side of that management team. Because that management team's job, the guy from Chewy at GameStop, he just got hired to make us, the whatever shareholders, happy, right? Yeah. And so if your shareholders are more happy with a current dividend, then they're incentivized to just pay it out, right? And if they're happier with you holding onto it and growing it, they're going to do that. It comes down to investor demand and investor expectations.
If only there was a way for the investors to actually have a say in this.
Totally. And we're going to talk about more of that with impact investing. I don't know if any of you guys have heard about Exxon Mobil and their shareholders doing proxy votes against certain decisions, but Exxon Mobil has hit a wall in terms of sustainability and emissions because their shareholders are like, nope, we're not going to tolerate it. We need you to become better. So
the people are speaking. They have spoken and they are speaking and they want change.
Yeah, absolutely.
It's hilarious. And that really we're going to be talking about a lot about impact investing throughout this entire webinar, but just to kind of start the conversation a little bit, it seems like ESI, like ESG, I guess.
Which ESI is our own ranking. That's the one that we do here at Hoskin Capital.
Yeah, we like to use the ESI instead of ESG.
Well, the I is innovation. Exactly. I don't know if any of you guys know Kathy Wood, but she's definitely on that train, and I am as well.
Yeah, it's I would say it's the future, and it's going to make a big impact, and it's going to last.
Hold on, before we get into that, I want to finish this point that I had on paying out dividends, because now a question is, how do you measure this? So you can look at a company's payout ratio. First, you can just look and see if they pay a dividend, because if they pay 0 dividends, that's going to be pretty obvious. But if you see a dividend number, let's say they pay out $1.50 per share, then you might want to know how much money they're holding on to and how much money they're giving out to you, because they could take this money and they could give you a third of it. And so their payout ratio would be 33%. This is something that you can find very easily. I'm going to show you Koifin because I swear by it. I'm not sponsored in the least. It's just what I use every single day. But I will show you guys the payout ratio of a company, and you can use that as a way of figuring out whether or not the company is investing for growth or investing for investor income, essentially, and making sure that I'm happy with the money that I'm receiving today. So we've talked a little bit about that transaction. Before we move away from capital markets, I want to talk about bonds, because that's the other most commonly traded security.
It's one of my favorite parts too.
I love bonds, dude. So I was actually the portfolio manager for fixed income when I was in college, when we were managing $3 million of the Chapman Endowment.
What was it, 300 AUM?
No, it was 60,000 AUM when I came in. Okay. And then we raised it to 3 million.
You
AUM.
Animal.
It was insane, dude. It was so much fun. I don't know many people who are able to say they managed $3 million at the age of 19.
In college.
Yeah, in college. But that was incredible. So I learned a lot about bonds very, very quickly because I was under quite a bit of pressure to perform well with them. But a bond, unlike a stock, is a loan. So if you are still the company, then I'm loaning you my money. And so I can loan you my stack, and you can take this to go make money, and you're going to Tim just walked in. What's up? Huh?
Stream is down.
The stream is down.
Instagram.
Oh. We hit a time limit.
We can fix Instagram. Oh, TikTok.
It's the TikTok stream.
Let me fix it.
Interesting.
Ignore limit. Definitely ignore limit for today. See, this is what
Tim just bolts upstairs.
Like,
the stream is down. We're like, what? I think we're good.
Beautiful.
Yeah,
we got highs.
Okay. How many people do we have on TikTok?
TikTok, we have 24, and then we have 11 on Instagram.
Cool.
Love it. Brings our total to
something
over 100.
Oh wow, we're at 84 attendees. Cool. So
we're distracted this morning. It's the coffee.
It's the coffee. So what were you saying about bonds?
I was talking about bonds because, unlike stock, if I give you money and buy a stock,
right,
I kind of don't expect to get this money back, right?
Yeah.
Whereas if I have a bond, I actually am guaranteed that I'm going to get my money back unless you go completely bankrupt.
You would more or less say it's kind of like a debt.
It is. It's absolutely debt.
Okay.
And so if I give you a stack of cash and you give me a bond, right? Then you're going to take that and you're going to go make more money, and you're going to pay me interest, right?
Yeah.
So you're going to pay me interest every 6 months, semi-annually, for let's say 5 years. There will be a term on the bond. So I'm just going to collect a little bit of income every 6 months. And then at the end of the term, you're going to give me my full money back.
Yes.
Right?
But that's a poor example. It would be more like, so if this is the money that you give me, right? And then I go and make, let's pull out a little bit. I go and make this much. I'm going to be paying back about, I would say that's a pretty good representation, every 6 months. And then when it comes to the end of term, I will pay you back the rest that you gave me. And then basically you've gotten your money back plus a little bit of interest.
Plus
so And
so if you're a good business manager, then your goal is to make more money on my money than you have to pay me.
Yeah.
So let's say, I mean, right now bonds are hilariously low. Let's say like 4%. Okay. So you might pay me 4%, but your goal is to make 10% on that money.
Okay.
Right?
Yeah.
Because that way you make 6% growth.
Right.
Even though you technically have to pay me every 6 months. And so when you combine a company's stock and bonds, you get what is called their capital structure.
Right.
So their capital structure is the makeup of the financing of a company. And there's a lot of cool stuff that we can dig into on that. What makes a good capital structure? And we'll talk about that when we get into ratio analysis, because I think that stuff is really cool. Figuring out whether a company is over leveraged, they're taking out too much debt, or too little, because leverage is sort of a double-edged sword. It helps
It's a
lot with
balance.
growth. Yeah. So let's see. Now we've talked a little bit about stocks. What questions do people have?
Let's see. What do you think about REITs?
Ooh, REITs. Okay. So REITs are another option. They're technically traded like a stock. A REIT is a company that invests in real estate. So REIT stands for Real Estate Investment Trust. And they issue securities just like any company does. So you can trade it like a stock. I'm not surprised at all. That's fine. And so you can buy it like a stock, but what you're buying when you invest in a REIT is you are buying their portfolio of real estate properties, right? And so the reason you would invest in a REIT is because you want exposure to either rental income or you want exposure to the actual value of the properties, right?
Right.
And having them appreciate. So when it comes to REITs, I think REITs make a lot of sense as an addition to your portfolio because real estate is historically uncorrelated with stocks, with equities.
Yeah.
REITs tend to be a little bit more correlated because they're traded on public markets. So they have the same supply and demand factor sensitivity. But that said, I hold quite a few REITs. I really like them.
Really?
Hoskin Capital's clients hold a few REITs as well because we use it as an inflation hedge.
Yeah.
As you know, a lot of the traditional hedges like gold and silver actually haven't been performing that well despite the risks of inflation on the horizon. And so we've been moving into other ideas, REITs being a very specific and very good offering because we get a lot of the outperformance of stocks because, as I mentioned, they're quite correlated.
Right.
But on the downside, there tends to be a lack of correlation. Right. And they move quite nicely with inflation because home values will rise
and
across
stocks are actually a pretty good inflation against.
Yeah, they're not bad.
So hedge against inflation.
Right.
Yeah.
Equity is way better than cash, way better than bonds because bonds, as we mentioned, pay out a specific interest rate. And so if you're paying me 4% and inflation is 3%, I didn't actually make any money. I made like barely 1%.
Right, because the value of that money is going down.
Money went down.
Yeah.
And so equities, despite not performing that well in an inflationary environment, will still generally climb along with inflation.
Right.
So let's see, what have we talked about so far? Talked about stocks. We talked about the payout ratio, which is something that I think is really important.
We had a pretty good question from Stanley. Why would companies issue out bonds rather than getting loans from banks?
Okay. So to some extent, they just might not be able to get the loan. I mean, bond issues will be in the hundreds of millions. And so having a line of credit at a bank like that would be very challenging to maintain.
Right.
And a lot of them do max out their actual bank holdings or their bank loans. But that said, bonds allow you to completely customize because you're now the debt issuer, right?
Instead of the bank, you kind of become the bank.
You can completely customize it.
Right.
I mean, you can add sweeteners. So there are a couple of different ways you can sweeten
sweeteners.
A bond offering.
Yes, sir.
You can add warrants. So you can allow people to buy stock or you can add a convertibility feature, which allows people to convert their bond holding to stocks in your company.
And these are sweeteners. Yes.
Yeah, these are called sweeteners because they allow you to issue bonds at a lower interest rate.
Exactly.
And so those are all incredible benefits of a bond over just a traditional vanilla bank loan.
Yeah, and it's interesting because growing up, I didn't know that much about bonds, until this past year, just working with Hoskin Capital. But it's interesting. There's a lot of really cool features, especially when you put enough money into bonds, you can actually generate a really nice cash flow. And
I'm so sad that bonds in general require $25,000 lot sizes,
right?
Because this is the type of thing that I want to make available to everyone and allow them to invest in bonds because especially in the last few years, for a lot of you guys who are just joining investing, who are maybe 18 to 22, 24, bonds haven't been attractive almost in your lifetime. And so this means that we haven't even necessarily considered them as a possible investment, but especially back in, Tim, do you remember when, was it the 80s that bonds were yielding 15%?
Yeah.
The 30-year was up to
Wow.
almost 18%.
Wow.
To just collect an 18% return.
Wow.
Consider inflation at the same time.
Yeah.
Yeah.
What was inflation?
Up to 15-20%.
Yeah, so it was at the same time that's what we're talking about. With
So
real
bonds
return.
were in a way a good hedge against inflation.
They weren't a good hedge, but they included the inflation.
Okay,
premium.
so they just included it instead of being
So
a hedge.
Investors are sort of responsible for that because if I know that inflation is 3%,
Mm-hmm.
I need the bond to pay more than if inflation was 1%, right?
Right.
You have to include that inflation premium in that bond yield. Someone said something about yield curve control. I want to talk about that. I don't remember where it was, but I think it was, can you talk about yield curve control? And yes, I can, because this has been a huge topic with monetary policy right now. So as we know, the 10-year US Treasury, the yield is skyrocketing. And this is what has caused a lot of the bumpiness in equity markets lately. And so yield curve control is this idea where the federal bank, the Federal Reserve of the United States, will sell bonds. They'll sell 10-year Treasury bonds. And what this will do is it will decrease the yield, right? Am I getting this backwards? I think I have it.
That's the challenge for me, understanding the relationship between bonds, the yield curve, and just rates in general.
I have to think through
it. It's early.
So
trust me, I get it.
The Federal Reserve does open market
Mm-hmm.
work. And what they do is they will sell bonds.
Mm-hmm.
And if they sell bonds, that's tightening, right?
Jump in.
Yeah, come in, get in here, come introduce. Pull up a chair, there's one for you. Yeah, here we go.
We got our third.
It's obviously
man.
far too early.
Here,
So
we're going to let you come right in here.
Okay.
yeah.
Does this work?
Yeah, ladies and gents, this is Tim Frenzel. This is our CFA and Chief Technology Officer, and he's
Let's get some claps and
quite
chat.
a bit smarter than I am. So tell us about yield curve control.
Yeah, I mean, in general, I'm going to keep it short because it's an interesting topic, but for retail investors, you kind of have to live with the consequences.
Yeah.
So let's talk about the short end because you talked about the control overall. What's a central bank? It's not only applicable to the US bank, it's pretty much everything around the world. You control the short end. So you can control what are the lending rate on a 6 to 12 months basis as the ECB, US Federal Reserve, Bank of Japan, Bank of England, and so on. But what you can control is with the wording, and this is why when there's a speech out there, you really on every single word is the outlook, what the central bank, the Fed will do going forward. So, and this is in a kind of normal market environment. Right now we are, since Lehman Brothers, since European crisis and other things, we are in a very different environment. So I wouldn't call this normal. And I think we all are agreeing on this. COVID is not normal. Anyway,
Yeah.
So for the short end, this is direct access for banking. What are you going to do? Long term on the other side is how stable is the commitment of the central bank to future short-term rates? And this is where we really control the 5, 10, 20-year rate. So if you go back to 2008, 2011, and so on, where all the smaller and bigger crises happened, especially 2008 affected everybody, 2011, and Europe and the Eurozone and so on overall. So what this means for us as an investor is, okay, is this a short-term effect where we're going to be in a low interest rate environment for 2-3 years? It doesn't affect the long end too much. We move a little bit, but we pretty much stay stable. So for us as a market, we don't really react to this information. In the short end, you're going to be affected. So if you have short-term ETF, something like this, bank accounts, you're going to be affected. But long end, like, okay, we're going to go back to this and that's it. If the commitment to the central bank is more, okay, we're going to be in this environment for the next 5 to 10 years because we expect problems on several ends, then you see the long term coming down further and further. What you're getting into more is the second arm, this third arm, which kind of developed since financial crisis, is we also, or not we, but the central bank can act as a buyer in this market to say, okay, we want to provide the market with liquidity. We're going to start buying usually very high AAA, AA corporate bonds and so on to lower the interest rate long term, because that will ultimately affect mortgage and so on. So really for somebody, it's like, I'm going to take out the loan and I want to buy something and I have to refinance that in 5 to 10 years. So this is how the central bank through different instruments can control the curve. But at the end of the day, it's just one central bank, and they're well aware of this. They're one part of the market participant, major part of the market. But if the market stops believing the central bank, this is where we get into trouble. Because the main priority, and I want to be clear on this, and it's internationally, the priorities are slightly different, but for most central banks is we need to guarantee price stability.
Yeah.
Because if price stability is not given, inflation becomes a problem, which is right now the main concern of the market. This is why Bitcoin and other cryptocurrencies are getting more popular, because we are concerned that what if we go back to the 80s, we have a 15, 20% inflation rate. What if your dollar, it's worth $100 now? And let's say I buy and I want to go derail too much, but let's say I'm going to buy an iPad for $500 now. And I decide I'm going to wait for the next one, take my $500, put it in my pocket, wait for the next better version. Then you suddenly have to buy the same, and then it's more, significantly more. Not because the technology is better, because inflation is 10, 15%. So your money is worth less. And you talked about this earlier. The bond has to reflect that. What is the current inflation rate? What is the expected inflation rate? And I want to derail too much because there's a lot to talk about.
There is a lot.
Well,
but I want to get you guys back on track.
So you said a couple of really interesting things there. So one, on the short, so when we talk about the short end and the long end, we're talking about the yield curve. And the yield curve is the different maturities of bonds of the same investment caliber. So in this case, we're talking about US Treasuries. And so when we say the short end, we're talking really short, right? Bonds with 6 to 12 month maturities. And then when we're talking about the long end, we're talking about between 10 and 30 year maturities. And so what you mentioned at the beginning is the Federal Reserve can directly control, or almost directly control, the short end, because they can change the rate at which they lend to banks, right?
Correct.
So that's how they control the short end. The long end is way more finicky. It doesn't fit quite as well. They don't have quite as much control. So you mentioned two ways that they really control it. They control it by buying US Treasuries. And when they buy US Treasuries, they increase the demand for those bonds, which increases their price, right? And when the price goes up, the yield goes down. Mm-hmm. But then the other thing that you mentioned is this idea of their dialogue
language
being the most important part. And I think a lot of you, especially as you're getting into investing, you know this guy, he's kind of small, little underground, called Jerome Powell. And this is pretty much his entire job. I swear this is what this guy gets paid to do, is he gets paid to tell us what we want to hear as investors and balance that with what the Federal Reserve needs to do. And what he's doing is he's managing the relationship so that we as investors feel confident in the future of price stability, in the future of inflation, so that we will continue to invest and stimulate the economy, right?
Absolutely.
Okay.
That
was awesome. I like that.
Yes.
If you don't mind, because I'm a CTO now, right. I'm a former, and we can go about the whole intro later on. I spent about 12, 13 years in finance and hedge fund investment and so on. You're going to hear more from me tomorrow. But I'd like to focus on this a little bit, because with Greenspan in 2008 and then Yellen and now Chrome is when you, and I know some of you are more event driven traders, like you listen to, okay, there's a speech coming out, I want to see what it is. And you really pay attention to every single word. And this is exactly the language. If the language is softening up a little bit, you clearly, okay, what does it mean? Is this unclear? That brings the 10-year, 20, 30-year yield to more volatility, increases this uncertainty about it, or they're very clear in the language. And I would say, hey, we are in this COVID environment. We want to support the market because we have to, but we also have to consider price stability. So we're going to keep this rate down for 3 years. That's good for the market. They know what's going on and they can act on this information. Just to put you in perspective, and this is where the tech guy comes out a little bit, you're going to sit there and read this information and you try to anticipate how the market react to this. But as a quant, this is nothing I really need to do anymore, because I have tools, algorithms that run the sentiment analysis on it. And there's so much research about this that allows me to act on this information instantly. So while you're still hearing the words, as a quant, I'm already trading this information. And this is why you see this in high frequency, especially the interest rates, currency markets, and main markets are heavily affected by those major decisions, reacting almost instantly. So as soon as the word comes out live, and I hope you're not lagging, you know, I know some TikTok guys are lagging today, you will be immediately, okay, information's already out there, market reacted, and you still clicking the buy button while it's already in price.
And that goes into efficient markets, doesn't it? Like
Absolutely.
the efficient market hypothesis. That was something really interesting to be learning about while I was studying for the Series 65, was all that and behavioral finance, just about how people react to this news that they hear. And it's funny because a lot of the stock market is really just people listening and, you know, understanding how other people are going to feel about news. Because very often you can get good news about a company or a stock or about the federal government, and the price can go in the exact opposite direction. And it's something that I haven't really considered, the fact that there is a more fundamental, math-driven, technical.
That's why he does the risk.
Exactly.
He does all of that.
There's a much more mathematical side to stonks and stocks and bonds, and there's, you know, a whole other characteristic, human behavioral part of stocks that if you can understand how people react and how humans kind of understand and interpret news, you can actually better kind of predict how the stocks and how the market's going to do, as opposed to doing a bunch of math and, you know, kind of understanding based off of both technical and fundamental analysis what you think the stock is going to be doing. And you know what I mean? Right. It's a lot of back and forth between, it's a balance, I would say, you know, and that's why we got YouTube.
To summarize this, and then give you some time to go back to your schedule, and to give you a teaser for tomorrow, because for me, it's more about, and again, we are in the market. It's all about opinions by the end of the day, and who's right, who's wrong is about timing, is about luck to a certain extent, and about, do you understand how the market works? And at the end of the day, I think it's a lot about what you brought up, Carl, is about understanding how you calculate fair value, understanding how a business works by the end of the day, how a business works from a fundamental level, which we focus on today, from a macro level, big picture, it's why we talked about central banks and so on. But ultimately, it's about, we are still humans. And even as a quant, I'm going to be the one who builds the algorithm that reflects my opinion, how I think the market works. So human behavior finance is a huge aspect. So you might be right about, okay, I think GameStop should be valued like this, or Bitcoin should be valued like this, or the Bank of Japan is going to do this. This is your opinion, and you might be right, but timing is essential, and understanding when people will pick up on this information. You saw this lately with AMC and GameStop, will pick up on this. So it's predicting about human behavior, which is a massive part in the 80s. It's not about being right about this is a fair value. It's about, do I understand how everybody else thinks about it? Will they agree with me eventually? And we get on the same level, and you're going to be an early adopter, or they never agree and you're going to be right, but you can never profit from this information because everybody disagrees. And we're on the market. Not everybody's as efficient, as has the same information. We talked about market efficiency a little bit, and there is so much more to talk about.
So much more.
And I have more about that. Don't worry. So we talked about a lot. We covered a whole bunch of different topics, and I think each one is important. But the thing that's important to me about this event, whatever you want to call it,
VERITAS,
is that you guys are then able to take what we're talking about and apply it. So here are a couple of ways that you can apply what we just talked about. One, we know that inflation and central bank policy play an enormous role in the performance of investments. And so a few of the things that I highly recommend that you do is you should go read the transcripts or listen live when either Janet Yellen or Jerome Powell speak. And you're able to create a Google alert for whenever they speak, so it will pop up and you'll know when they're doing a talk. And this is pretty widely reported information on any sort of financial news website, so you'll know that way as well. So make sure that you do that. And then at the end of the day, that final part that Tim was talking about, I think is really important.
Right.
Because at the end, you are having an opinion about the market at any given time. I don't care how educated your guess is. that is investing. It's called speculation for a reason.
Right.
And so you need to make sure as an investor that opinion is backed up by as much information as is humanly possible. And so this is where quantitative algorithms come in. This is why we're working to implement so much of this at Hoskin Capital. But more importantly, you need to know what to look at. And so that's what we're going to move into now for the next, we've got 45 minutes. We're going to talk about the things that you can look at in a company to figure out if this is one that you would like to have a positive or a negative opinion about. So let's talk first about the different ways that you can analyze a stock. And I'm going to try to not put this in the middle of everything. So
Nate.
Yeah. Oh, we got questions?
How do we analyze a stock? We also have questions. We can answer those whenever.
Let's just, I need coffee. Where is my coffee?
Where is your mug? I said you drank the mug.
I drank the mug.
Oh my gosh.
Okay, what do we have?
So let's see. We talked about REITs. What's a good capital?
What does capital structure tell you about a company's future growth and profits? Andrew. Wow. Beautiful. Don't worry, I'll talk about that.
Andrew with more questions.
Why would someone pick a bond over a blue chip stock? I'm under the impression that they give the same sense of security, but way more upside because of the dividend, and the stock price may still increase. So this is a great question. Why would you pick a bond instead of a stock, especially a blue chip stock that pays a nice dividend?
Right.
So my take on that trade-off is yield, yield and risk. And at the end of the day, that's all of investing. That's a whole other issue.
Yes.
But a bond is always going to be safer than a stock. And the reason is because there is an order in which money is paid out in bankruptcy.
Right.
And so at the top of that are secured debt holders. So these are people who have bonds that are secured by actual property. So if I have a secured bond in your company, I can go take your couch. Like that's how I'll get paid back.
Not my couch, bro.
You should have thought of that when you signed it over.
Gosh,
bond.
right. But I needed the money, so I was willing to.
Yes, please. Absolutely, I need coffee.
Get him some coffee. Get this man some coffee.
So then at the very bottom, the absolute bottom of this hierarchy are shareholders, common stockholders. And so common stockholders are called residual claimants. So normally blue chip stocks do not go bankrupt, but we know history is the best tutor that it absolutely happens. And so if you are a stockholder in a common stock, in a blue chip company,
in Cal Incorporated,
if you go bankrupt, I might not get anything.
Right. Because I have to pay the people who I actually owe money to before I pay the people who kind of just have ownership.
Yeah. Whereas if I own a bond,
right,
you have to pay me back, and you're going to pay me back long before any of your shareholders.
Yeah. And for stocks too, you pay the preferred stockholders before the common stockholders. And then it goes further into sweeteners, like what your stock or debt can actually do, such as convert.
I love it. I can tell.
There's
I can tell
so
that was
much
on a flashcard.
Yeah. Well, on a flashcard. Yeah. Every day.
I have spent the last year studying for my CFP and just took it a few weeks ago. And Cal just took his Series 65 on Friday the 19th. Something like that.
Yeah.
So
last week
we're both thinking in study terms.
Oh my
working
gosh.
on getting out of it for sure.
It's quite a process unwinding from the every night
You guys are
grind.
sounding like textbooks. I'm a textbook.
This guy is a walking textbook.
I
kind of know what I'm talking about.
Okay. Let's talk about what to look at in a company, right? So 2 main ways to analyze a company. What are they?
Fundamental
with an F,
and then technical.
Beautiful. So let's talk about fundamental analysis first.
Okay.
So if you were to look at a company right now, tell me a couple of the things that you might look at.
Well, I would first off, what I would do, and this is coming from a purely inexperienced investor standpoint,
right.
I would
sales guy.
Yeah. I would just look at the stock like movement history, and that is technical analysis for those of you who don't understand that.
Prices.
So exactly, if the stock has shot up, so let's say I'm looking at GameStop. If I look at the stock and it's shot up, I'm going to be like, wow, this looks great, but is it going to continue going that far in that direction? And I might wait a day, I might wait a week, and I might not wait at all. I would say, just let's go, you know. But doing other sort of fundamental analyses really plays a big part into whether or not I do want to wait or what I think the company is going to do. And that's one of my personal shortcomings, is that I don't do enough fundamental analysis. And I feel like there aren't enough tools out there for the inexperienced investor to kind of do the analysis required to be able to understand whether or not the stock is going to go in the direction that they want.
Because it's intense.
Right.
So you mentioned technical analysis as looking at price charts.
Right.
And so that is at its core what technical analysis is. So tech analysis, you couldn't care less if the company sells computers or diapers. You don't even have to know, because all you care about is how their price is moving, right? And there are a lot of different trends that you can look at. There are a lot of different indicators. If any of you are on something like TradingView or anything like that, you will understand that there are a lot of different things you can look at to tell whether a stock's price is in a buy position or a sell position. And I'm going to talk about a few of those. But first,
coffee.
I'll drink cold coffee. Are you kidding?
Hey,
Cheers.
Cheers.
Oh, you didn't say it was iced. That's actually.
Is it iced?
I thought it was going to be.
Mine's just warm coffee that's turned cold.
Home brewed cold.
Which is so much worse than this being cold brew. Oh my gosh. So
what we were just talking about.
Fundamental analysis first. We'll get into technical analysis, but I think that fundamental analysis is the most important one, because at the end of the day, I care if the company sells computers or diapers.
Right.
And so if maybe the technical will play a role, especially in short term, but I invest with the attempt to hold the stock for like 5 years.
Perfect.
Preferably my entire life.
Yeah, definitely.
Definitely the long-term holder. And so when I look at a company and I say, do I want to invest in this company? I ask 3 questions.
Okay.
Is this company doing something that is innovative?
Okay.
Are they doing something that is going to drive them forward? So one of my favorite ones that I always talk about, because I've been looking at them since 2015, is CRISPR Therapeutics.
CRISPR.
So it's a genomics company. I highly recommend holding it. No, I highly recommend.
Can we even recommend holding it?
No, none of this is investment advice. I actually don't recommend CRISPR.
CRISPR right now has not been doing that great either. Yeah.
Not the best. Has some ties.
We just went from up to no.
Yeah,
but
has some ties with a with a pharmaceutical company that is notoriously overpricing all of their different product offerings.
Really?
And so this idea of gatekeeping an incredibly groundbreaking technology is an issue to me, especially with impact investing. But anyways, I don't have a buy or a sell recommendation on CRISPR.
Right.
And even if I did, I wouldn't be able to tell any of you guys, sadly. So when I'm looking at a company, I want to know if they're doing something innovative, right? Because if they're doing something innovative, this is going to be their #1 growth story. In the case of CRISPR Therapeutics, they are actually developing ways to edit our genome and implant little, I would call them mugshots. So a mugshot of a pathogen that we might want to fight off. So a CRISPR is a clustered, randomly interspersed palindromic repeat. And what these are is they are little pieces of our genetic sequence that we take when we fight off some sort of invading body. So for instance, when we fight off something like COVID, we collect a CRISPR. And a CRISPR is what tells our body to fight it off next time. That's why it's the mugshot. We now have an image of this pathogen, so we know when to kick them out of our store. This is an incredibly innovative technology, and it's new, it's relatively untested and unproven, so there's speculation involved, but that checks off the first thing. Right?
What is speculation?
Oh, so I'm putting.
Is that too much of a tangent, or is that in line with what you're going to talk about?
Speculation is educated guessing, right?
Basically,
where you don't know the outcome. You are speculating and you are making a decision based on incomplete information. Is that enough?
Is that speculation?
What?
Thank you. I'm just kidding. Okay, great. Then
Hold on. My next question. I want to finish my three really quickly before we derail again. So my second question is the company good at what they're doing? Because if they're good at what they're doing, they're probably going to be making money and adding to shareholder value, right? Mm-hmm. And so the way that I look to see if a company is good at what they're doing is much more quantitative. The first question, innovation, that's more my opinion. Do I think it's innovative? With quantitative stuff, I want to look at numbers and I want to understand, is this company making money? So do they have growing revenues? Do they have growing profitability? And do they have growing efficiency? And we're going to look at a couple of ratios that will allow you to understand each of those. But that is the first question, the second question. Is this company good at what they're doing? And then the last question, because I talked about how risky it is to own stocks in the case of bankruptcy, is the company going to go bankrupt anytime soon? Are they healthy? So I've listed all of these out. The question is, what do I look at, right? Mm-hmm. So I'm curious. I'm thinking about going and pulling it up on my computer and showing them the ratios, or should I use something different? What do you think? What do you guys think? Because I'm happy to show you the tools that I use in a given day to look at this, or I can explain it with chips or something like that.
Show us the tools.
All right, let's see the tools.
We're getting the show us the tools.
Cool. No, Cal, you have to stay here. Otherwise, no one's going to be in the camera.
Oh, that's fine.
You need to entertain them. All right. Let's see.
These guys rave 1000% from Stanley.
How did they know?
When is Kyla going to speak?
9:30.
9:30. She's coming on.
34 minutes.
The schedule, by the way, if you are interested in looking at the schedule for the whole Veritas event, is posted on the Instagram.
It's also on the website too.
And on the website.
But I like the Instagram better because then you can follow us.
Exactly. Give us a follow.
Okay. Is the screen sharing? Can you guys see all of this?
Yes. They might not be able to hear you as well. Let's move this.
Yeah, move me a mic. You can probably just put it at the end right there.
Yeah, I'm going to put it right here.
Okay. Can you guys hear me? Does this work? Let's see the chat. Can see and hear perfect. Beautiful. Screen's good. Okay. So what we are looking at is Koifin. I have to say it over and over because I'm not sponsored. I just use them all the time. And Koifin, I think, is a really great one-stop shop to be able to see anything you might be interested in the markets. So you can see the very simplistic performance of the indexes, but then you can also break it down by sector within the United States. You have all of your fixed income information, and there's more to that. And then you also have performance of global markets, which is something that I think is really underutilized by a lot of investors. Because what's going on in Europe and what's going on in the emerging markets might actually tell you quite a bit about what's happening in the United States, if that's where you invest. But the thing that we're interested in right now is financial analysis. Before I do this, I'm going to show you guys Edgar. So Edgar is the company filings website for the SEC. Any publicly traded company needs to give you their financial statements every single year. And they actually need to update it a little bit quarterly as well. But this is the thing that we care the most about, is the 10K. And I'm using Apple for this example because it's just the most common one. So if we open Apple's 10K, these are on average 150-page documents. And I love them. I love to read a 10K, but that's because I'm a nerd. And so in this case, the thing that we're interested in is the financial statements. And this is always item 8. And so you can click on item 8 and go to the financial statements of a given company. And you can see the amount of money that they're making for net sales. You can also see the cost to make those things. So this will be your statement of operations or your balance sheet, your income statement. And then they will also have their balance sheet. So what they're actually holding. For instance, I believe this is in millions. So Apple right now, as of September 26, 2020, had $38 billion just sitting in cash. These are the types of things you can learn from a 10K. But it is so much easier to look at this information on a website that aggregates it for you. So that's why I use Koifin, because we can click on the balance sheet for Apple and we can see it looking back. In this case, we're looking back quarterly but we can change that if we want. We can go annual instead. And so you can see that it's the exact same information. Apple in September of 2020 had $38 billion in cash and equivalents. So we're looking at the same information, right? Yeah, okay. that number just blows me away. And so this is, in my opinion, one of the best tools for looking at a company fundamentally, because I now at my fingertips have all of the information that I could want on their income statement, on their balance sheets, and on their statement of cash flow, which are the three main financial statements. And then Koifin has been nice enough to go and pull the highlights for me. So you guys were talking about capital structure earlier. We can now see their capital structure. So we can see their market capitalization. We can see the amount of debt that they're currently carrying, as well as the amount of cash and short-term investments they have, and their enterprise value. Tim, pop quiz. How do you calculate enterprise value? So enterprise value, I believe
that was a great reaction,
is market cap plus debt minus cash, because the idea is that if you were to buy a company, you would immediately pay the market capitalization, and then you would inherit all of that debt, and you would use the cash that you have to pay off as much of that debt as you possibly can.
Okay,
that's what enterprise value is. So this is very commonly used in multiples. That's why I wanted to mention it. But now let's look at the thing that I was actually curious about, which are ratios. So what were my three questions? What are the ones that I asked? Is it innovative?
Oh, isn't it innovative? Does it make a difference?
So is it good at what it does?
Is it good at what it does?
And then is it healthy?
Is it healthy?
Those are the three main things that I look at.
Right.
So when we're looking at whether or not it's innovative, this is qualitative stuff. Really, you're going to be looking at the description of the company. You're going to be reading about what Apple does. You're going to be looking at Apple in the news, trying to understand what people are talking about. Then if you've made this qualitative decision, we can get into the numbers. And this is where I then go to financial analysis and I look at whether or not the company is good at what they do.
Right.
For me, the most simple indicator of if a company is good at what they do is, do they make money, and are they making more money year over year, right?
Okay.
And so if we go to the income statement of Apple and we look at quarterly, then you can see this consistent upward trend for Apple. Of course, their fourth quarter of every single year is going to be their most productive. And so that's why you're seeing this seasonal effect. If we look at annual, that will clear out and you can see an upward trend. This is the first thing that I look at for a company. Are they making more money year over year? Apple has done quite well at doing that.
Yeah.
Then are they using that money to reward shareholders? So this is where we get to return on equity. So return on equity is your sales divided by stockholders' equity. And so the question is, it's your earnings divided by stockholders' equity. The question is, are they making money? And is that providing an attractive return compared to, are we laggy?
Who's what?
Oh, right. Well, here, let me pull my, sorry, we have, the TikTok is just looking at you and everyone in here wants to see my screen. You guys actually want to see what I'm talking about? Weird.
How many do we have on TikTok?
45 of them.
45.
I'm sorry about that. Let me see if I can flip.
By the way, if you're on TikTok or Instagram and want to join the Zoom,
do we have room?
We have 2 spots.
Oh, awesome. Well, we have 2 spots. You can find,
and they're filled.
Never mind that. They filled up. So if you guys want, the Zoom link is on our website. It's hoskincapital.com/veritas. I think we have the waiting room going. And so if you want to just sit there, that's going to be the best way to watch this, because obviously I'm just holding my phone and trying to show you what I'm talking about.
We're also getting some really good questions in chat if you want to take a look at that.
break into fundamental analysis first,
Okay.
then we'll do questions, and then I'll talk about the health of a company. So I'm sorry, guys, the tool that I'm using is Koifin, and I was reading through the 10K on Edgar. And so this is sort of the catch up on what I've been up to. And we're answering 3 main questions about a company. We're going to talk about, is the company innovative? Is the company good at what they're doing? And is the company healthy? So right now we're talking about, is the company good at what they're doing? And we were looking originally at the total revenues. And now we're going to be looking at a couple of their profitability metrics. In this case, we were looking at return on equity. And then we're now going to move into their margins. So their ability to be profitable and to be more profitable. So these are the things that I look at when I want to know if a company is good at what they're doing. And in this case, their gross margin is relatively constant. Their EBITDA margin is actually decreasing. So for Apple, let me go back to the income statement. So the gross profit is just your revenues minus the cost of goods sold. That's going to give you your gross profit right here. And so when we're talking about gross margin over here, that's what we're actually measuring. And then EBITDA margin is earnings before taxes, depreciation, and amortization. And so this you're actually going to see further down. Let's see, why is it not letting me scroll? So we have EBT. Where is EBITDA? Here's EBITDA. So then this right here is what we will actually be using to measure that second one. And so these, if gross and EBITDA margin are profitable, if they're positive, that's your first immediate indicator that it is a company that is making money and that is being profitable. But hopefully you want to see those metrics increasing. They're becoming more profitable, or at the very least, they're remaining stable. And so that's why I want to talk specifically about this EBITDA margin. So as you can see, over the last few years, Apple's EBITDA margin has been decreasing. Cal, why do you think that would be?
Oh, I was just reading chat. I'm sorry. Why is EBITDA increasing?
Yeah, why is the EBITDA margin decreasing?
Why is it decreasing?
Yeah.
Oh, well, either people aren't investing as much, or the company isn't returning as much as they normally are.
So my guess for why EBITDA is decreasing is because they are increasing their SG&A.
What's SG&A?
SG&A is selling, general, and administrative expenses. It's kind of highlighted right here. More specifically, I think it's because they are increasing their research and development, most importantly. So my hypothesis, and this is sort of tinfoil hat type of thing, but my hypothesis for Apple is that their EBITDA margin is going down because they are spending as much money as possible on developing new technologies. For instance, they were just developing a new chip, right?
Right.
And so the cost of developing that chip is probably going to eat into their EBITDA margin. And so the fact that they've been able to keep their net income, their profit relatively stable, is a sign of an incredibly good company that is then investing for the future. So for me, even though this EBITDA margin is decreasing, that's actually a good thing in my brain in this case. So now let's talk about, is the company healthy? Because this is the most important one. We were talking earlier, I don't know if you guys were here, about if you own stock, you are the last person to receive money if a company goes bankrupt. And so this is really important because the company going bankrupt is the worst thing that could happen for you, the common shareholder. So let's look. Let's see. Flip camera. I apologize for my shaky hands.
Give us an announcement on TikTok that everything's going to be on YouTube after. And this is for everyone here as well.
We are going to put everything on YouTube.
We are recording this
That's nice. I was gonna break it up into little videos and make people go through all of our content to parse it out. But I agree with you. I think it makes sense. We're gonna put it all on YouTube. We just started the Hoskin Capital YouTube. I feel like this is just an incredible way to start.
More announcements to come. But yeah, if you're here now, creds to you.
Right. And we are going to withhold a lot of the guest speakers have compliance issues because they're coming from major hedge funds and things like that.
Right.
I'm pretty sure we're not going to be able to post those anywhere. So especially at 9:30, so in 11 minutes or 21 minutes, make sure that you're here for Kyla because I don't think we'll be posting hers. And then make sure you're here tomorrow because I know that all of those speakers are just locked up.
And those are some high-end serious speakers.
Yeah, we have PhDs coming. I think collectively they manage close to $5 billion. And so
wow,
they just can't be on some dude's YouTube, you know? Hoskin Capital is growing, but we're still a startup. So we need to work through that. Okay. Final question is the company healthy? And the way you answer that is using liquidity and solvency metrics. So let's see, where did it go? Let's go to profitability. So liquidity metrics are these guys right here. Current ratio, quick ratio, average, let's just use current and quick for this one. So current and quick ratio right here. These tell you how good a company is at covering their short-term obligations. So their short-term obligations are the ones that are coming due in the next year. And so the quick ratio, oh gosh, I'm gonna mess this up. I'm gonna be really sad if I have to Google the different ratios, but quick ratio is cash plus marketable securities divided by current liabilities. So it's the very, very quick assets, the very liquid assets divided by your current liabilities. You pulled it up. Okay, yeah, so the quick ratio is current assets minus inventory divided by current liabilities. I got it right. Cheers. Okay, that's exciting.
Everyone clap.
So then what is current ratio? Because current ratio is current assets divided by current liabilities. So the difference between current ratio and quick ratio is the fact that current ratio includes inventory. That's the big one. Okay. Those are the two main ones that I look at for short-term ability to cover their debts. And then mostly I look at total debt to equity when I'm considering solvency. So this is how much debt does the company have relative to the assets that they have. And so for Apple, this is really, really interesting because look at how much debt they are accruing. This is an incredible increase in the amount of debt that Apple is taking on. So the question is, and this goes to you, Cal, why are they doing that?
Again, was not paying attention. Restate the question.
Why is Apple taking on so much debt? And let's get people in the chat responding as well.
Who would be an Apple debt holder as well?
Who would be?
Yeah.
So mostly is issuing bonds. So they're mostly going to issue bonds to like you and me. Cal, did I lose you? Reading comments?
Yes.
That's okay. There are quite a few of them.
I was going to say innovation or maybe risk management.
Okay, I'm seeing, yes, Isaiah Rubio nailed it. So one of the main reasons that they are doing this,
Isaiah for the win,
is because they can. Because they're able to borrow at historically low rates. And so for the company, they can take on way more debt and have their interest payments remain pretty much the exact same, right? If I was in that case, if I could double the amount of debt that I had and still pay the same amount of interest, I would do it in a heartbeat. I would do that without even blinking. And so my belief is that that's why they're doing it. There's an incredibly low interest rate environment, and that's going to allow them to lever up, and they're doing so. And that's what we've seen lately. And as you can see, that especially took place in 2020. And so this is because interest rates have hit a historic low in 2020 and have been near zero, depending on which metric you look at. So that's kind of the end of my rant
Can you add one more thing?
Yeah.
That's a good question. Does that increase the risk of over-leveraging?
Ooh, so yes, absolutely. Because the interest rates, and as we're seeing right now with the 10-year treasury, the interest rates might not stay low forever. And so they might be trying to carry this current amount of debt and have to refinance it going forward, or have to issue more debt at a higher interest rate, which means that their current debt levels, given the current interest rates, are healthy. They're fine. Apple in general is probably fine. But if the interest rates go up, they might find themselves incredibly over leveraged and unable to keep up with those interest payments. Apple, because as I mentioned, they're sitting on what, $38 billion in cash or something hilarious like that. They're going to be fine to cover those interest payments without going bankrupt or running into short-term financial trouble. Smaller firms, especially smaller growth firms, will suffer enormously. And this is why we're seeing growth tech selling off when interest rates go higher, is because they are directly inversely correlated with that. Okay, I'm going to move back. I'm going to stop sharing. And we're going to move back to the
great speech. That was amazing.
All right, let's get you guys set up back here. Okay.
What's your phone at?
Probably close to death. Let's find out.
Close to death.
15 minutes.
Yep, we have 15 minutes until Kyla. Get hype. It's not telling me. I'm gonna have to exit. Oh, I still have so much.
Awesome.
Are we back? We're back. We're good.
Let's see, how much do we have here? Wow, I can't even check. I'm at 42.
I'm still sitting at like 70, so we'll be all right on that. You want to grab the mic and bring it over?
Yeah.
Try not to break anything while I do this. Okay. So last 15 minutes, let's talk about efficient market hypothesis, because we can.
Oh, I love this.
Because, I mean, how interested are you guys in technical analysis? I am not an expert in technicals at all, and Tim's going to talk about a lot of that tomorrow. Do you guys want a primer on it for 5 minutes, or should we just move into EMH?
What do people want?
Okay, we're looking, I'm seeing technicals. All right, fine, let's do both. Twist my arm. Okay, so quick crash course in technical analysis. As I mentioned, you're looking at the price trend. Ooh, coffee.
Get your coffee.
As I mentioned, you're looking at the price trend for a specific company, right? You don't care if they make diapers. You don't care if they make computers. Your goal is to find a price pattern that you like and that you think indicates a purchase. It works. Pop filters in place. Okay. So how do you look at that? There are a couple of main indicators for technicians. Technicians look at moving averages. They look at changes in volume. They definitely look at relative strength indicators, the RSI. And then finally, they look at, well, Tim, how would you classify a MACD? Oscillator, that's the word I was looking for. You look at oscillators. So I'm not a technician at all. I know these just sort of from playing around in college.
Which one would you use or are most interested in?
I love RSI
at the moment.
So
RSI,
yeah,
okay.
RSI, relative strength indicator, is something that I actually use when picking investments, because I like to know, once I have my fundamental analysis done, I then want to look at the technicals to figure out if I should get in now or if I should get in later, which is what you were talking about earlier. So I look at the RSI, definitely. Usually I will eliminate an investment in the near term if their RSI is above 70, and definitely if it's above 80.
Okay.
And so that's just Wilder's RSI look back of 12 days or 14, something like that. So
what does the RSI tell you specifically?
So the RSI shows you the relative strength of the company's stock, and the relative is to its previous performance.
Gotcha.
And so is it incredibly overvalued relative to where it's been, or is it undervalued relative to where it's been? And usually it will oscillate in the middle.
And this is strictly technical analysis.
Strictly technical.
Okay.
Yeah, you don't care what the company does. You're just looking at the price. The other thing that I will use, especially with the S&P 500, so not necessarily looking at individual stocks, instead looking at the market as a whole, is support and resistance lines.
Right.
So for instance, we had the NASDAQ fall something like, thank you. So
You can use that if you want.
I said no whiteboards at the very beginning.
Oh,
I said we're not doing a single whiteboard, but we have it.
We have a whiteboard.
This is our dirty little secret.
you can kind of see it pretty well too.
So this is the RSI. Tim was nice enough to create this incredible chart for all of you. Scale of the RSI is between 100 and 0. 0 is very, very oversold, meaning that it is of interest to buy. The more oversold, the better. Overbought is overvalued.
Okay.
And so it's not necessarily what you would be interested
So
in. This is why we have a technician here that's not me. Do you want to hop in? Or do you have work to do?
He's just,
of course,
he's just going off. He's got it.
That's the range you want to trade.
So
30-70.
God, he's good.
He's good.
So 30-70, this is why I mentioned 70, is because you want to trade when it moves outside of these ranges. This is the general idea of RSI. And so if one climbs above 70, you could consider taking a short position.
Make sure they can see it too.
Oh yeah, over there. Do we have, it's in everything? It's in all the frames?
I think everyone can see it, yeah.
So we're talking about the relative strength indicator. That's 100, that's 70, that's 30, and then 0 is down there. I cannot imagine
so
they could read this.
Let's take a stock, for example, maybe GameStop, and talk about how the RSI can tell you when to buy or sell.
So if we're talking about GameStop, if it drops below 30, that's a buy indicator.
Okay.
So you would be interested in purchasing GameStop here.
So that would be what, the months leading up to end of January, early February, or whenever it blew up?
So when it blew up is actually really interesting because RSI completely falls apart in that case.
Gotcha.
Because probably in the first 2 weeks of GameStop climbing, it probably climbed above 70.
Right.
Because it was trading around what, like, I don't even know. I didn't watch it. I tried not to watch it.
Yeah.
But when it climbed to like $5 instead of $4, it probably got above 70 on its RSI. And so in that instance, it stayed above 70 for weeks.
Weird.
And in those weeks, it climbed from 0 to whatever 52,000% return.
We're having some internet connection problems. I think we're okay. It looks
Let's
better
see.
now.
Started around 18. First boom was to 35. So yeah, by the time GameStop hit 35, it was already sitting at 100 probably on its RSI. And so it was going to stay there until it went up to 420. And the RSI would have been completely useless in giving you any sort of analysis.
I'm going to have to kick 2 people.
Why?
We're over the 100 limit.
How do we can't get over the 100
I don't
limit.
know.
Weird. That's okay. So that's my crash course on RSI. Yes, Koifin does include an RSI indicator. Let's go do that for 5
As long as the stream, grab your phone too.
Got my phone.
Okay.
Couldn't let you guys miss out on this.
Oh, the Zoom just died.
Well, I'll fix it.
Let's fix it.
Let's see. That means you guys get to see something the Zoom ones don't. I love it. Okay. Graphs, historical. We're looking.
So, and is the Zoom still up on your computer? There's a connecting. Is everyone?
It's up, and I'm.
Are you on the Wi-Fi? No. You guys aren't on the Wi-Fi. What is going on?
I think we're good. I have connection.
Oh, my computer stopped.
Yeah, I'm not seeing any issue. Yeah, John's saying it's good. Seems fine.
Oh,
Fine.
really?
We're totally.
Then that's just me.
Well, I lied. I'm sorry. This isn't exclusive content.
Here, let me try rejoining.
Let's move you.
How close are we? We also have 7 minutes until
Yeah,
Kyla.
until Kyla comes on.
Right.
So, okay. Flip screen, flip camera. So this is the RSI for Apple right here. So what I did in Koifin is if we go to the Koifin home screen, we can type in Apple's ticker and hit enter. And then let's see. And then I hit G to go to historical price graph. And then I selected the pre-made template technicals. And then this will give you the RSI right here. And so as you can see, it tends to trade within this range. But if we look at the RSI back in January, like January 7th or something like that, you can see that it popped into the overbought territory right before this large drawdown. So you might have considered in this case selling Apple according to the RSI, and this would have been a very good trade because you would have ended up being out for this entire one. Quick little, let's just talk about a few other indicators that you can see here. So this one is the Bollinger Band. That's what these little guys right here are. And the Bollinger Bands are based on the volatility of the stock. And so as the stock becomes more volatile, the Bollinger Band will extend. And if it breaks the Bollinger Band right here, as you can see right here, if it breaks the top Bollinger Band, that is a sell signal. And if it breaks the lower Bollinger Band, that is a buy signal. So as you can see down here, it broke before recovering. And then the last one down here that we'll talk about is the rate of change. So the rate of change is a momentum indicator. The higher the rate of change, the faster the trend is moving. And so as you can see right here, rate of change popped, and that is when the drawdown was occurring. 5 minutes.
5 minutes.
Put you guys back right here. I'm trying to think if there's a way to let the stream at least hear Kyla, because she was going to be in my ears. But I don't know if we could hook up a speaker maybe. What are we thinking?
What? Hey.
So
for Kyla,
I should stop sharing real quick. So for Kyla, I kind of want the TikTok stream to be able to hear her.
Yeah, so we should ask if she's going to be streaming from her TikTok, and then we can direct everyone who is watching from our stream to go to hers. That is one possibility.
You can't watch 2 TikToks at once.
Right.
And so I want them to be able to see both.
I mean, we could point it at the screen, but that's gonna be not as great.
We could point it and the sound won't even be there.
Right.
That's my issue. So what I'm thinking is we could maybe hook up a speaker, but I think she's just gonna have to be in my ears for this one.
Right. Yeah.
I guess that was the whole point of all the signups.
Well,
getting everyone.
Whoever's here is going to be able to
yeah.
be here.
And I'll ask Kyla if there's anyone I think we might be able to post their guest speakership. It might be her.
Yeah.
So we'll see.
We're capped out. Like,
yeah, we've been sitting steadily.
Pretty much been sitting. Maybe we should have gone for the bigger. No, you know what? I think this is great.
Exactly what we wanted. We wanted more people who really care about
intimate,
what we're talking about,
private.
Yeah.
Webinar.
We made it an investment. We made it worthwhile for them to get here.
You did not.
I did. I absolutely did. The investment company talking about investments.
So yeah, and they were getting intimate. Oh my gosh. But yeah, we're gonna be having Kyla come on
3 minutes.
In 3 minutes. I'm going to hop off and grab some more coffee during that time, and we will have her
plug a speaker to a phone with her TikTok live.
What?
So hook your phone up to a speaker.
Okay.
And then put it next to our TikTok live.
Interesting.
So they can hear her TikTok live and ours.
Is that gonna work?
I have no idea.
Oh my gosh.
No clue.
Okay. Well, we can try that. And worst comes to worst, you guys just pick a side.
Ooh, wait, who is this?
So
Christopher, doing webinars is not investment advice, luckily. That's why we get to do stuff like this.
Let's go.
Our goal is to give you education and not buy or sell recommendations on anything.
Awesome.
It will be delayed and may double your voices. That is true. There's going to be a lot of time.
So let's pull up the schedule. I'm going to screen share really quick. Start share. I am not able to share. I will not share then. we'll just talk about it. Kyla is going from 9:30 to 10. And then after that, and we don't, the schedule is more or less
Oh, wait. Can you invite someone to
loosely
TikTok Live?
interpreted.
Eric, tell me more. I don't know. I've never done live on
Oh, we might be
before,
able
so
to do that.
that
Yeah,
might work. I have no idea.
I think it will work.
Absolutely no clue. Can I? How do I do this? Teach me, guys.
Teach me.
You're going to hear your voice repeat and repeat. You're probably right.
Instagram does it for sure.
Admin
That's
settings,
something
moderators. I don't need a
that
moderator. I want
Stanley
someone else
and
in.
I know for fact.
Teach me how to TikTok, guys.
Teach me how to TikTok.
Let's see.
Oh, Kyla's here?
She's in?
Yes.
Yes.
So
Hold on, she made it. Yay. Hold on, let me put it so that I
put your headphone in,
I gotta get everything hooked up.
and
Otherwise-
then you can see her from here.
Oh my gosh, she's here. We're so on. Let's see.
Gallery.
Okay. Sound. Headset. All right, Kyla. Can you talk real quick?
Yeah, is my audio okay?
The audio is great and I can hear you. Can everyone hear her? Okay, I'm gonna put, I also need to put your TikTok in the chat because everyone needs to go follow you. Okay, we're here. Hold on. Oh, wait, let's see. I have to show off all of this for a moment. There we go. Now you guys can see that she's here. Okay.
You can hear her.
Question.
I can't.
That's fine. I can do all of the talking. Kyla, welcome. Thank you so much for taking the time. This is so cool.
Yeah, of course. Happy to chat. I think it's great what you want to do. So yeah.
Of course. We have been talking all sorts of, we've been talking about stocks, we've been talking about bonds, capital markets, a lot of the more vanilla stuff that have been around forever. So my goal with you is I want to talk about NFTs because this is something that I haven't looked into very much at all. And so I need you to educate me and teach me a little bit about this. But before that, I want to hear about you. So tell me what you do. Tell me why you're making incredible TikToks. What really drove you to do this?
Yeah. So about me. So I graduated college in 2019. Went to work in asset management for a little bit in Los Angeles. And then left recently to join On Deck, which is a tech startup and building some stuff there. And with the TikTok and my writing, I just really like to talk about finance. I really like to engage with community about it. And it's really important for me. I'm sure everybody on TikTok sees like the more, scammy accounts. I think it's really important to have rational voices out there. So hopefully I do come across as a rational voice. And I really like monetary policy, and I don't see a lot of other creators talking about that. So just trying to add some more depth to the conversation.
We should have just had you in this entire event because we just spent about an hour talking about yield curve control and the different methods that the Fed has to actually mitigate what's happening with the 10-year and applying their open market operations to it. So next time we'll do all of this in person and we'll make sure that you can be a participant. Yeah. So you started at Capital Group, right?
I did.
That's awesome. So my late uncle was actually a PM at Capital Group. And so that's how I know that. He was awesome. And he was the guy who got me into finance. So what do you do at On Deck now?
So we're building out something and we're announcing it on April 6th. So that'll be it's kind of a secret right now. But it's around finance and investing. In what On Deck does, for some context, is we're trying to be the next Stanford, but the Stanford of the internet. So really building community and fellowship as well as education. So sort of changing how we think of the traditional university model and making it more focused on, how do you actually create these concepts in a community? What?
Sorry, I got distracted and I left my TikTok live just face down. So they were staring at a wall. So,
really engaging.
That is something that I've heard from a lot of my friends who went to more of the Ivy League style of school, is they came away with the connections. The education wasn't necessarily the main component of that. It was about the people they met and the fellowship that they created. Is that what you're talking about when you're saying redefining the idea of traditional education?
Yeah. So instead of like the way that we think about it, rather than like learning in sort of like a lecture style, you learn from your community, you learn from speakers, you learn from like theory and application, rather than just like pure academic. Like you know this, like from finance, like the finance that we learn in school is so different than how it actually works in the real world.
Absolutely.
And so like the goal is to sort of actually create like curriculum around real world application and
right.
Yeah.
That's awesome. Something like we're trying to do here. I have no idea if it's working, but it seems like people are having
it looks
fun.
like they can't hear me on the live.
On TikTok Live.
Yeah.
And you're just right here. And so sadly, we have 100 viewers and we have 100 participants in Zoom, and those were the ones that RSVP'd and were really wanting to be a part of this event.
Okay.
So sadly, they get the exclusive Kyla experience.
Excellent.
And the people on TikTok Live will have to sit out on this one, sadly.
Yeah, scarcity. I love that.
So it was completely accidental. We bought the 100 person webinar and we were like, wait, people might actually like this, because they're like, I can't leave. If I leave, I'll lose my spot.
Yeah.
So the big thing I want to talk about is NFTs. I generally know what they are, but would you just give us a quick rundown for everyone in the chat about what they are, and then why we should either be excited or not excited about them?
Yeah. So like I'm not a crypto expert by any means, but I've like kind of been thinking a little bit about NFTs just in the context of like the broader market and sort of what they mean, on a very meta level. But NFTs are non-fungible tokens. And so they are a crypto token on the blockchain that points to an asset. So if you buy an NFT, you're buying a pointer to a JPEG file or whatever it ends up being. It's not actually like the art itself. It's this pointer that exists on the blockchain. And right now the market is pretty hot because you have a lot of people who are like trying to sell NFTs and trying to like enter the market. You have people who just sold a big NFT for 69 million. And that was
insane.
Yeah, and that was a really big deal because, I think NFTs are really interesting because it's hard to monetize as a creator, especially if you do digital art. So I think like from that perspective, it's a really valuable tool. But I think that like we're just in this market environment where everything gets frothed up to an extreme level. And so right now we're in an NFT bubble. So it's not sustainable at current levels, in my opinion. Yeah.
I agree. And the thing that fascinates me so much about NFTs, and really I talk about this all the time on my TikTok with cryptocurrency as well, is the applications of the blockchain. Because personally, I've never been a collector. I never did the Pokemon cards or the baseball cards, but I feel like there is such a valuable application in the deed to my house or the registration of my car existing as a non-fungible token on the blockchain instead of a pink slip that I guarantee I'm going to lose by the time I sell my car. And so that for me is what is so exciting. But first I want to talk about scarcity. This is what you were just talking about with people being in our Zoom chat, because I think, and this is me being more opinionated than anything, we have moved away from this idea of unique ownership in the age of digitalization, where you can copy and paste. We were burning CDs, now we're just downloading the MP4 files as many times as we want. And so there is no idea of singular ownership. So do you feel that NFTs are the whiplash back from that trend? Are people seeking unique ownership? Or is it more that it's exciting for monetizing the digital creator world?
I think a lot of it is like, I think that we're entering some iteration of an ownership economy. Like, I think that you see it with decentralization, like people just want to own stuff. And I think like NFTs are sort of an example of that, because it's like, well, how can I own something that is in existence on the internet? Because the internet is so like it's not physical. And so what you're saying is like, it's hard to own that stuff because it is online. It's like in the cloud, right? So I think that people are trying to establish ownership over things, and NFTs are one example of that. But I also think I think we have like a really interesting sort of get rich quick mindset. So I think that's more so what's happening with NFTs. Like right now, short term, I think long term it is more ownership economy, but short term, I just think that you have so many people who are interested in trade in like what this is all about, right? Like day trading. How do I make money as quickly as possible? And I think NFTs, like people are flipping them. Like how do you flip art?
Right.
Whatever it is. And like I think like the long-term applications, like people are saying in the chat, like that's super valuable. But right now it's like, how can I make as much money as possible in as short of time as possible?
Right.
And that's unsustainable.
Which in my brain and my heart, in a way, devalues the art that's being bought. Because so much, especially with that Beeple piece, the one that went for $69 million, it's an incredible piece. It's not a Mona Lisa necessarily, but it stands in my brain on that same level. And so for me, that's something that is a piece of our culture as internet participants. And so I hope that that's not being flipped, I guess, is how I would feel.
Well, people actually, he took the money that he got from that and put it into USD. So he took it off like out of Ethereum and put it into USD because he was like, NFTs are a bubble. So it's like a creator who made all this money is also like feeling that sentiment. I think that that's like a really big signal. And I think to your point, like, is it devaluing the art? I mean, I think to the point of scarcity, it's, every time I talk to somebody about NFTs, they're like, I can just take a screenshot of this. So I think like that's a big sticking point with NFTs is like, there isn't that concept of scarcity yet. So I think that in order for it to scale, you'd have to figure out how to either convince people that you can't like take a screenshot of it, that you do have ownership, or you're going to have to like control the screenshotting somehow, some way. Yeah.
Of course. And that pointer is nice, but it's not going to stop the copy and paste. So now we're on this topic of blockchain and this idea that is in my brain where all of this started, because we have cryptocurrency on the blockchain and then we have NFTs now on the blockchain. So can you first quickly just tell us what the blockchain is? And then also, which of these three things that I just named, which do you think is the most important in the future of humans transacting, is how I would describe it?
Yeah, I mean, I think with the future of transactions, like I did a TikTok on CBDCs 2 days ago, and sort of like how the Fed is thinking about cryptocurrency, in like they're not planning to move on it very quickly, which I think is really interesting. Because like you have other countries that are moving really quickly on creating their own digital currency, but like for whatever reason, the Fed is like, no, we're not going to do that. Like the Bahamas has a sand dollar, and you see like other countries sort of leaning more into like the blockchain and sort of executing on that. Like China's doing a really good job, UAE is doing a really good job. But for whatever reason, like Western countries, I think are a little bit behind. So with the future of transaction, like I think it'd be really interesting to see the US dollar, like if that stays as the reserve currency, like if China does execute on, their CBDC, however that ends up working out, like will you see the US dollar not, and like what implications will that have, right? Yeah.
Because in order to release a currency, a digital currency, in a way they have to cannibalize the one that they have built so much power on, because the USD, especially for the United States, doesn't necessarily represent our own money, but more our international power, the fact that we're the reserve currency of the world. And so there was actually a chat that popped up saying they don't want to devalue the USD.
The debt, the debt levels.
And I think that is why that might explain to some extent why we're so far behind, is because we're like, we have this power that we're used as the reserve currency that no one else necessarily has. And so we want to keep that as long as possible. And it would be very hard for us to create the central bank digital currency, the CBDC that you mentioned, and just immediately switch it out for USD and maintain our point of power. Do you think that is possible? Or do you think we could see an upset soon where we see a new reserve currency?
Oh man, I'm not sure. I mean, I think like what the chat is saying, like, you know, they don't want to devalue the DSD or USD. I think that's important, and that's why they're moving slow. Is like there's this weird relationship between like the Fed and the Treasury, right? Like if the Fed raises interest rates, like you all were probably talking about yield curve, like the Treasury is going, like that debt, that interest payment that they have on this debt is going to increase. So I think like with the USD, they keep on saying that inflation is transient, that it's not real, but like you do see like the deterioration of the dollar. So I think with CBDCs, it's going to create a lot more transparency, both in the people who use them. So like if we start using CBDCs, the government's going to know like every transaction that we do. They already kind of know, but like that's going to be a lot more transparent. Right. And then for them, it's going to have to be a lot more transparent as well. Like what they're doing with inflating the money supply, I think it'd be a little bit more apparent if there was a CBDC involved with that.
Absolutely. I totally agree. So I guess, well, first, what is the name of your website? The one that you write.
Yeah. So I have a Substack, and then I have kylascanlon.com. So my first and last name.com. And then my Substack is just Kyla. So my first name.substack.com.
Okay. I spent a solid 2 hours on kylascanlon.com reading.
Nice.
For any of you 104 people sitting in the participants list, please go read her website, because I think that you do such an incredible job. And are you 23?
Yes. Yeah.
Yeah. So I'm 22. The idea of having a very, very sophisticated young person who has dedicated themselves to learning about all of these things makes me really happy, because I'm in good company. And so I really want to share that with as many people as possible. And a few of the things, well, first, what are you most excited to write about coming up?
Oh, yeah. Well, so for the past 2 years, I was sort of, rightly so, constricted on what I could write about publicly. And that was kind of hard for me because I love writing. And so now I can sort of write about whatever I'd like. And so I just published a piece yesterday. It's not on my main website. It's on my Substack. I have to transfer it over. But it was about like the stock market. So like the meme markets and sort of how like NFTs and SPACs and GameStop and ARK Invest and like the Tesla effect, how they're all combining into like the memification of the stock market.
Absolutely.
So that was a really fun piece to write. And then I'm really into like gaming companies. So I'm working on a piece about Epic. I love video game companies. I think they're fascinating, like kind of that, how do they integrate with the blockchain? So thinking about them like on a very expansive level. I did a piece on Roblox and sort of just, I'm going to continue working in that space. I love company analysis. So I'm going to, just do a lot of like company stuff, a lot of macro pieces.
Yours on Roblox was incredible. And for me, I'm an avid video gamer myself. And so I totally agree with the analysis of video game companies. And I'm curious to know, because one of the things that I've become obsessed with, and we have it somewhere, we brought one of them, I don't know where it went, but we have an Oculus.
Oh, cool.
And VR is, for me, the future. I read Ready Player One back in like late 2000s, I guess. And so tell me a little bit more about how that plays a role in your video game analysis. Here it is. We got it.
Oh, cool.
Right here. Yeah. Which sucks because I'm not a fan of Facebook, but I want the Oculus.
Yeah, Facebook is scary.
Yeah.
No. I'm like super bullish on the metaverse, and I think that Roblox is positioned really well to kind of expand on that space. So how do you like combine AR, VR, and sort of have people exist within the internet, right? And like these virtual, physical realities.
Right.
So that's like what I think that. So I like. A lot of people like there were so many articles that were like Roblox is a kids gaming company, and it's like it's literally so much more than that. People are not seeing like the bigger picture. Like it's the metaverse, and sort of like a call option on that. So yeah, that's. I think that we're like kind of at a fork in the road, and the pandemic has accelerated that. I think that we're either going to enter a world where we don't want to be online at all. It's going to be very physical, especially like post-vaccination stuff. Or we're going to like really lean into virtual reality. And that'll depend on like what happens with the climate too. Like, I just think that there's going to like the next 10 to 15 years are going to be super important in determining like what happens with our physical reality in space. And I think the metaverse is one option.
Well, the idea of us, whether or not being outside or being inside digitally is more attractive. And so you mentioned two really important things, which is the degradation of our outside world and then the improvement of the digital world. And I've done a lot of thinking about this because we're impact investors. That's the center of our mission. And so with the things that we choose to invest in, there's a part of me that says, I want to invest in VR companies because I am incredibly bullish on that technology. But at the same time, my investors' money is incentivizing essentially a coping mechanism with degrading our physical reality. Because if I can flee into this, if I can put this on and not care about what's going on inside my window, then that increases the incentives to just make, pollute.
Yeah.
And I'm curious to know, what do you think about that? And this is some higher level approach to investing stuff. Do you think that when an investor like the people who are with us today, when they buy a company, does that type of granular question matter? Or do you think that the investment of a single stock doesn't really matter in the big term?
Yeah, I mean, so I consider myself an impact investor as well. And I think that your money is really important, and like the companies that you choose to invest in are really important. And that was kind of like, I like GameStop, and I think like what happened there was broader, like more, it was more than like an investment, right? But I think that the money that was in GameStop or went that way could have been utilized in a much more efficient manner. So I think like where you invest really does matter, and sort of like how you think about your investments. And that's like one thing that I think is being missed out on right now, because it's like, this get rich quick stuff. So I think like, yeah, your money matters. And in terms of like our physical reality, like I really like community spaces. Like I'm from Kentucky, and sort of like, how do you reinvest in your community? How do you rebuild it? How do you make it a place where people want to go? And right now I'm in Los Angeles. And so like really different spaces and really different realities. So I think that, yeah, I mean, I think that we have to sort of invest in the world around us, or we're going to end up like as Wall-E. If you've seen that movie, like, I think all the time, like we're going to be like floating in outer space because Earth is burning. And that's like a super extreme example, but I think that could be something that does happen if we don't think about the environment more critically.
Absolutely. And that is something that I struggle with. So my mom owns a company that makes it possible for you to never accept a piece of single-use plastic again. It's kits of forks and napkins and all the little things that you don't think that you consume. And so we actually sit on different ends of this spectrum of how do we have an impact as humans? Because for me, I'm on the investing side. I'm like, I get to vote on these companies. I get to tell their management team what I think they should do. I obviously have more power. And she's like, no, I'm speaking with my actions. And I'm making it very clear that my usage is going to reflect the way I feel about the environment. And neither of us are like, it's one or the other. I totally think you should do both at all times. Yeah. But for me, I think that it's equally important to invest the way your values align as it is to operate the way your values align. So I'm curious, because you said you're from Kentucky and moved to LA. I think in LA, being environmentally friendly, so the metal straws, things like that, are very, very in fashion in LA. And not necessarily, at least from my experience, as in fashion in the rest of the world. So what do you see in terms of the difference between your experience in Kentucky and in LA? Do you think it makes a difference in terms of overall waste?
Yeah, I mean, so like I don't drive, like that's sort of like my commitment to the environment. Okay. It's like my small thing. So I bike, and in LA, like there's, it's kind of dangerous, but like there's at least bike lanes. And like in Kentucky, because it's more spread out, and like where I was from, like it's a little bit harder to get around by bike, and there's not solid public transportation. So I think it's just like little things like that. Like you can have, like, what if we rethought how public transportation works, and we had less cars? Like I think that would be a huge step in the right direction. Not just EVs, but like less cars in general. Absolutely. And like thinking about public transportation, because I think like if you can rebuild cities to have like solid public transportation, to have them more community focused. Like people need to care about the place that they live. And I think with Los Angeles, people do care about it. With Kentucky, people do care about it. But like, if you have a solid infrastructure, you're going to care about it a lot more because you're more invested in the world around you. Like it's more beautiful to live in, right? So I think that's a big deal. Yeah. And with Kentucky, like in coal mining and stuff, like there's just a lot of remnants of that sort of mindset. And I think like the hard part about climate change is it's so abstract. Like we don't really see the day-to-day impacts so much. And if it's like a little bit warmer one day, it's like, oh, that's great, it's warmer. And so I think it's hard to think about it and to realize that it is happening because it happens at this very like granular level, as you were kind of saying.
No one's going to believe I didn't give you a script because it worked perfectly. The reason I took you from NFTs all the way into this sustainability tangent is because of this idea of abstraction. Because just like technology, just like the way we interact with the internet, there is no sense of tangible ownership of our not just our economy, but our environment and all of those different esoteric things that we're obviously concerned about. I think we're on the same page where there is this concern, but there is no ownership. And so there has been a little bit of a foray into this world with the idea of carbon credits, where you can purchase this fungible thing that allows you to offset your carbon emissions and allows you to be net zero. But run with me on this because this is sort of tinfoil hat idea. But what if we could create some sort of ownership through NFTs where you could own or purchase trees, or trees is a terrible example. I don't know why that was the first thing that came to my mind.
No, I understand what you're saying. Yeah.
But buying ownership in a sustainability project or a tree planting project, something like that. Do you think, and I want this from the chat as well, is that something that you guys would be interested in? Saying that I own part of this sustainability project and it's an NFT?
I mean, from my perspective, I think that's so like you can offset your NFTs and it's like super expensive to do so. I think that's so interesting. And I was reading this article that was talking about like, how do we build out nonprofits? How do you like create more like ROI within a nonprofit investment? And so I think that kind of ties into what you're saying, like, how do we actually sort of evolve this clean tech investment thesis into something that's like really attractive to investors? And I think like what you're saying, so like monetizing the physical, right? So how do you like monetize trees? I think like one thing that you could do is like you could issue bonds or something like that on like on physical spaces. So like you can invest in sidewalks, right? Like there's people who buy highways and they take care of that highway. So I think you have an opportunity to do that with like physical spaces too. I think it's really interesting, the idea of like NFTing it. That would take NFTs in a totally different direction, which I think would be interesting. But yeah, no, totally.
And then we run into this, again, it's never easy, but NFTs and the blockchain being so energy intensive. So suddenly we're trading these things that involve so many emissions, but that's a whole other tangent. Did you hear, you mentioned bonds. Did you hear about the $45 million bond that was just issued on the lives of the remaining rhinos in Africa?
Oh, wow.
And
oh my
the money,
gosh.
$45 million, it's used to fund the monitoring of poachers. And so you can actually own that, and ROI is the ROI, like the return is variable. I didn't read too much into it, but it's based on the population change of these rhino populations.
Yeah.
And so as the project is more successful, you as an investor receive a higher return on investment for owning that bond. I haven't looked into the actual mechanics or the plumbing of it, but I thought it was such a cool premise.
Yeah, I think that's great. And bonds get a lot of hate, and I think that they can be utilized in a much more efficient way than we do them now, especially if we could get like right now, it's sort of, you have to be institutional to like really, really get access to them. Like I used to sit on a high yield trading desk. So I saw bonds, saw corporate bonds, saw the structure. And I think that and maybe somebody's doing this and I just don't know enough about it, but like if we could, like doing a $45 million bond on rhinos, like that's a great way to impact invest and sort of like, and yeah, I mean, that's incredible. I think that's amazing.
Absolutely. And we were talking about that earlier, that because really you need at minimum a $25,000 lot size to get good pricing on buying individual bonds. And so it's so inaccessible for smaller investors, especially the people that we talk to over TikTok and things like that. So I wonder if that's an area for disruption. Yeah, I'm close. I wonder if that's an area where providing access would be a really positive thing. I think we just hit time. What's your schedule like? Do you have an extra 5 minutes?
Yeah, I have 5 minutes. I do have to hop like right around, I don't know what time zone you're in, but like 10-ish. Yeah, but I can stay on for a little bit. If
you're up for it, this is totally up to you, but I was wondering if you'd be willing to answer a couple of questions from the people here, from the chat. Yeah. Okay, you guys have, as she said, 5 minutes. So drop any questions that you might have for her in here. Let's see. I have chat. Where's Q&A? Here's Q&A. Put them in the Q&A, please, if you guys can. Let's see. And let's see what other people. So Victor wants your input in working on the high yield trading desk. Victor, can you elaborate a little bit? And in the meantime, Kyla, can you just tell us a little bit more about what that looked like?
Yeah. So I was not a trader. I just sat there and sort of like helped and stuff. Being a trader was something like that takes a little bit more training than what I had. But yeah, I would just sort of like learn about the bonds, like see stuff that crossed the desk, spend a lot of time like thinking about the structure of bonds. And when I was there, it was pre-pandemic. So it was a really interesting time. And then I was also kind of there like when the corporate bond market pretty much crashed at the beginning of the pandemic. So saw like yields just shoot through the roof. Spent a lot of time like thinking about CDS, which are credit default swaps. So thinking about like how do you hedge in the corporate space. So yeah, did a lot of like just research in that space. I didn't trade myself.
Right. Okay. And then Alex asked, so what made you leave your old job? Was it moving into a new opportunity, or was there something else?
Yeah, so like what I'm doing with On Deck is kind of my dream. Like I really love education, really love community, and the opportunity to build something was just, and like On Deck is amazing, was just like something I couldn't pass up. I really love Capital Group. I really love I love like the path I was on was great. But for this, I was like, I have to like lean into this new opportunity. I want to work at a startup for a little bit and sort of build something. So that was a big change, because like with traditional asset management, it's just a little bit slower. There's not as much dynamicness. However you'd say that.
I don't know the word.
Yeah, it was like a dynamism of it. So it wasn't as dynamic. And like with startup environment, you can just move as fast as you want, which I think is amazing. So
right. And then Aramis, this is selfish for me as much as anything, but they brought up a really good question. If you had a book that you could recommend, what would it be?
Yeah, I mean, so I've been thinking about this boat that's stuck in the Suez Canal, and I think
we were talking about that today. It's insane.
But I think so. Black Swan, that book, I think is just like that's so important right now. Like thinking about a boat that gets stuck. Like, how do you prepare your portfolio for that? That's a Black Swan event. Like at the end of the day, that's what that was. It is. I think it's still stuck. So yeah, Black Swan. That would be the book I'd recommend.
Okay, awesome. And then Thomas, are you interested in learning about how she got her job in the financial field? Is that what the question is? Oh, I need to make sure that we plug your TikTok again, because we have a few new people in here. So I'll drop it in here so everyone can go do that. And then let's see. Okay, so yeah, Thomas wants to know, how did you get your job, and just sort of what did you do in school to lead up to a job like that? Because Capital Group is obviously huge.
Yeah. So I've been doing finance online for a while. So I used to write for Seeking Alpha. I had a little podcast. I've just been like always writing about companies, always writing about macro. Used to trade options. I've been trading since I was 17. And so like for me, I kind of had this living portfolio online because I went to Western Kentucky University, so nobody was recruiting me.
Not exactly.
Yeah, it's a great school. Love it. But yeah, nobody cared about me. So like I had this living portfolio online of my writing, and so I was able to get like a pretty cool job at Capital Group just through being very present on the internet and like you know, they could look at my writing and be like, oh, she does, you know, she knows what she's talking about. It doesn't quite matter that she didn't go to Harvard. So yeah, and it's hard, like Harvard is too expensive, you know? So like that's, yeah, I've got a lot of thoughts on education.
And you said it really well, because that's how I got my first job as well, was by having something to deliver. So I wrote an analyst report on Lockheed Martin. This was before I was deep in impact investing.
Yeah.
But to do a full company analysis from top to bottom as an analyst would write, they were like, yeah, that's an immediate ad.
Absolutely.
And so I think your approach of having a website and having something that you contribute to constantly, because I'm sure every single person joining us today has these thoughts and opinions and does these little micro analyses on the stock market just out of their own curiosity. And so the fact that you record that, I think, is a huge edge. And I think that that's going to play a role for any of you guys who are watching. If you're looking to get a job, being able to show that you do it, not that you think about it, not that you consider it, but that you actually do it, that is what employers really, really look for. Okay. I won't take up any more of your time, but this was an absolute joy. Thank you so much for coming on.
Yeah. Thanks so much for having me. And if anybody has any more questions, I'm on TikTok, and I think my website has my email, so just feel free to email me too. So,
yeah. Please go get in touch with her. Her TikTok is kai.now. I just put it in the chat. Her website is kylascanlon.com, and then her Substack is kyla.substack.com, right?
Yes. Yeah, absolutely.
And so go read all of the things. She's doing incredible work. Make sure that you follow her. And
yeah, and I'm on Twitter. I'm on Twitter too.
What's your Twitter?
That's another way. Kyla Scan.
Okay, perfect. Then next time we do this, I would love to have you on again. Hopefully then it will be live. We're down in Laguna Beach, so it's totally possible for us to be nearby. Awesome. And with that, have a great rest of your day. Thank you so much for coming.
Thanks, everyone.
Awesome. All right, guys, what did you think? What are the thoughts in the chat? I'm fanboying, of course, because she's awesome. She's way smarter than me. Ooh, a sample template of the full company analysis. Dude, it's on my link tree. I think it's still there. Let me double check. Oh, there are still 23 of you. I'm so sorry. You only got to hear me talk. We recorded all of it. I'm gonna see if I can if she will let me post it, because that was probably the coolest guest speaker I've talked to in a while. Anyways, we're going to take a 10-minute break. So I'm going to shut down this live and go charge my phone really quickly. We're going to come back at 10:15. We'll see you guys soon. This is the Vegas stream. We're here. We're in Vegas. This is it. Are you talking about the roulette table? Like when we go? No, never mind. All right. We'll talk soon. Bye. Oh my gosh. I said bye and now I can't exit. How do I exit? Let's see.
How are we looking?
Good. I'm trying to leave the heckin'.
So many people on TikTok
and
like, what's going on?
Good. That was the point.
That's for you.
Oh, thank you. I needed something. Okay. Her Twitter was at Kyla Scan. It was Kyla Scan.
Scan.
Like that.
Okay.
Let's see.
Did we turn off TikTok?
I just turned off TikTok.
Okay.
I'm gonna fire it back up, but I need to pee. Let's see. Okay. I was going to check my link tree to see if I still have my analyst report up, because I think that's something that you guys might like to read, which I don't know why it's terrible. I was 18 when I wrote it.
Yeah.
Oh, it was trash. Absolute trash. Okay. It's not. Let me go. I'm going to share my screen. I'll show you guys the actual analyst report, and then I'll put it back in the link tree so that you guys can have it.
Tim, do you have anything you want to share?
No, let's take a 10-minute break.
Yeah, definitely a quick break. I will show you guys this. Let's see if I can find it. Oh my gosh, I have to go back to my college.
Oh my gosh.
Files. Goodness. Let's see. That would have been at college.
Glad to be back.
In 2019. Oh God, I don't remember.
When did you graduate again?
2020.
There you go.
No, but I was a sophomore. Oh my gosh, I forgot that I did the Joel Stern class. That's another thing you guys might be interested in. Let's see.
Chapman University, for those of you asking. It's a school in Orange County.
that's where we met.
Yeah, dude. We
Yeah.
freshman, sophomore, and junior year, Cal was there, and then Cal transferred to Boulder. Here we
Yes,
are.
sir.
Oh, you guys are in luck. I managed to find it. Didn't think that was gonna happen.
You're gonna keep Zoom open?
Yeah, we'll keep Zoom running just so that people can fill it with questions and stuff like that, and then we'll come back in 10 minutes. Let's see, share. Here you guys are. Okay, so this is, God, it's embarrassing to go back to this, but this is the analyst report that I created for Lockheed Martin on the 7th of December, 2018. So I did a price target. We can dig into the price target later because I used a couple of different models to get there. This is just the overview page and then revenue drivers. So a couple of the different components of their product line that I thought were really, really important. Business overview. So what they do, breaking it into each of their different sectors, I would call it. So they do space, aeronautics, rotary and mission. So this is helicopters pretty much. And then missiles and fire control, blowing things up. As you can see, this is long before I got into impact investing. And so then I break down the industry overview that they participate in and then analyze their competitive positioning within the industry. And then I actually issued a buy recommendation. I think it blew through my price target in 1 year, which was cool. Some reasons to buy, some relevant risks to consider, and then just a massive index talking about the models that I actually ran. So I'm going to put this back on my link tree real quick because I think you guys deserve to have this, and I put it up on.
Yeah, someone just asked if you could post it.
Yeah, I got you guys.
And they're asking, is this a pre-established template or did you make this yourself?
No, I made it from scratch.
Yeah, sounds about right.
Log into my Linktree account. Let's see if it's still here. Yeah, okay. I just turned it back on, guys. It should be at the bottom of the Linktree. So if you go to TikTok or something like that, and you hit Linktree and you scroll down to the bottom, it should say LMT analyst report for you guys. All right, got the break.
Go for it. So we got one really good question. How was the Series 65? It was interesting. Personally, I had to set aside a lot of time in order to kind of focus on that. And for those of you, nice. Congrats. For those of you wondering, the Series 65 is basically the test that you got to take in order to become a registered investment advisor representative. And I'm 23 years old. And my story is that I went to Chapman for about 3 years, and I was majoring in strategic and corporate communication and minoring in business. And I don't know what it was, but I wasn't exactly having the best time there. And I enjoyed my major, but there were like some things that I felt were missing, more or less. And Nate, who was one of my best friends there, is from Colorado, and so was my roommate. And so just looking at schools in Colorado, came across Boulder, and while I was studying abroad, decided to apply and transfer there. While I was abroad in Madrid, interesting enough, and
Hold on.
wound up. What are you looking at?
We might have the speaker down.
You don't have this. You don't need a
Can
sponsor.
you guys hear us?
I think they can hear us. Yeah.
Why does it say my speaker is not working properly?
Can you guys hear us?
Oh, that's because I put my AirPods in.
Yeah, they can hear us.
Yeah, they can hear us. It's that we can no longer hear that.
So what I did is I wound up transferring to Boulder, and I studied communication and minor in media production. And that's definitely not as impressive on a resume, but I enjoy it a lot more. It's a great school. I highly recommend just, going to Boulder or Colorado whenever you get the chance. It's a beautiful place. And I wound up getting through my 4th year there. I'm currently in my 5th year. And at the end, the second semester of my 4th year, I realized that I really wanted to get into marketing and advertising, which is awful timing. And Nate came to me. He was like, look, I want to start a company. And basically last summer, and this is right as COVID hit, we decided to more or less start Hoskin Capital, and we started from the ground up. And sooner or later, we realized that I can't really talk to clients until I passed my Series 65. I can't like go out and actually gather clients or do marketing. And so starting in September of last year, I started studying for the Series 65. And just this past week, did you shock yourself again? This guy's been walking around shocking everyone and himself.
For any of you who don't know, I have an absolute phobia of being shocked. And I swear, everything in this entire place is trying to shock
Are we both wearing black shirts?
My computer just got me.
Oh my god.
Yeah, let's do a counter. How many shirts am I going to sweat through today? We got one. We got one.
But yeah, just to finish up, studying communication, going into advertising, just passed the Series 65 for investment advisor representation.
Yes.
I'm all over the place. But
are you just talking about?
I'm just
talking about
people
your
were asking
experience?
about the Series 65 and stuff like that.
Oh, dude.
Yeah.
You don't need a sponsor. The Series 65 doesn't mean jack unless you actually put it at a registered investment advisor. So I would say don't go take it until you have a job. But what you should go take is the SIE, the Securities Industry Essentials.
SIE.
Yeah.
Okay.
It's now required as a prereq for the Series 6 and the Series 7. And you can take it without a sponsor and it looks great on a resume.
Yeah. So that's basically just what I've been doing. And he took his CFP the same week that I took my Series 65. He took it on Monday. I took mine on Friday. And
as far as I know, I'm the youngest person to pass.
And
way too proud of that.
Yeah, we both got through it. We both passed, and we're here in Vegas to tell you about it.
Yeah,
and,
celebrate a little bit.
Yeah.
What a great excuse. Like I get to talk about what I love for an entire day.
Yeah.
And then I get to do so in Vegas. What's up?
You still live?
Yeah, we're live.
We're taking a 10-minute break.
We are. We're not talking about anything useful.
We're just talking. Yeah. We're gonna.
Exactly. It's all wasted time. So it's either a break with me sitting here eating an orange, or it's a break with me not in the frame. So
yeah. We had someone say earlier.
Coffee.
Cal is slacking on the coffee mugs. What's up? Yeah, I have one too. Much required.
We had someone say earlier we should start a podcast. Like, how dope would that be? You know, especially after college. Yes. Oh my gosh.
I would do it, honestly.
Yeah.
You mean people are actually interested to hear me talk?
Dude, it blows my mind that we still have 90 people in here, you know, and we're just talking.
Yeah, that's because you guys are awesome. Are you kidding? I love the fact that we have people who actually care about stuff like this. That's something that I never expected. So I'm guessing most of you guys found me on TikTok.
Right.
I started TikTok January 1st. So we're well over 1,000 followers a day, which is sick.
Sick.
And when I started it, I told my brother, I was like, I want to hit 1,000 followers by June. That's what my expectation was, because I thought we were talking about more. Oh, hi, Catherine. Oh my goodness. I didn't know you were in here. That's amazing. Catherine Fontaine, everyone, went to Chapman with me. Were you?
What?
Are you in residency? Are you still in residency?
No.
Nope. I figured. That's fine. That's the other Catherine that I was thinking of. I wonder if
Chapman gang. What's up?
Get Chapman. Maybe I'll text Nick and have him come on as well.
Gosh.
One of the things that people usually don't believe when I tell them is the fact that
she was in residency,
but
she got out because of COVID.
Okay, good. I thought I was just trying not to be rude here.
Stanley. All right, be real with me. I have a 2.91 GPA right now. Next semester it will be, well, what year are you?
It better be 3.2.
It better be 3.2.
But yeah, 3, like if you're above a 3, you're fine. It's kind of it's a binary
sophomore
thing.
You're fine, dude. Just just bring it up before senior year. And really I would say most employers look at the grades that you get senior year as opposed to like your overall.
If you can show them a curve, like starting terrible and then rising up,
curve.
it's big.
Oh my gosh, my curve is insane.
Yeah, you went from C's to A's.
Last semester, I finished the semester with straight A's, which is mind-blowing for me. I've never even come close to that.
And study.
This goes to show the difference between Chapman and Boulder, maybe in academics, maybe in academics, but also like just in general, like when you find a place that works for you, the effort that you put in suddenly becomes effortless. And it wasn't like the material changed so much as I just had a greater overall experience. So complete side note, finding that sweet spot makes a big difference.
You're not screwed by any means.
Oh yeah, you're not screwed.
Like, yeah, if you sit at a 2.9 or a 3, that's totally fine.
Wow.
Do make something. As we were talking about, make an analyst report, write on a website, go read Kyla's website. That's the type of thing that an employer is really interested in. And then continue to get really good grades because you can. Like at every single moment, I was working full time and going to school. I was lucky to not have personal issues, and I totally understand what that can do to grades. But that said, get the grades you can get and then just move on from there. Like they're not going to care.
Yeah.
And I'm a year out of school now, and no one asks me what my GPA is. Doesn't matter.
I mean, who's going to ask you?
Exactly. I own the company. If they do, I fire them. So
what grades do you guys?
Should I talk about how I got my first job? Does anyone care?
I think they would love to hear that. Let's be honest. Everyone's going to be like, yeah. Because I feel like a lot of the comments you get on TikTok is like, how did you get to where you are? And that honestly is a really good question. You know, sometimes I still wonder.
So let's see, when I was 16, senior year of high school, I got a job at a tiny little boutique wealth advisory in Crested Butte, Colorado. That's where I'm from. And so it was called High Country Capital Management. And I was a coffee intern. I brought them coffee.
Coffee?
Coffee. Dude, if I have more coffee, we're going to go through another shirt. I didn't bring it up.
Another shirt. God.
Here,
we look like brothers. This is ridiculous.
I know. We're a little too
I swear I might have to change shirts. This is
just
too
need
much.
more tattoos. You'll get caught.
Yeah, okay. Yeah. I'm going to get a face tat that just says Hoskin Capital.
There you go, right on the forehead. So I worked for High Country Capital Management, which was fine. I just did it because I was curious and wanted to learn. I went and talked to the owner, and he would just tell me about the markets and things like that. Then I went to school. I went to Chapman sophomore year. No one really hires sophomores for internship roles because what they want to do is they want to move their internship class into their like a full-time position. That's the goal. And so sophomore year, I just sent out like 200 resumes and emails. I looked up every single different
They got us.
We got us.
We got them.
Diversity.
2 white dudes in black shirts.
Dude, I think about that a lot.
Yeah.
I'm like, I am a white male,
right,
preaching impact investing.
Right. Yeah. And it's just 2 white dudes talking about making an impact.
Yeah, talking about making an impact. Like I'm not the image of the financial industry that is broken as it is.
Well, I feel like the old white guy is the image.
It is, absolutely.
Yeah.
So the fact that I'm 22 adds some merit, but in my brain, I'm like, okay, I could be a white guy in traditional finance, continuing to propagate the standard quo, the status quo that we have.
Right.
Or I could do impact investing, and I can try to make a difference.
Well,
because I can't change this.
Yeah, but you can use it to.
But I can use it to my advantage, without a doubt.
Break the system.
Yeah.
Or whatever.
Anyways, I went to Chapman. Chapman was great. I had a great time. The reason I loved Chapman so much is because my professors were just incredibly rich people who got bored. They were like one of my favorite finance professors made like $40 million by the time he was 35.
Wow.
And then just retired.
What?
and was like, I'm bored, so I'm going to teach. And so I learned intro to finance from a guy
From a retired 40
from a
millionaire.
retired millionaire
Yeah.
who loved every second of what he was talking
Wow.
about. And that was what I wanted to do. Catherine knows exactly who I'm talking about.
Best professor ever.
Yeah. Don't tell Tim.
Don't tell Tim.
Did you hear my name?
No, we're just talking about great professors.
Yeah, we're talking about and then I got a job at Pacific Investment Research as a sophomore because I sent out all of those and one of them got back to me.
Yeah.
And I can we all connect on LinkedIn, Stanley? Absolutely. So after that, I went and worked for Pacific for 2 years, and they are a great little wealth management firm, very traditional wealth management, where they were working with premium finance clients. Like most of our clients had more than $5 million under management. And they pretty much, that was it. Like we managed rich people's money. We had like 100 clients, and that was what we did.
That would be a great motto. We manage rich people's
We manage
money.
rich people's money, exactly.
Wealth Management Company Incorporated.
And I started out as an investment management associate. I was just writing code. I learned AMI broker formula language, AFL, so that I could mess with our quantitative algorithms because that's what I was interested in.
What's the professor's name? You don't remember?
40-year-old professor, so we could go follow him. I don't want to say because I don't know if he wants me to.
Then don't say.
Maybe I'll check with him and next
Go
time.
attend Chapman University for a few years,
exactly.
and you'll find out. But yeah, that's
So-
really amazing.
Yeah, and then at Pacific Investment Research, we had our CFO or our CIO, sorry, Chief Investment Officer, just dip out when I was still an associate. So I had just gotten licensed. I had my 65. I was working on the quantitative algorithms alongside our CIO, and she just left. She was
This
like,
was during COVID, right?
this was right before COVID. So
Bro.
this was 2019. And they were like, oh, we need a new person to manage these strategies because we had 9 strategies going and they were all quantitative strategies. And so I ended up managing $100 million as a 21-year-old. And I think people misconstrue that. And I think I allow it to some extent because it adds to my credibility.
It's hilarious.
But
I mean,
they're quantitative algorithms. I wasn't picking the stocks. I wasn't there like, oh yeah, I like Apple, and I would buy $1 million of Apple or something like that. I just ran the quantitative algorithms and made sure that they worked, made sure that they were incorporating all of the data properly.
Right.
And then I was executing trades and making sure the trade execution, liquidity issues, all of that was handled. And so that was where I cut my teeth. But the reason I left is that I didn't want to just do traditional finance. I had learned early that I had potential, I could do something to really make a difference. And I didn't want to make that difference for millionaires. And so that's why we started Hoskin Capital at the end of the day, was that I now know how to do traditional wealth management. Tim knows how to do hedge fund institutional management. And then Cal knows how to tell our story in a really good way. And so we're going to make those services available to you guys. That's the whole goal. Like, you're our target market. You think you're here to learn, but we're here to sell you. No, I'm totally kidding.
and things are just going to pick up since we're both done with our tests. Starting
It's full time. Yeah.
Starting
absolutely.
next month. As soon as, well, I mean, right now.
Someone asked, there was a question that popped up earlier, that they were like, how many hours are you working nowadays? You don't want to know. We started a company. This does not come
Finishing
easy.
my last semester of school, studying for the Series 65, like working on Instagram and everything. I'm hitting at least 40 hours a week. That's something like that. I don't even
Just on Hoskin Capital, probably.
the Series 65. I was peaking.
I'm sitting at 100.
Yeah.
Pretty easily. Like I will wake up at 6 so that I can just like.
When are you? Oh my gosh! When are you launching the OnlyFans? Right now.
We use that to fund everything else.
Gosh, it's funny because like at the end of the day, we are. I mean, I still kind of consider you to be like in college. We are just two, like college kids, soon to be college graduates, and
I feel like that does give us an edge. And yeah, so laughing at the OnlyFans comment, but I feel like that does give us an edge in terms of looking at the big picture of investing and the market from a whole different standpoint.
Not to mention the fact that we have clients who have OnlyFans. How many wealth managers can say that?
Yeah.
That we are managing money that was made on OnlyFans and helping them do tax planning.
Can we say that?
Around? Yeah. I'm just not going to tell them who the client is.
Well, duh. It might be me. I mean,
it is.
It is. It is me.
It's actually me.
Hoskin Capital.
Hoskin Capital. OnlyFans to Apple stock.
Apple stock.
Exactly.
Oh
you guys.
This is why I like the Zoom webinar, because it's just like we're just talking about OnlyFans with like 100 people.
Yeah, exactly.
No problem. You know.
Someone said, let's see, where was it? Someone said favorite market movies.
Yeah, someone said Trading Places. That I think you went way too far.
There we are. Yeah, Stanley, favorite market finance movies. I have a bent against this. Why? Because all the time I see finance TikTokers and people like that, and just finance bros in general,
right? Just
worshiping the Wolf of Wall Street,
dude. Yeah,
I want you guys to think about something.
It's ridiculous.
This is important to me. I am convinced that 90% of stock bros have not seen the second half of that movie. If you look at all of the different clips that show up on TikTok, all the ones that are like the background image to people talking about their trading plays, it's the first 40 minutes of that movie.
Yeah.
The remaining hour is his life falling apart.
You mean the part where he becomes a drug addict, loses everything,
loses his house, loses his wife,
dies.
Loses his child, attempts to drive a yacht across into international waters so that he can like escape being prosecuted by the United States government.
Sorry.
I still never crashed my own.
Have you ever seen Margin Call? It's a pretty good movie. It's about the 2008 crash, and I haven't seen it in a while, but that's a pretty good movie. Just about one of the companies kind of dumping all of their assets right before everything just hits the fan.
Right.
So
was that Goldman dropping their CDOs on Lehman?
Maybe. But it's something like that.
Goldman killed Lehman. That's my assumption anyways.
The Big Short's a great one.
I love The Big Short.
Yeah, I love that movie.
Moneyball. Okay, I'm glad someone else mentioned Moneyball because it's not a direct stock reference. It's baseball, but right?
It is baseball.
Okay, good.
Yeah.
I was like,
Brad
I don't know sports, but I do know analytics.
And the
analytics were incredible there. That's just such a cool quantitative approach to a very qualitative problem, and I like that a lot.
Should we open up TikTok again?
Let's fire up TikTok.
Yeah.
I'm hydrated. I'm fed. So let's get.
Apparently, 86 people still want to talk to us.
Let's get everyone back in here.
Yeah.
And
what is next on the schedule? We got risk reward.
Yeah, we get to talk about. So everyone talks.
Is that a lesson?
Yeah.
Okay.
We'll talk about. Oh God, I have it all written out.
Okay, cool. I'm gonna start the camera so we can record it, so we actually have a better recording for you guys after the fact.
This one's important too.
Yeah.
Because this for me is like something that 90% of people miss.
Yeah.
When they're considering an investment because they're just thinking about the money they're gonna make.
Right.
The returns.
Right.
So might do a little bit of Excel, get hype, and then we'll go from there. Yeah, you want to fire up the camera?
Yeah, let's do it.
Let's see if we can fill this back to 100. What is it?
Instant.
10:30? Beautiful timing.
Okay, camera.
Let's see. Let's work.
Oh, you mentioned a Hummingbird project, by the way. It's the unknown high frequency trading movie. Hummingbird project.
Oh, I haven't seen it. We should watch that. We need to sesh some movies for sure.
Oh my gosh, yes.
All right, let's go live, shall we? Go live.
Okay, that's about right.
Let's see. Oh, I need to add why didn't it add a title for me? I want to add a title.
Okay. I can record anytime you're ready.
Is Instagram live the whole time?
Huh?
Instagram is already.
No, I took it down. There's only 4 people looking at it. Most of them already have TikTok too. Okay.
5 out of title. Here we go. VERITAS event. Risk reward, baby. Risk reward.
Reward streamed on TikTok or something like that. I don't know if you can make an announcement.
I don't know if I can either.
How do
that's
you?
Fine. They'll see that I'm live.
Yeah.
That part I'm not worried about. Ooh, Victor,
we can even put it
how
right
do you
there.
attract clients?
Yes.
So the main stuff that I do to attract clients is I talk to people that I know. That's kind of the most important part. Reach out to the people that I know that might be interested in investing. And then I also do a lot of inbound marketing stuff. That's Cal's strong point by far. But the big part of that is just telling the story of Hoskin Capital and trying to help people understand what's going on with what we do, because at the end of the day, we manage money. And so we need money to manage. And I've had a lot of clients I've had some come in from TikTok, which is fantastic. And then a lot from LinkedIn and a lot from referrals. Referrals are definitely where the main business is doing a good job for someone. They go tell their friends. That's how that has really played out.
So tell your friends, guys.
So tell your friends. Exactly. Let's see. What do you legally need to run your own hedge fund? You're going to need your 65. A hedge fund
It's a private company.
Yeah. So a hedge fund is quite a bit more litigated than anything else. To be a registered investment advisor, you need to have an ADV, you need to be filed with your state, and then you also need to be filed with the SEC. But to be a hedge fund, I believe you need to do a lot of additional disclosures, like your 13F. And so that's definitely challenging. I liked the recommendation that you could maybe make a student club. If you're in school, you should absolutely do that. Okay. For those of you who are watching on TikTok, we have 15 spots left on our Zoom session. That's going to be by far the best way to watch the VERITAS event. So I would say go join. If you go to hoskincapital.com/VERITAS, it'll say join now. Just click that. It will take you right to the webinar.
What's my computer at, by the way?
Your computer is at 52%. We're totally chilling. We are about to kick into one of our little mini studies. We're going to be talking about risk reward analysis in investing. So in the stocks that you might possibly be picking.
Yeah.
So let's clear this area a little bit so that I can flail my hands around a little bit. Okay. So I blocked it all, or can you see? You can see that camera as well.
Good, so people can watch later.
Yeah. Oh, more coffee.
That's my coffee.
Exactly.
Don't take my coffee.
Okay. So let's talk about risk in investing. So a lot of people and a lot of what we've talked about today has been understanding what a company does and how a company operates so that we can determine whether or not they're going to give us a good return, right? That's the most important part. So the next important part, the thing that needs to be considered is this company incredibly risky? And are we willing to take that sort of risk when we're making this investment? Because I think something that people fail to understand in investing is that outsized returns does not necessarily mean better returns. So we're going to talk about this idea called risk-adjusted returns. And risk-adjusted returns are, in my opinion, a much better way of evaluating a stock, especially historically, than just straight up pure total returns. So that's what we're going to talk about today. Before we talk about that, the big thing that I want to cover is this idea of risk, right? So in the chat, really quickly, can you guys let me? I'm loving the comments that stocks only go up. So tell me real quick, what are some investment risks? What's the first thing that you think of that pops into your head when I say, like, what is an investment risk? Because for me, I have 5 of them that immediately pop up. And I like, okay, cool. So we have a few good ones. So the first one is stocks go to zero. This is called capital risk. Capital risk is the idea that you put your money into something that could just disappear. Company goes bankrupt, you don't get any payout, then that is capital risk. That's the idea, the risk that your stock goes to zero. Then someone mentioned systematic risk. So this is the highest level separation of risks. There is something called systematic risk, and then there is another type of risk called unsystematic risk. For systematic, this is actually what you want. So you actually want to have systematic risk because this is what you get compensated for. Systematic risk is the risks associated with being involved in a market. So there are 5 of them. I'm going to see if I can name them without looking. There is purchasing power risk, reinvestment risk, interest rate risk, exchange rate risk, and market risk. It's prime is the way to remember that.
That was impressive. I will say that is impressive.
Thank you. So purchasing power risk is inflation, the risk that inflation is going to occur. Then reinvestment risk is the risk that, let's say you buy a bond. You buy a bond. Oh, you guys can't really see the chips, which is a shame. But you buy a bond and then it will pay you interest. So if you collect the interest, then you might take it and invest it in another bond. But the risk is that when you invest in this bond, interest rates have gone down. And so now this bond is yielding less than this bond. So that is reinvestment risk. Then you have interest rate risk, and these two go hand in hand. Interest rate risk is the risk of interest rates changing. This is what we're seeing in the stock market lately. The interest rate, especially the 10-year treasury, is increasing exponentially. And this is forcing down a lot of equities, specifically in growth sectors, so like tech. And so the interest rate risk is the risk that interest rates go up, the cost of borrowing goes up, which makes companies less able to be profitable. There is also the inverse side of that, which is that interest rates go down. And this is what I was talking about with reinvestment risk. So you can see that it's sort of a double-edged sword. Then we have market risk. Market risk is the risk that you take by participating in a stock market. So this market risk is going to be the risk of the stock market selling off. For instance, we are all participants in the market, right? We're all investors sitting here, and there are 100 of you in here. So if all of you decide to sell, even if I don't decide to sell, then my stock holding is going to go down. And so what this means is that the market risk is something that I cannot avoid. Then the last bit we have is exchange rate risk. So exchange rate is the idea that I take my American money, US dollars, and I exchange it for something like the Japanese yen or something like that. So the Japanese yen, you actually need, let's say it's 4 to 3 or something like that. And so the Japanese yen is currently less valuable than US dollars because these are worth the same amount. And so if I take my US dollars and I exchange it for Japanese yen, and I take this and I go invest in a Japanese company, and I hold it for a year, and I make 20% on that, then that's a great investment. But in order for me to then use that cash to go buy a new Mercedes or something like that, I need to transition back into US dollars. So what if, even though we made 20%, what if the Japanese yen also devalued by 10%? So this means that even though we made 20%, by the time we transition back to US dollars, we actually only made 10% instead of 20%. That is exchange rate risk. These are the 5 main systematic risk factors. Then we can talk about unsystematic risk. So unsystematic risk are risks associated with a specific company. You don't get paid for unsystematic risk. You should never have unsystematic risk in your portfolio. Well, I don't like the idea of never. There are certain times that you should have it involved, especially when you really like a company and you believe that that one is going to outperform. So you take a larger position in it. But the reason you don't get compensated for unsystematic risk is because you can get rid of it really, really easily. And the way you get rid of it is by diversifying. So if I have my chunk, right? If I have my chunk and then I invest some of it in one company and I invest some of it in another company, what I've done is I've diversified my risk, because we have the risk, the unsystematic risk associated with company A and the unsystematic risk associated with company B. And so it is in my best interest to diversify out into as many companies as I can. And this will reduce my unsystematic risk by as much as possible. This is why people buy index funds, because index funds only contain systematic risk. And so your hope is that you are so perfectly diversified because you bought the entire market that all of the risk you experience is systematic, and therefore it's all of the risk that you're being compensated for. The issue is that in doing so, you sort of guarantee mediocre returns. And guarantee is a terrible word to use in investing. You are not guaranteeing anything by buying an index fund. But it means that even if this company quadruples in value, it only contributed so much to your overall portfolio. What you might have preferred in that case is to invest all of it in this one company and reap the results on your entire portfolio. The issue is that there's a huge amount of risk associated with doing this, a huge amount of unsystematic risk. And so balancing the trade-off between the possibility of pure return and the diversifiable risk is one of the main factors in investment management. So it's a lot of what we do at Hoskin Capital, is asking how many companies are we going to diversify in? And so just for some info, most of our clients are usually in 80 to 100 equities, which is pretty high. We go pretty big on diversification because we try to capture themes instead of the performance of individual companies. So now we have an understanding of what risks exist, and let's see what we have. Okay, so everyone in the chat named all sorts of awesome risks. So let's talk about a few of them. So a lot of them are talking about regulations. So this is actually more likely industry specific risk. So for instance, let's say a company that makes computers has a law passed about how they build semiconductors or something like that. Then that legislation is going to affect all of the companies within that industry, but it might not affect any other industry. So then we have bad entry. So this is actually an interesting one. This is an investment risk that has to do with timing the market. So there's a chance that you get into a stock at a local maximum, and then it's going to go down from there. So that's called timing risk. Bankruptcy risk is always present. This is something that we talked about in our analysis earlier, making sure that the company that you're investing in, the probability of it going bankrupt is as low as humanly possible. Let's see. Yeah, then we have market risk, industry risk, company risk. Perfect. We talked about those. Black swan event. This is huge. This is what we were talking about with Kyla. The idea that you just can't plan for some things. There's no way that I, as an investment manager, could ever have planned for a boat getting stuck perpendicular in the Suez Canal a few days ago. Like, it just can't happen. Let's see what else. I think those were the main ones. So, okay. Now that we've talked about the main components of risk, we're going to talk about how to measure them. So the first one that I want to talk about is measuring how much systematic risk you have versus unsystematic risk that you have. So one of the ways that I tend to measure this is using a metric called R squared. R squared is technically a statistical measure. And what it does is it measures the amount of performance in your stock that is explained by the performance in an index. So for instance, you would take the R squared of Apple compared to the S&P 500, and the R squared of Apple to the S&P 500 is about 85%, I believe. It's a little higher now because Apple is such a large component of the S&P 500. And so what this means is that 85% of the performance in Apple is explained by the movement in the S&P 500. The other 15% is explained by other extraneous risks or unsystematic risks. Okay, what questions do we have? Okay, so R squared, you can usually find it. Let's see. So you can usually find R squared. I believe you can find it on Koifin. We will look into that together. So the way you measure R squared otherwise is you actually, I can show you how to calculate it, but it's really easy to do on Excel. So we'll do that. Why is Apple considered a growth stock considering its size? Apple is a growth stock because of its reinvestment in itself, really. That's the big component of Apple that classifies it as a growth stock, is the fact that they maintain a lot of their earnings in order to use it and reinvest it. Oh, Lawrence, we're going to talk about Sortino and Trainer. Don't worry. So, Lawrence, you also said we hold 10 to 15 stocks at any one time, attempting to be as efficient as possible. What are the benefits of going for a more broad 100 equity trend? So, the reason we stick around 100 is because it allows us to get near perfect sector allocation. So we have certain opinions on which sectors are going to perform. And so we size the risk by sector. And so if you have 100, you can then create your sector exposure essentially down to the 100th. That's our goal anyways, because we use fractional shares. Mitigating, no, I'm not going to do that right now. I'll talk about that. Don't worry. If R squared is, what is the risk calculation per sector? Victor, I'm not sure what you mean on that. Maybe go ahead and tell me a little bit more and I'll see if I can answer it. Okay. Analyze and predict what sectors are going to perform the best. That's why people pay me. Okay. So now we can talk about systematic risk first. So we talked about measuring how much of a stock's volatility is related to systematic risk versus unsystematic risk. Now let's talk about the systematic risk component. So this is where we use beta. And I'm sure quite a few of you are incredibly familiar with beta because you see it everywhere on all the different stock, like Yahoo Finance, for instance, always has beta. But I don't think many of you actually know what beta means. And it's a kind of a complicated thing to try to describe. So I'm going to pull you in and I want to try to describe it to you because if you can get it, hopefully other people will get it, but we'll see.
I got it for the Series 65.
That's true. You got it figured out.
But
so
in terms of having it completely understood,
give me just a primer. Like what is beta?
Beta is market risk, right?
Yeah.
And when it can be used in different ratios, such as Sharpe ratio.
Sharpe uses standard deviation, but
okay.
Trainer, yeah.
Trainer, okay, yeah. And from my understanding, it measures the type of risk that you're taking in for an investment.
Okay, so yeah, beta it measures a stock's sensitivity to systematic risk.
Okay.
So the way it's calculated is you take the covariance of the stock and the market,
okay,
and you divide it by the variance. And so what this does is it provides you a number that shows you how much the covariance is in relation to the variance of the market, right? Mm-hmm. And so what this gives you is this really nice number it can be negative, but usually it sits somewhere between 0 and 2. It can go further. I'm not saying that those are the limits on the statistical metric, but what happens is if the beta is 1.1 on stock, then what this is estimating is if the S&P 500 goes up 1%, then the stock is going to go up 1.1%.
Gotcha.
Right?
Uh-huh.
So that's the idea behind beta, but it only talks about systematic risk, right? So here's one that I think is going to stump all of you, and I'm curious to hear what you think. How do we know if beta is worth measuring? How do we know if the beta of a company means anything at all?
That's a really good question.
I feel like it really has to do with, well, one, the company, you know, and obviously what is going on at the time. Do we have any answers?
Anyone have any weigh in? It's okay. That one was designed to be really hard.
Back
So,
testing.
the way you can tell whether or not beta is worth measuring is by looking at the R squared of the stock. Because as I mentioned, the R squared is the systematic risk and the unsystematic risk, right? So let's say this is the, let's make sure everyone can see it, right?
Yeah.
You can see that. Okay. So let's say this is the systematic risk and this is the unsystematic risk, right?
Okay.
So the white is the R squared
Okay.
and the red is the error term.
Gotcha.
So if we have a beta of 1.1, what that metric automatically assumes is that it's all systematic risk.
Okay.
So it cannot incorporate unsystematic risk.
Right.
So if the R squared is tiny and the unsystematic risk or the error term is really large, then the beta is not a reliable metric because the stock is really unrelated to the market.
Okay.
So sure, it has a beta of like 1.1,
1.1, but it's accounting all the risk that isn't systematic.
which means that the unsystematic risk doesn't actually have any relationship to the market.
So it's the same amount of risk, but not really. It's like,
so it means that if the market goes up 1.1, this component of the risk within the stock is going to go up 1.1.
okay, gotcha.
We have no idea based on beta what this is going to do.
Okay. So you got to look deeper.
You got to look deeper.
Gotcha.
You have to dig in and you have to understand the total risk of the stock.
Okay.
Because as I mentioned, we have R squared, right? R squared is the little white piece down here. So how do we measure all of this? This is where we look at variance and standard deviation.
Gotcha.
So that's going to be our next risk metric. Does anyone have any questions? How can you tell how much the unsystematic risk affects the company? So this actually comes down to risk decomposition, which is a very complicated topic. But the general idea is that you can pretty easily back out the effect systematic risk has on a company, right? And so then you can look at the risk that's associated, and then you can go find other factor betas. Let's find it here. Let me grab
that green one right there.
Get in here. There we go. They were so tightly packed. So then this is just one beta.
Gotcha.
So we could have this, let's say this is the beta to the S&P 500 and this is the beta to IWM, the Russell 2000.
Okay.
And then this is the beta to the bond market, to let's say to the ag bond or something like that. So you can add multiple what are called factors and you can get an R squared that is much higher than if you were just using one beta.
So in a sense, creating a portfolio of beta.
Because the R squared, or sorry, the risk of the stock has to be explained by something, right?
Yeah.
So you just have to find the different components that explain it. And this is factor analysis, which I'm not going to dive into right now.
Sounds really cool though.
But let's see. Okay, cool. So
for those of you on TikTok, we also have we're up to 18 spots now. 18 spots on Zoom where you can hop in and ask us questions in regards to what we're talking about.
If you go to our website, hoskincapital.com/veritas, then that's where you'll be able to join the.
It's in the link tree, I'm pretty sure.
It's in the link tree.
Yeah, it's in the link tree.
Yeah, if you click, it's the top one. It just says Veritas event.
What should I do? Aren't you in what? The webinar is also going to be posted on YouTube afterwards, and we're going to have a link to that as well. So if you're missing or if you have missed or have to go, you can just watch all the best parts.
Try to put all of this on.
We're doing our best,
somewhere.
but it's going to work. You're going to get something out of it. But yeah.
We talked about systematic
cool,
risk, right? We talked about factor betas, things like that.
Standard deviation, we kind of touched on.
So now let's talk more about standard deviation and variance. So
Besides the fact that it was something that I learned in high school math.
Right. All of you guys have heard about standard deviation. If you were in even entry-level statistics, you heard about it.
But how does it apply to the stock market?
I love that. So the way that standard deviation applies to the stock market is because you can measure the volatility of the returns of a stock, right? So let's just break it out by day. Like Apple goes up 2%, down 1%, down 1%, up 2%, right?
Okay.
We can take that and plug it into the standard deviation calculation.
Right.
Right. And so this is how we would apply it to stocks.
Okay.
And we have the expert coming in as well. We're talking about variance and standard deviation in measuring risk. And so the standard deviation we can then use to figure out how much a stock is going to move in any direction. Right. And so
how much it's going to deviate.
Right, exactly. How much it's going to deviate from the mean.
Okay.
So we have the mean return. So for Apple, it would probably be slightly positive, right? Because it tends to trend up more than it has trended down.
Right.
So the mean return might be 0.1% or something like that. And then the standard deviation will probably be like 3%. I'm making these numbers up as I go. We'll measure them later. But what this means is that we can then look at standard deviation. We can figure out what is the probability that it's going to move a certain amount, right? Because I don't want to get into normal distributions just yet. So let's talk about what standard deviation.
Well, it also tells us
first.
Whether or not a stock might be good for a portfolio.
Right. Absolutely.
Yeah.
And it will also allow us to calculate the portfolio standard deviation as well. And so with standard deviation, what you're measuring is called total risk. So total risk is the total movement in the stock up or down on an average basis.
Gotcha.
Right.
Yeah. Right.
And so what we were talking about with R squared and what we were talking about with systematic and unsystematic risk, the standard deviation just measures everything. It measures the total risk of it. And so then we can get an understanding for how volatile the stock is.
Right.
And this is where we get into something really interesting. And if we're lucky, Tim will talk about this with us as well. I don't know what you're up to, but I want to talk about risk-adjusted returns. And I want to talk about why it's so important that we use this measure of variability in order to calculate risk-adjusted returns.
Right.
Because now we haven't even talked about returns in this section so far. We've only been talking about the risk of a stock.
Right.
So how do we use that to adjust our return expectations and pick a stock?
Right. Well, we would want to look at what risks we're taking on with a stock and then what systematic and unsystematic risks are inside of that risk.
Absolutely.
So if you got a bunch of systematic risk, or if you have a bunch of unsystematic risk and only a little bit of systematic risk, the amount of risk you're taking might not be worth it for that particular stock.
And so then what we can do with risk-adjusted returns is we can compare two stocks. Let's say one stock went up 100%,
right,
and one stock went up 50%. Stock A, you're like, oh, I'm going to pick stock A, went up 100%. That's the obvious choice.
Yeah.
But what if stock A was 10 times as risky as stock B?
So the next day it went down 200%.
Right. Tim, you want to weigh in?
Yeah.
All right, I'm gonna pop out real quick, and I'll let you have my spot.
Tim, teach us something.
You wanna? Okay, I'm gonna give you a break. Can you bring me a coffee though?
Yeah, of course. Is that cold?
Yeah, we have stuff some left.
So Tim, what do you think about risk-adjusted return?
Okay, first of all, because I was obviously listening, there's a lot coming up tomorrow, more details, especially risk decomposition and analysis. I'm not sure if you or Nate used the term CAPM model, because this whole
CAPM is my least favorite model, but it is on the list.
That's definitely on the list, because I want to make sure, I know a lot of questions, you guys coming in from all different angles. I want to make sure we keep some structure alive, because a lot of portfolio theory, financial theories behind this. To clarify, I think the last question you asked about was risk-adjusted
return. Yeah.
So there's a lot to it. And Nate brought up this example. There's a stock 150% up, 100% up. It's a clear choice. 150%, we all want to make more return, because then we can use the return and diversify, do something, enjoy life, whatever you want to do. Problem is, you don't know. So we always have to deal with uncertainty. It's not only applicable to the stock market, capital market, asset market, how you want to spread it. it's applicable to everything. So when you have different job offers, when you have different decisions to make, how you plan your day, if you're going to be on this TikTok channel, or I'm going to read out in the book, or go take an e-learning class, or just Netflix all day, the opportunity cost associated with it, I'm sure many of you covered in your econ classes, and there's certain uncertainty with it, how much you can learn from it, how much makes it happier, how much impact does it make on your life and somebody else's life.
Right.
So to kind of dial back to this point is, since there's uncertainty, we need to find a measure to quantify this idea of uncertainty. So risk is a very vague term, it depends a lot of your personal goals, depends on your model you're using, because you start off with yourself. When I say, okay, I think this stock is going to make 150% return, is okay, how do I come up with 150%? What factors did I include? And what assumptions did I make along the way? So we try to capture this idea of uncertainty, this risk, with those measures Nate mentioned volatility or standard deviation, variance, covariance, correlation, CAPM. So there's a lot to it. And I think some of you brought up option theory or options in general, tail risk. So the black swan event that Kylie brought up earlier is another whole new term that came up, especially during the dot-com crisis, 2000, 2008, and so on. And since I lived through all of them, I kind of experienced it myself, and how human behavior accelerated the whole process and really makes it even more difficult to predict. Because if you're the only one who says 150% is up, there might be others that disagree with you, agree with you. And the more people agree with you, the less risk is associated with it. This is why you always want to keep an eye on the market, but see what people think about it, because it's not just you acting in this environment. There's always the supply and demand.
And more recent example would be GameStop, right?
Yeah.
Because there is no, backing for that besides just human behavior.
Exactly. Because the company is not like they make a huge announcement and say like, we're going to go and do not gaming anymore. We're just going to go in entirely VR, or let's build some roads somewhere in a country, emerging country, and so on. So it's not the fundamentals did not change, but the human behavior, Reddit and other accounts are like, hey, let's do something with this. Let's increase demand. And since there's limited supply on stocks, it will affect the prices immediately. So to go back to the risk factors, because there's usually the first stepping stone in financial theory when you take those classes is volatility.
Right.
So volatility is a good measure because it measures the uncertainty around the stock or any asset classes, pretty much everything. It's, especially when you go into, for the accountants in here or marketing, there's the volatility around, okay, I think we're going to have 100 users today or 1,000 users. What if we have more? What if we have less? How do we deal with this? The same with the stock investment. Volatility measures the dispersion, the uncertainty around your expected value. And what can you do if this is realizing, thank you,
Of course,
on the up or downside?
Need the caffeine to stay that sharp.
So you might say, hey, this is not really a risk for me, because I think the stock is going to make 150% next week, or Bitcoin, which is probably more realistic to Bitcoin these days than to most stocks, to say 150% in a week. But if the stock realizes 200%, you might be happy, or you definitely will be happy, because you estimated this, 200% realizes, you're going to walk away with 200%, and then you can go move on to the next one, or stay invested. If you realize 100% or even lose 30%, then you really feel the risk part of it. So this is where you have to differentiate between your looking at your bank account and actually, I make more money than I expected I would be, which is great, or you losing money. But in both sides, you are at risk because your prediction is still wrong. So you estimate 150%, but 200 realizes, or 100% realizes, or even more. So in both cases, your prediction is wrong. So from a modeling perspective, you need to go back to your model and say, I made some mistakes. How can I adjust it so next time it will be more accurate? And this is the idea of standard deviation, risk-adjusted return, that your prediction is getting better and better. And you incorporate this risk factors, uncertainty of your model, uncertainty of the market, talked about systematic and unsystematic risk, and how can you improve our overall investment approach. So that's the idea. And it's, again, there are a lot of measures behind this, backing this up, because it heavily depends on the asset class, heavily depends on the sector you're working in. There's, I think some of you mentioned regulatory risk, there's sector risk in there. All those factors you need to anticipate in the model and model in. you might also deviate from the traditional measure of standard deviation, because the one problem with standard deviation, even though it's so popular in the market, is measuring the whole part of risk. But as Nate taught you earlier correctly, is what you should be concerned about is systematic risk, and volatility also measured the unsystematic risk. So if you want to decompose this, you want to talk about what is the beta behind it, and then you see certain measures popping up, like, for example, Sharpe ratio, which is probably something you've seen before, because you look at the expected return or return overall and divide it by the volatility. So this is a risk-adjusted measure to say, if I have 150% prediction for this one, but my risk associated with prediction is, let's say, just to keep the math simple, 150%. So it's a Sharpe ratio of 1. 150% divided by 150%, which is probably not reasonable when it comes to Bitcoin. So it's 1. And then you go into a second stock, and let's say I'm going to go into something more conservative, let's say McDonald's or something. Not saying, again, we're not giving any investment advice, very clear on that. And we're going to talk about education on the process, the thought process you might want to go through. And let's say McDonald's is 100% stock return expectation, the same time period, and so on. But I'm feeling more confident with my analysis because the company's been around for a while. So my risk volatility measure, let's say, is 50 only. So that puts me at the Sharpe ratio of 2. And this is something that many people underestimate, because everybody's so hyped about Bitcoin and, you know, I can make 200% in a day or a week or 2 weeks, but I also can lose 50%. If your prediction model is much better, I would rather go into McDonald's and say, I have a expected Sharpe ratio of 2. It's only 100%, but divided by 50% risk, because my model is better overall over the longer time period compared to Bitcoin. Because what I can do, I can go back, hopefully you have some, and I'm not sure how much you covered, leverage and so on. You have some tools out that allow you to increase the leverage of this, which overall leads to the same return, but to a much lower risk exposure.
And you want the least amount of risk for the most return that you can get.
Exactly. And at the end of the day, it's a really simple equation. So we can talk about, 3 days straight, probably without any prep, about risk measures and all the ways you can predict this.
Right.
But at the end of the day, it's very simple. That's your prediction. You need to be aware of this prediction comes with risk, uncertainty, assumptions. You try to quantify them by using certain tools, and then you invest in the one that comes out with the best ratio. And Sharpe ratio is 1, but there are easily 10 others. I'm not sure if you talk about Trainer or Sharpe Hero or others.
Them, but haven't talked about it.
So there are some others, because then they cover more onto, okay, what if we want to focus only on systematic risk? Or another measure could be semi-variance, because you say, I'm not really concerned about the upside. If I'm wrong on 200%, I'm fine with this. I only want to focus on the downside. So I'm going to take a different measure in the semi-variance, which focuses on the downside. You can also think about, because black swan events and tail risk was a topic for today, think about, I'm a long-term investor, which we should be. We're going to talk about details. Let's say you have an investment horizon of a year, 2 years, 5 years. Let's say you want to, I don't know, you start college, or you kind of want to save for your master program, or you want to save for a car, house, whatever it is, or retirement. Then you think long-term, and on the long-term, you want to make sure that you have a focus on systematic risk, and then you can use some tools like backtesting, for example, to measure this, to have a better grasp on those this risk measures overall. So I think there was a lot to cover. Maybe there's
I think you did a pretty good job of covering it, though. So let's take a relatively new investor, and they want to start investing. What would you recommend from a risk standpoint? Like, what would be the least risky but the most return for that risk would you recommend? I mean, and I understand that gets into like picking out specific stocks, but should they be looking at ETFs, individual stocks, portfolios?
How does constructing a portfolio change the risk profile of your investments?
Man, you allowed me not to use the whiteboard today, so let's see if we.
I know, we're on the shirts. I forgot about.
But yeah,
the
we're
shirts.
gonna just to keep it short, because we're gonna talk a lot about portfolio theory tomorrow, and kind of why you want to diversify your portfolio overall, and to kind of make sure you understand where we're coming from, because as a startup or as part of a startup, you have a very highly concentrated risk, which many people don't agree with. And this is my first advice, especially for early investors, is find something you really understand, you feel comfortable with.
Right.
Don't go into something like, oh, everybody's trading Bitcoin and other things. Like, you can make some quick money, don't get me wrong. You can also easily lose money. And I guarantee you, many of you will probably reach out and say, I made so much money, I know the market. And 6 weeks later, we're gonna have some conversation, lost everything, let's think about something else. Does not apply to everybody. There are always exceptions. I was an exception for a while until I realized, okay, my time is better spent because opportunity costs are higher on something more institutionalized and institutional level to provide value to my investors on the asset allocation side. So we're going to talk about alpha and portfolio theory in more general terms, or more specifics tomorrow.
That's Tim's really polite way of saying he made a lot of money for a lot of people.
Yeah, there was quite a good ride. Yeah. So yeah, going back to the advice is pick something you feel comfortable with.
Mm-hmm.
And because that allows you to minimize your risk and the assumptions you're making. So you invest in this field and maybe try to team with somebody up who's like, okay, I worked in the tech field for a while, so I'm feeling comfortable in investing in those stocks.
Right.
But I also understand tech is a high risk, usually a high beta stock. So they are volatile quite a bit, and maybe you want to find something that's more conservative. Let's say you want to go into, I brought up McDonald's earlier. You can also go, electric companies, obviously in impact investing, there's a different approach to it, and Nate can talk about this in more detail. But you want to team up, which you all do it, otherwise you would not be here. You want to team up with other people that have a similar mind, but a different experience in this field. And this brings us to this idea of stock selection. If you do a good job on stock selection, you can outperform the market, which is your ultimate idea. Because you talked about ETFs earlier. I'm not sure that's a common term for everybody here. Just to bring it up.
I would say it is.
If you don't have an experience, which for some of you, teenagers, 17, 18, 19, 20 years old, you have maybe read up on it, but you don't really have a good grasp on what's affecting the specific industry, then you want to go with something very diversified and use an ETF. And an ETF is exchange traded fund, low cost profile, diversified, and is focusing primarily on systematic risk. And maybe you want to start from this core portfolio and go into a field like, okay, let's pick some on the side, gain some experience, get more comfortable with the space before you go too aggressively in one.
And it's especially for new investors, there are a couple people in the chat right now talking about this. Don't trade on margin.
Don't trade on margin.
I think that is something that will become a tool down the road. But for anyone who is feeling like they're getting into investing, adding leverage can add a lot of financial risk just to you personally.
Yeah.
And for me, I think that it makes a lot of sense to stick with the cash that you have until you've developed a very good strategy and have executed it for a number of years.
And that includes just calls, shorts, puts, longs, like that type of investing is something that takes serious skill. And you see a lot of people, especially on TikTok, posting all these videos about how they made thousands or whatever, hundreds of thousands, just, putting shorts or puts and calls and all that stuff, leveraging different stocks. And they'll only show you a specific stock that did well. They won't show you the 10 other stocks that just plummeted their portfolio. And it's really funny because I feel like Nate does a pretty good job on TikTok of not kind of calling out a lot of people like that, I've
had some fun the last couple of days.
Okay. But in terms of getting your hands dirty with leverage, it definitely requires a lot of understanding. And I'm slowly understanding that I don't understand enough in order to get there.
What's the name of that? It's called, there's a curve where at the beginning, you feel
the
like
learning curve.
You feel like you know everything.
Oh, it's coding.
And then
just
you figure out how little you know.
Oh.
And slowly work your way back up.
Yeah.
Just Google the coding experience. You see this curve.
Yeah.
Absolutely.
But it's definitely really helpful once you understand it. And that's how most hedge funds, that is how hedge funds make all their money. It's by, I mean, I don't want to get into it, and this is your expertise.
Yeah, I'm going to talk about hedge funds, and I want to make sure we use the term right, because for me, just to introduce the topic for tomorrow, because there are going to be a lot of hedge fund managers.
Come tomorrow, it's going to be great.
Talking about this, and think about hedge fund managers first as entrepreneurs in this field.
Right.
It's really, they want to do something different. They see a niche in the market they can use. There are, again, different views on hedge fund managers. They're in a press for, bad things, for good things. They're usually smaller and much faster than many other in the market, because they don't have the same regulatory environment as we have as a wealth manager, as a traditional.
They're not as regulated, right?
Yeah. In most countries. To bring one thing home before we maybe go back into your fundamentals, is I want to emphasize this, because I would give the advice, which I know is a boring one, like start with something you feel comfortable with. I've been in education for quite a while, and I started trading when I was 16, so quite a while ago. I think I'm like halfway through now, 33. So you want to do it, and you probably ignore what we're going to say today until it hurts. So I think you have to go through this experience. It's going to hurt. And then you realize, okay, I need to get a better understanding of what I do. And when I remember when I took I think second, third semester in, I took way too much leverage, traded currency. I traded a lot of options, but also currency markets, because they are extremely efficient, but also very volatile. You can pretty much trade in 24/7. And I remember 6 minutes before my econ class, I had a huge leverage, and I was like, okay, I want to get executed on this. And I think I lost like $700, pretty much twice my rent in like 3 minutes. And my roommate came in and is like, you need to go. And it's like, no, it's coming back. It's coming back. I know I'm going to break even on this. And it just got worse, up to $1,000 loss. I had to cut because I wanted to take my econ class. And then I was sitting there the whole time like, oh God, why did I do this? And after this session, I heard, because like I said, it was like almost twice the rent I lost. You start writing down rules. And this is where you start really thinking about a systematic approach. And this is what makes you successful as a long-term investor. If you realize where you have your edge, can you formulate them and then execute them over a longer time horizon to be successful? Not saying that you cannot be lucky, and maybe you're lucky enough that you put the right money in and you make a couple of million and you can just say, wait, I'll walk away. If you keep doing this for another 5 years, there's a very high chance you lose everything. And to give you some statistics, I think the last research I saw was 92% of the managers are not successful over the long term, if they are on a very specific field. It doesn't mean they're 10 years later not coming back and making a good profit, but it is very time dependent, and it's something we need to focus on, and which leads to the diversification conversation.
And I think it's tough. It is tough a little bit to quantify success, especially in a world with so many different objectives. And I think that is something that people misconstrue, especially with hedge funds. Like one of the guys who's talking tomorrow, his hedge fund, one of their defensive funds makes like 3% a year or 4% a year, something like that. And so against the S&P 500, that's a joke. There's no chance. But the volatility is so much lower in that fund. And so that's where this idea of risk-adjusted returns comes in. Because if you just look at the total return of the S&P versus the return of a lot of these managers, they're failing miserably. But when you start to consider risk-adjusted returns, I don't think it changes the metrics that much. But there are ways to add value that aren't necessarily just pure return.
Actually, on this note, you remind me of a really good example I want to give you, because I'm sure, I think we skipped it. So I was running a different funds over my life, but the one I'm most happiest about was about 650 million multi-asset strategy fund. And I remember one of my former sales guys called me up and they're like, hey, Tim, I'm quit at, I think it was back in the day, it was maybe Nomura. Like, I'm going to quit my job. I'm not sure if you actually quit or, there was another theme behind it, but that's what he told me. So he was on a leave of absence for, I think, almost a year, still cashed in, and he's decided to start his own fund. So he called me up. He's like, hey, Tim, you want to join? It's like, I think I'm pretty happy with my fund right now. I'm not going to go and, go into a startup because I was doing a CFA at the time, FRM, and other degrees. So you're busy enough. So I kept there, and he switched from the sell side to the buy side. So becoming an investment manager. And he was a good sales guy. He really knew what he was doing. So anyway, long story short, after 2-3 years, he raised about 150 million. And then I remember I called him up one day, and his fund was exactly that. He was like, I think he made like 5% on average over 3 years. And I was about averaging 14%. So I called him up, and he's like, you do an amazing job, even better than I do. Because on a Sharpe ratio basis, my volatility was close to 6%. So which is still close to a 2 Sharpe ratio, but he was averaging 5 at a maybe 1/2, 2-point volatility.
Insane.
So from a Sharpe ratio,
consistent.
Everybody loved him, because especially pension fund, insurance companies, that they don't need, I mean, everybody wants 14%, but they don't want the 7-8% volatility to come through this, because they're long-term investors. So he invested in his fund. It's why he raised so much money. But then after 3 years, everybody's like, hey, this guy's clearly know what he's doing, and let's invest. We realized we used the wrong measure for him. I mean, I knew him personally, so I knew exactly what he was doing, and he was a lot of option trading. So he sold, for those of you who are familiar with the term, he sold tail events, pretty much tail risk. So he was really going out of the curve to sell, okay, I bet a black swan is not going to happen. Then guess what? 3 years later, black swan happened. And when the black swan happened, I think it was, it wasn't even COVID. It was maybe the second, yeah, kind of Brexit, post-Brexit, something like this. And my fund went down, I think 15%, and he lost a little bit more than 40.
Oof.
So that is exactly what I talked about earlier. Because we're using the wrong risk measure, volatility captured both of us, and you think he's a better manager, but if you understand his investment approach, volatility is not the thing you're concerned about. Your concern you have with him is, what if the downside kicks in? How hard will this hit gonna be? And those are the measures where you're gonna switch to CVAR, so value at risk, conditional value at risk, so more on the tail end on things. And for mine, I expected in an event like this, volatility captures those multi-asset funds pretty well. So I expected it to be in this range. For him, the market completely underestimated him. And I think he lost about 40% of his investors. On my guys, like, no, we expected that.
Right,
let's move forward. You briefed us on this. We measured you the way you told us to. So this is within the range. And then we move forward.
Yeah. And I think that this plays a huge role, because obviously we're investment managers, and so much of the objection that we receive, especially on TikTok, things like that, is that why would you ever manage money when you just own an index? Like, what's the point? Why would you, when I could just go buy the S&P 500 and outperform in every metric, why would you manage? And my answer to that is that there are so many different ways of measuring risk and success. And so for us as managers, we have clients that don't want the S&P 500 returns because they can't stomach that risk. There are a few that are just like, the S&P 500 has before lost half of its value. They're like, yeah, I can't do that. Can't take that risk. I don't have that. And so they can't just go buy the S&P 500. And that's where money management plays such an important role in people's lives. Not to mention the fact that we offer an investment universe that doesn't exist with anyone else, including ETFs, that you just simply cannot buy the product that we offer in terms of what we invest in and the impact of what we invest in. When it comes to pure performance and risk, money management plays a really important role, because the S&P 500 is just one risk profile. And so you can't really customize that to everyone else very easily without a level of sophistication.
Yeah. And this, to follow up on this, it opens up two very interesting topics. To stay with the risk for a little bit longer, if you think about the theme we are following here with impact investing, and if you feel this is an industry that's gonna get more significance, will gain more significance going forward, and you think that more people will agree on this topic, this is a good time to deviate, because what the S&P does, and every market around the world, they try to develop an index that reflects the majority of the market, which brings us to Markowitz portfolio theory tomorrow.
That's smart.
But for now, it's a very, Yeah.
It's going to be so much fun. That's how you know I'm a nerd. Markowitz? Did someone say Markowitz?
It's where again, like 6 minutes later, I'm done with this stuff. So to go back to the S&P, because it's obviously everybody knows the S&P. You don't need to be an expert. You heard of it at some point. You see the screens in the background. I'm sure, hopefully, it's
I hope so. Yeah.
Something stock related.
Jeez.
And so you have the S&P, and that is a very clear definition. This is what's going to happen. Those are the stocks that are in. Here's the weighting, and so on. And there's no theme behind it. It's reflecting the market. So if you believe that the market or our focus as society is going to change more in this field, you want to select somebody who's like an impact investing focus on this term. Why? Because the risk is narrowing down, because there's less like debate about this. There's more like we all should focus on this. And I think Kira talked about, you talked about earlier about, say, sustainability and those topics. If we more society narrow it down on this, it limits our risk, which makes the overall profile significantly more interesting. This is one level. The other level is that you see very frequently popping up in research, academic research, is the whole topic of ETFs, because cost is a major part of the industry. It is interesting when you start in investment banking. I think we talked about working hours. You know, when I selected my first job after my bachelor's, like, I'm gonna go into tech. I want to work for Microsoft and IBM. And then, you know, for somebody's like, my mom's 2 jobs. And then, like, I mean, I'm from Germany. For those of you who did not, you know, recognize my accent yet, that's actually Germany, not Austria. Not offended though. Austria is nice. Yeah, with the mom with 2 jobs, I'm like, I need to find something that I can, you know, give some money back. So IT wasn't too big back in the day, not like today. So I picked a job in finance, and this is where you start, you know, making 20, 30, 40% more than most of your peers, because it's really high paid. Yeah. But you also realize you're going to work Saturdays, Sundays, 100-hour weeks, and you put all this time in, and you think usually as, you know, stock in selecting. You mentioned your report about Lockheed, so you write those reports. You really focus on stock selection. The problem with all those guys, they have to be paid. Fee structure is high. So the whole industry over the last 10 years or 20 years almost, realize there's a lot of fee compression going on. So the fee comes down, because they realize the success rate is not as high as the fee would justify. And ETFs started popping up. So many institutional investors started investing in ETFs. They're significantly cheaper. There's no trader. I mean, there's a trader behind it, but no analyst, because they usually just replicate the S&P markets like this. Mm-hmm. Usually from a regulatory perspective, very clear how you invest. It could be still an algorithm to follow, like, I'm going to do the S&P, but I equally weight everything. Or I'm going to do an efficient frontier. I do this, but there's always an algorithm, a very clear strategy behind this, which led to this whole problem of, if you think about it, it makes a lot of sense. What if everybody just invests in ETF? Then we all know what we're doing. There's no value to capture. Then it makes it more interesting if you do something different than everybody else, which now turns into everybody wants to be, you know, 20 years ago, active stock selection. They come down because they don't get paid anymore, and they switch to other industries. ETFs are up here. Since now this market is so crowded, you see active investors coming back in and say, hey, we can be better than the ETF, because 80% of them, I'm just making up numbers here, I'm not sure if 80% in some regions, sectors, it heavily depends on the industry as well. But if you see everybody's going into this passive investing, active investing gets more attractive. This is where it combines again to the impact theme, or in general active investors to see there's more alpha coming out of this industry and anticipating going forward.
Absolutely. And to that point, I think the S&P 500 is really representative of the United States in its current rendition, in the way it is right now. And so what we're doing in our own portfolio construction is developing the portfolio that is hopefully capturing the themes that are going to be incredibly popular in the coming years. And this is why we talk so much about clean energy, electric vehicles, virtual reality, so on and so forth, because we don't necessarily want to capture the market as is. We want to capture the market going forward. And we think that the main drivers of alpha there are going to be sustainability and impact and innovation. And that's how we've designed our entire investment strategy. So I think that's actually a great place to pause. We have a half-hour lunch I'm sure you guys are tired. I know I am. So let's take a little bit of time, go get some food. We're going to leave the Zoom up, but we're going to turn off the camera and the mic. So you guys are welcome to stay in if you want. For those of you who are sitting in TikTok live right now, we have 27 spots in our Zoom if you guys want to go join. If you go to hoskincapital.com/Veritas, or you go to the top button in our link tree, it says Veritas event. There's going to be a button that says join now. Go ahead and click it and join. We will be back with you guys in a half hour, right? Okay, perfect. We'll talk to you guys soon. I'm going to stop the TikTok live as well. I'm sorry. I'll miss you. Okay. Let's see. You're at the control panel, so you'll have to mute and video.
I'll just mute.
That's fine. We're still sitting at 70. We're going to just leave the sound on because I want to roast you guys in chat. Stanley, posture check. Come at me, dude. I will fight you. I noticed that, and I don't know if you guys saw me sit up straighter. I was like, oh, geez, he's right. He's right.
Oh, no break music. It's actually a good idea. You should turn the music on.
Oh, like power moves.
100%.
No break music. I know your back hurts. Dude, it's not a stiff chair. It sucks. They're terrible. They're absolutely terrible. It's fine. I'm here for it. All right, yeah. Where's the sound bar? Send it. Absolutely send it. Let's see. Oh, we got 22 new followers while we were live. I love it.
That's awesome.
711 viewers.
What do you need some food?
I do.
Go get some food and we can do some Q&As too, because it's supposed to be Q&A right now.
Oh yeah, that's power moves.
Yeah.
What games do we play? Should we invite everybody for
You trying to play some Tekken? Play some Rocket League?
No, Rocket League tonight.
Yeah, we can stream Rocket League for a half hour. I got it on my computer.
We're gonna have to pretty much make a stream at this point.
Hoskin Capital after hours.
Dude, Hoskin Capital live stream? I would honestly do that. I'm not opposed.
Oh, here, somebody heard Tekken, so that's good. We have some traditionals here.
Someone heard Tekken. Victor wants to hear about the tattoos. Dude, so let's see. We got aspens over here. These are aspen leaves. I'm from Colorado. And so the aspen leaf, the quaking aspen specifically, is very much the symbol of my homeland. This is a Calvin and Hobbes cartoon. I don't know how well you guys can see it. We can kind of get closer. But that's a Calvin and Hobbes tattoo. My brother has the matching one. And then we have a mandala that is going to be part of a much larger sleeve as we go forward. When is Hoskin Capital starting its own MPI, Sean? Leave. No, I'm kidding. You don't have to leave. But we will be talking more in depth about MPI. I'm actually working with the data guy on TikTok because he's gonna be helping us visualize stuff like that. Alexis, we will definitely touch on environmentally friendly stocks. We're not going to recommend any. We can't make any specific stuff. We can't make any specific recommendations, but we will talk about analyzing them because that's a very important part of what we do. Yeah, Christopher, as you know, my best friend is Curtis Ray.
Curtis frickin' Ray, man.
Yeah. Oh my God. All right. I need food. I shall return. All right, go eat some cold Costco pizza.
There's no more pizza.
I'll go find some.
Yeah. How many people? We have 72. Wow. So how many people are going to show up tomorrow? Cal, what's your Venmo? No. I'm good. How many people are? Okay, yeah. So tomorrow it's going to be incredible. We have 4 guest speakers, all of them super credited, and like I think a few of them are hedge fund managers. I posted all of their bios on the Instagram, and I actually run the Instagram, if any of you guys were wondering. And do the people that RSVP? Yeah, so we sent out the link for Zoom last night. I think we're going to do the same thing. So after this Zoom wraps up, we're going to basically finalize the schedule, and we're going to send out a Zoom link around the afternoon to those who have RSVP'd already. So if you signed up for the whole VERITAS event, you will get the link. It's just about showing up early enough. It will be a different link. I'm pretty sure Zoom, sometimes it can be the same link. I would just go to your email that you signed up with and use that to be sure. But in terms of the people that we have coming, oh man, like you saw how Tim and Nate reacted when we talked about it. They are going to be like some serious people. Kyla was today; she was great. But we, I'm not sure who's confirmed yet. Marvin Owens, he's confirmed, and he runs Impact Shares, or he works with Impact Shares, and that's very much related to what we do, which is ESI investing and investing in companies that make an economic or environmental, social, and innovative difference. So definitely stay tuned for that. But if you're wondering what the schedule is going to be like tomorrow, I can actually screen share this. Yeah. Nope, cannot. Yeah, so I mean, you can tell we're still figuring out this whole Zoom thing. But yeah, it's so far going pretty well. How does the music sound to everyone? Is it kind of, does it sound okay, or is it's good? It's low key. Awesome. That's what we're going for. What's my best trade to date? Probably Airbnb. I mean, I got in right at the IPO and it's been doing pretty well. But again, the stock market recently has been really up and down and volatile. I would say that me personally, I'm more so investing for the long run. So I haven't traded options yet. I'm on Charles Schwab, and I have to open an options account in order to do that. I've literally been focusing so much on the Series 65 that I haven't had time to actually invest, which is hilarious. And nice. And I'm excited to like kind of get into that. And again, like this is kind of the first time that those of you who are coming from TikTok have seen me, because I've been like at school in Colorado grinding. But starting in April, probably more like May or June, Nate and I are going to be doing a lot more collaborative stuff, and I'm hoping to kind of boost our marketing a lot more. Palantir, oh man, it's crazy because I got in on Palantir when it was around 30. It was at like $30, and it's gone down to like 23. Again, not recommending anything, but I'm holding on to it for long run. I think it's going to do great. So yeah, we'll see. But wow. What do you guys think about streaming? Do you think, do you like the Zoom setup that we got, or do you think, podcast, do you think we should like find a different way of streaming? So the plan for tomorrow, this was the one hiccup we came across. We were going to stream to YouTube so that people can actually watch it, not just on TikTok Live and Instagram Live. But
Okay, cool. But we're going to have everything streamed to YouTube tomorrow. So if you're not able to actually be in here, we have a lot more spots now. But if you're unable to attend because of capacity, you will actually be able to stream what we're seeing here frame for frame instead of like TikTok lagging a little bit, etc. Is that cereal? Are you eating cereal? My guy.
Absolutely.
I love that.
Cereal right now.
Yeah, we're talking about options trading and a little bit of streaming.
Share with my cereal.
Yeah, people want a podcast guy. My guy, dude. Zoom is great. People love Zoom too. I don't know. I think we're doing pretty well. What are your thoughts on Palantir, by the way?
I fuck with PLTR.
Yeah?
I think it's cool.
Cool. Yeah, let me undo this. So what should we talk about? Is it loud? Oh my gosh. Bro.
Just absolutely destroy my eardrums.
Delayed reaction. Here.
It wasn't until you talked.
Oh, sorry, dog.
No, you're chilling. You're totally chilling.
Here, I can.
A little more?
Is that yours?
No, it's the other one.
The hell? We don't know what we're doing. Is that good? Am I gonna? Is this okay?
Yeah, you're fine.
Okay, cool.
So this is what the podcast would look like. Here, scoot over,
Something like that.
sort of facing in, like that.
Yeah.
Oh God.
Um,
How do you suggest uni students get involved in the industry? Ooh. What's your major? Victor.
let's open
I
a.
want my cereal.
Eat your cereal. What's your phone at?
Should I be an asshole and read it? Eat it right next to the mic.
We want some ASMR. Oh my God.
What did Victor say?
Victor, biomedical engineering. LOL. Yeah.
And you want to go into finance?
Maybe. International business, maybe.
I can see international business.
Yeah.
I think as an engineer, your main sell is the quantitative, like mathy side. So you could aim for quant of some sort if you want to be an
investment banking. I'm sorry. He wants to go into investment banking. IB. I'm still learning, guys. I am. Oh my gosh.
Well, with IB, I think. Yeah. I mean, I would say don't.
Piece of advice: don't.
I think.
Well, okay. Let's say you would though.
If you want to go into IB and you're an engineering major, the main thing that you need to tell them is your diligence around school. So you need to show them that you're incredibly competent at doing school, aiming for the 4.0 GPA, something like that. And then I'm trying not to eat right next to the mic.
They don't care. This is DJ Hoskin Capital coming at you live
The DJ
with
sesh
the
comes
hottest tunes. Yes, before I went into investing, I was actually a DJ, and I played for absolutely nobody.
So if you're a day trader
Now we're getting into
and you want to get involved in a
Sean
firm,
is still here.
I would say you should. Yeah, if you want to get involved in trading, I would say you should go the analyst route and leverage your engineering background to aim towards more like quantitative, systematic trading companies.
Nice, Sean.
And if that's the case, I would say you could probably aim for a master's in financial engineering because those feed straight into hedge fund analyst, investment manager, that type of stuff.
What are your opinions on Vanguard Life Strategy Fund?
Is that one of their target funds? I don't know. I don't know what Vanguard Life Strategy is, but Google knows.
Curtis Ray probably knows. MPI, baby.
Let's see. Vanguard life strategy?
Eh. Can we do a poll? Why can't we do a poll?
You just might not be driving. You can probably create a poll from the
Yeah?
other main
Okay.
one.
Take the wheel.
I'll take the wheel. I want to learn about life strategy. Let's see. Oh. So life strategy are just risk managed target allocation funds. So what that means is that there are 4 life strategy. We're talking about Vanguard life strategy here. So there is the income fund, the conservative growth fund, the moderate growth fund, and then the actual growth fund. And so all life strategy is doing is providing 4 different options for different levels of risk that you're willing to take. So if you're a super conservative investor and you have maybe a 5-year time horizon, then that's what the income fund is targeting. And so they are 20% stocks, 80% bonds. And then as you go up in risk, you just increase your equity exposure. So by the time you get to the growth fund, you have 80% stocks, 20% bonds. I don't really see the point. Like you could essentially make this yourself for cheaper because you could just buy a bond fund and then you could buy a stock fund. And that would be, you could recreate it in whatever fraction you want. And that would give you a lot more flexibility to then adjust your allocation as your goals change. Because as you get older, you want to rotate away from stocks and into income. And so if you're holding a life fund, you would have to sell the whole life fund and buy one of their different life funds. But maybe that's not the exact allocation that you want. Maybe you want 75% stocks, 25% bonds. So I think that if you're looking at something like what life strategy offers, I would say, especially for you guys that are here, you should just build that allocation on your own. I'm on the Vanguard website right now. You can't see it on my phone at all. But I'm just looking at the different life strategy allocations, and you could just look at this and say, I like this one, and go combine a bond fund and an ETF, and you'd be fine. Minimum capital to have Hoskin Capital invest with us. There is no investment minimum. You can invest, but I am pushy, especially if you're under $5,000. I definitely try to get all of my clients who have lower investment accounts in some sort of savings plan. Usually they have Roth IRAs. And so I try to get them to save $500 per month. And so you can start with whatever you want, but only if you're willing to put up with pressure to like save and continue to grow your wealth. I would say usually our average client is like 25K, more in that range. And the people that do start out with small allocations hit 25K within like two, 3 years. That's kind of what you could expect. Our fee structure is really simple. We charge 0.9% of assets under management. So it's the exact same as owning an ARC fund, which I actually did not base my pricing structure off of that. But if you hold like ARKK or something like that, then you are paying the same expense ratio that you'd be paying with us. That's the idea. Let's see. Can you manage it if it's through Chase? So the way that we directly manage assets is through our custodian, Interactive Brokers. Interactive Brokers, so you, rather than having the money at Chase, you would transfer it into an account at IBKR, and we would manage it from there. That's because they have all of the systems in place that allow us to do our model management. But we do some financial planning as well for clients who know a little bit about investing and don't want our investment management. We'll write them a plan. Those are $500, and we'll essentially allocate for them. And then we'll check back in once a year and just make sure they still like their allocation and make any adjustments that they might want. You can transfer a Roth. You can do what's called an ACAT transfer, and you can just move it over to wherever you want. And you can do that as many times as you want. You don't have to worry about rolling it or anything like that. For work-life balance, would you say portfolio management is better than investment banking? Tim,
Yeah.
Work-life balance, portfolio management versus investment banking. Which one's worse?
Investment bank.
Not even a competition. IB is brutal. Portfolio management is usually where you go when you have kids, so that you can actually, get to know their names. I write our plans from scratch. I do not use Money Guide Pro. I'm honestly kind of disenchanted with the financial plan stuff that they have, because it gives you all these really neat numbers, all these Monte Carlo recommendations, things like that don't mean anything. They're just shiny and they look sophisticated. The way that we write our plans is we nail down 2 to 3 goals that you have. We do a full financial workup to analyze your ecosystem. And then we recommend changes to align your ecosystem and your saving strategy with the goals you want to achieve. That's it. That's the whole point. But of course, that has a lot of different components, like what you should invest in, where you should be locating those assets, which is what we're going to talk about this afternoon. So should you have it in a Roth? Should you have it in a 401k, an IRA, so on and so forth? These are the types of things that we talk about. Am I gonna write an article on being the youngest CFP practitioner? Absolutely. I'm gonna try to get featured in Forbes. Are you kidding? I'm gonna tell everyone. I'm gonna scream it from the rooftops. I get my marks in a couple of weeks. The exam window just closed, and so the moment I have my marks and everything's done and ready to go, I will be telling everyone that I'm the youngest CFP until someone comes out and tells me I'm wrong.
All right, I got a poll for us.
Okay. I got my CFP at age 7. Dang it, man. I thought I had that
Age
unlocked.
7.
Holy smokes. All right. We're at 63. That's honestly, I'm kind of stoked on that. Yeah.
We have friends. They're sticking around. They're vibing. Absolutely vibing. Let's see. I want to make sure I'm not missing Q&As. Ooh, entry-level job. Okay, let's talk about entry-level jobs, stuff you can do straight out of college. So if you are interested in investing, investment banking, and maybe like an analyst for buy side, so doing like the associates program at Capital Group, which is one of the rotations that Kyla Scanlon did. I think she was a CAP associate, not a TAP associate, but those types of things are best if you want to go into strictly asset management. If you are curious to do wealth management, which is what we do, where you work with individuals instead of institutions, then I would highly recommend working for a registered investment advisor. So an RIA, we are an RIA, like that's what we do. And this will get you the work experience you need if you're curious to take the CFP, Claudia. But what you should be looking for is, my favorite job title in my side of the industry is a client service associate, a CSA, because that's going to give you the most exposure to the actual wealth manager who's doing the work that you want to do. And you get to just sit and learn, and they pay pretty well too. I think they sit in like the 60 to 70 range, so they're fine. But for out of school, it works. Whereas if you go into investment banking, something like that, it's going to be relatively higher. Let's see. Sean has a point. So if you go and you work as a CSA or something like that at a bank, or a wirehouse, they will pay for a lot of your licenses and your education. So they would pay probably for your CFP, which, I mean, it cost me $3,000, something like that, to go through the full education and take the exam. So I think going to a bank makes sense. The work at a wirehouse, especially as like a financial consultant, is kind of rough. I decided not to chase that, but it's also easy. Like if you want work-life balance, being a CSA or like a financial consultant or an associate at a big bank like Merrill Lynch is a good example. That's usually a good run.
Is everyone ready for a poll?
Yeah, let's see it. Drop it in there. I want to see if this works. Oh, it popped up for me. Okay.
So
we're just gonna.
So if we're gonna do a podcast,
So if we had to do a podcast,
I feel like we just need a. Oh, I can't click on it. Oh, because I'm a panelist.
Oh, I made it
I'm,
so that
no, yeah,
panelists
I'm a
can
panelist,
vote.
That's fine.
I
I feel like if we put it on YouTube, we could record it and do it like as Stanley said, put it on Spotify.
yeah.
Too.
Oh, Spotify would be cool.
Yeah, that's
Yeah.
easy. It's not
Yeah.
a problem. Meh. I would answer meh. How's everyone liking the webinar?
Meh also means awesome, so that works too.
Facts. Yeah, I feel like we could do YouTube if we want it to look nice. Like if we set it up, like if we end up living in the same city after you're done with school, then we'll do a podcast on YouTube.
Dude, how fun would that be?
We can do it together.
Grind the whole week and then on the weekends do a podcast. Oh my gosh. The best part is I bet that podcast would just blow up. Like
Yeah.
people
We're gonna have fun. We would just have so much fun doing it. And I feel like that's
Yeah.
what makes something successful is that if you enjoy what you're doing, if you enjoy every second of it, everyone's like, yeah, bet, I agree.
Tim's floored.
Yeah.
Stretching.
He's laid out.
All right, let me see if I can.
Dude, it's all about the guest speakers, Christopher. I'm so stoked.
we got 38
So
out of
stoked.
55, 69% voted, 70% voted.
Beautiful. Tim, they've requested that you change to a black shirt so we can all be matching.
Matching?
We're both wearing black shirts.
Oh, yeah.
I love when I choke on water. God, that's what I get for laughing in the middle of that. All right. What else?
You want
I
to see
think-
the polling results?
Yeah, let's see it. I'm
People are
curious.
still slowly. Well, I can end it and everyone will see it. I'm pretty sure. No. So people really like YouTube. It looks like here. And then everyone's from
Everybody's on TikTok. Let's
Yes,
go.
sir. Instagram. If you don't follow our Instagram, go follow it. And everyone's doing great. Go Mets. Let's see. Show results. Yeah.
There you go.
Here, you.
Oh, we can scroll ourselves. So yeah, it looks like everyone follows us on TikTok, which is great. Instagram, you should also follow our Instagram, but that's just because I run it. YouTube. So yeah, I guess starting and running a YouTube account to like stream from would be a really good idea. And we're already going to upload a lot of this content onto the YouTube account that we sort of started. We were going to stream today on YouTube, but it takes 24 hours for you to be able to be granted access to live stream. Yeah, Stanley, you want to fight or or you want to get out?
We're throwing hands.
Cal is emitting major 5'11 energy, but 6'0 with shoes.
I'll throw hands.
Yeah, it's actually 5'11 with shoes, so nice try.
Wait, what energy am I emitting? Good God. No, I don't want to know. I don't have the ego for that.
So yeah, YouTube. Can we add the YouTube page link to the TikTok? Yeah, we can do all that. We're going to. Yeah, so we're gonna kind of construct the Instagram, the YouTube page, and we're gonna share all those links and everything. And hopefully tomorrow we're going to have it all streamed on YouTube,
Yeah,
and
that's
then
the hope.
on YouTube to watch anytime you want. And there you'll be able to actually watch the guest speakers that we'll have, which is okay, right? Like we can do that. Have the guest speakers be streamed and recorded.
Yeah, they'll see, like, they would see the same thing that
Cool.
the Zoom attendees are seeing, which is sick.
Cool.
Those are the speakers you guys do not want to miss.
Can we drop some dono bombs in the YouTube? Hey, I got no problem with that.
Honestly, we might have to hit that up. We'll let you know.
Yeah.
Okay, Andrew just joined. Welcome. Nothing is going on.
It would strictly be to pay for the subscription for the webinar edition
There you go.
for Zoom.
Yeah,
Yeah.
that's it.
Which
That's
is
what-
like
that's what it'd be
$40. So
fun.
$40 is our
That's our dono bomb.
that's our dono bomb. Yeah.
So Andrew, we're on a break
Can
right
we
now,
accept donations?
but we're about to start. Oh yeah, it's 12:02. So we're gonna start talking about personal finance and like making good personal financial decisions. So we'll step away from investing and more into my arena, which is the planning end for sure. Do we have any last questions we want to do?
Yeah. Any last questions? Get them in now.
What do you guys think of the music too? Is it annoying and loud, or is it a good background vibe?
Of course, Alex.
Cheers.
It's chilling.
Can we
This
get
is
Hoskin Capital t-shirts? We are absolutely doing
Bro,
it.
imagine Hoskin Capital in black with the logo.
Yeah, that'd be
Oh my
sick.
gosh.
It's a shame you can't hear the music. It's a vibe.
Can't really hear it.
How about that? How about that? All right, let's talk about personal finance then, shall we?
YouTube will be linked after the webinar.
Yeah, we'll do that. We need to wait for it to approve.
Yeah.
Maybe should I drop maybe I'll drop my TikTok, or not my TikTok. I'm gonna drop my LinkedIn in because you guys were talking about connecting. We'll put both of us in here if you want. I believe I'm Nathaniel on there.
TikTok?
On LinkedIn.
Oh, on LinkedIn?
Yeah. So that's where you'll find me. Obviously, managing partner,
I don't-
Hoskin Capital.
Yeah.
Easy to find. Oh, I have all of the people. Let's go. Connecting with all the homies.
You guys are going to love my name.
I don't think
Callahan?
Cal swearing.
Yeah, I don't think they know my name is actually Callahan. That's great.
You're going to do a mid-market check-in because I'm excited. I'm glad we're positive.
Yeah.
So S&P 500 turned positive. Let's see where go back.
Huh?
Yeah, S&P 500 is sitting. This has obviously not updated. Hello, or did mine not update? Yeah, there we go. Full recovery, baby. S&P 500 up 0.45. What happened? What did we miss? Dip buying. Of course, it's dip buying. That makes sense. So it sounds like we hit a low. People got excited and started putting stimulus money into different pieces. So we hit oversold territory. Yeah, this makes good sense. Anyone buying here? You don't have to tell me what you're buying. Just thoughts about whether or not you're bullish on the market here. Why do I have so many emails? I don't need emails. Let's see.
Airbnb,
I'm liking I'm liking the ones that have
Same.
dipped 50+%. I think that's because there are some names that I'm obviously not going to talk about, but that I wanted to get into and had FOMO on that have corrected majorly.
Should we, sorry, I didn't mean to cut you off. Should we throw the TikTok live back up?
Oh yeah, let's toss it up. Yeah, because we're ready to get started.
And wow, we got a lot of spots. It's cool how
Dropped to 57.
for a sec we were capping at 102, and that's the 2 would be two.
us.
But
yeah.
it pretty much shut down the Zoom on my computer, and that's a good thing. We didn't know what to expect today.
Yeah, no, I had absolutely no idea what the plan is. But the cool thing is that we get to start it back up.
Yeah.
And have it work. Let's see.
Don't lie, y'all ever checked your assignments? Oh,
Of course.
duh.
It's not a question.
Yeah, that's not a question. Get out.
I passed college.
Reported to the FCC.
Boom. Report.
Okay.
Fire up the TikTok live, and we will kick into some personal finance. Making good financial.
We're going to be doing another one of these tomorrow, and then hopefully in the future, depending on how everything goes. And it's going well so far. So
Yeah, if we get a turnout like this, absolutely do it again. Okay, we are live.
should we?
What's up?
Hello.
God, we are matching.
I know.
100%
Jeez
matching.
Louise.
Okay, So the goal of my next really hour and a half is we're just going to talk about personal finance. And I'm going to share with you guys a couple of tips that I have learned working in the industry, as well as a lot of the different tips that have helped multimillionaires continue to keep their money tight and continue to add to and grow that wealth. And then we're going to talk through a couple of different things that you could implement today and actually use it in your strategy of building wealth over the next couple of years, especially because you guys are younger. So let me see, where do I want to begin with all of this? Hold on, I have it all written out. So the first thing I want to talk about, I think not enough financial planners talk about, and then way too many like 18-year-old TikTokers talk about. And the thing that they talk about so much is improving your earning capacity, because this is an incredibly important component of building wealth, right? Like, I don't care if you're the best trader in the world. If you are trading with $50, you're not going to do anything reasonable with that cash. And so you need a way to get money into your pocket in the beginning. This is the type of topic that just ends up being, oh, you should buy a dry cleaner, or you should get vending machines or something like that. And first of all, those side hustles are incredibly saturated. They are now full of people who learned about them on TikTok and are now purchasing them. They come with very intense overhead costs. So you need to have money in order to invest to do these different things that are often recommended. And that includes drop shipping. There is no real starting from zero with a lot of those. But there are two ways that you can improve your earning capacity for essentially free. One is education. There are sometimes, I don't really recommend courses, because courses just do a good job of aggregating data and making it presentable. All of the data is available. And so I wouldn't say you necessarily need to buy any specific course or necessarily go to school. Going to school helps you get a job, not helping you be educated. And so the ways you can increase your earning capacity are improving your education so that you can show other people how smart you are, and they will pay you to do the things that they cannot.
And so you can also understand everything.
Absolutely. So you can get what's going on.
Right.
And so it's not about just being educated in everything. Like, if you go and you spend a year doing a deep study analysis of World War II, that would be really cool. And you would learn a lot and you'd be way more educated at the end of it, but that wouldn't necessarily translate into earning capacity. So this is where we come to valuable skills. And the valuable skills, I mean, I'm biased, coding, computer programming. The fact that I knew how to write AFL, Python, and R in my job added $20,000 to my annual salary.
Wow.
So
that's crazy. And yeah, I've heard over and over, you got to know how to code if you're going into finance.
I just think it's huge. Like, I think there are still jobs, there are still areas where it's not necessarily required, but I also think that you can learn rudimentary Python in a year. Like, if you did a 2-month intensive and then you did 2 projects, you would be a very competent programmer in Python. Wow. And that would allow you to do a lot of the things that like I did in my job that made my MD think I was a wizard. And so that's my obvious recommendation, is programming. But then the other education really comes down to personal finance education. This is actually one of the reasons I went and got my CFP, is because even if I don't use it for a second in industry and I don't use it for Hoskin Capital, which I obviously will, I still get to use it in my own life, because I learned all of the tricks that are used by the wealthy to be financially independent. And I learned about taxes, and I learned about investing, and I learned about investment risk, and I had to know it really well in order to pass this test. And so even if I quit this job and go work like a tech job, I'm still going to be using that knowledge to improve my own finances. So that's the second component, is becoming financially literate. And the fact that you guys are all here listening to us speak means that you're dedicated to that, which is awesome. So then the third part is, if you're not going to drop ship, if you're not going to go buy vending machines, what are you going to do that you actually get paid for. So what I did is I found something that I was quite good at that other people needed.
Right.
Can you guess what it was?
Investing.
That's a good one. But the one I did first was tutoring.
Right.
Because I was good at school. I got good at statistics, and I got good at analytics, I got good at Excel, and I got good at finance.
Right.
And then I would just tutor people. I still do. $30 an hour. Sit down with someone.
Don't tell them that.
That's true.
Nate, please tutor us.
Sit down for an hour,
Right.
teach them statistics. Because I went to Chapman, I had a network of people that I knew, like within fraternities, sororities. So they would then recommend it to their underclassmen.
Right.
And I would help them out with their classes, and I made money that way, both in college and out of college. And so personally, I think that that's a way better way to improve your earning capacity rather than investing in something that everyone else is doing.
Right.
Just figuring out something that you're really good at and then monetizing it somehow. So for everyone in the class, or whatever this is, the event, and then you as well, let's brainstorm a couple of ways that we could do that. Because I mentioned tutoring. So you could tutor people if you're good at doing school. Another thing that I did for money is I cleaned people's AirPods.
You did not.
$10. $10. Just clean your AirPods.
How does that work?
How nasty are your AirPods? If anyone has them, how nasty are your AirPods? I went to a
Do you just take a
school.
toothpick?
I had a little brush scraper. It was like a little metal brush. And then I used a Q-tip with isopropyl alcohol. And so you would clean the whole interior. You would scrape everything out. You would pull the lint and the earwax out of the actual.
That is disgusting.
It was horrendous, but I wore gloves and I could sit down and do 10 of them in like a half hour. So it didn't matter.
Wow.
And so people would bring me their AirPods and I would do that. Let's see. The pros are very nasty. They're gross, dude. So then I also really like freelancing. So I have a couple of friends. My brother does digital art, so he does animation.
Yeah,
and,
he was in here earlier too.
Oh, nice.
Yeah.
I missed him.
Yeah.
And so he is incredibly good at that. And so he does freelance work. And so he just works on ad hoc projects for people. And you can find, in the gig economy, this is so available. You have Upwork and Fiverr and those types of things. So you could just put yourself on there. And if you are doing something else, like going to school or working a 9 to 5, you don't really care how busy you are with that. But if one pops and you can make $500 doing a project, easy. That's cash. That's a festival ticket. So I feel like those are the types of things that people miss out on because they're more interested in doing the earning capacity things that just take so much time.
Right.
Like drop shipping.
Yeah.
So much time, so much money to advertise stuff
And
like
you
that.
see it all over like TikTok and social media. Like if you want to make money like passively, drop ship.
How I made $10,000.
It's ridiculous.
And I think there is money in it, but especially nowadays, there is so much price compression and so much saturation that you're just not going to make any profit. You might make a lot of money, but after you subtract out the costs and the advertising and everything like that, as well as the time that you spend,
Time value.
yeah, you could just end up doing something way more worth your time. Even if we despise coding, should we still learn it for finance/investment analysis? If you despise anything, I don't necessarily think you need to do it. For investment analysis, especially if you're doing it for your own portfolio, you can probably do most of it in Excel.
Yeah.
Unless you're trying to build a systematic trading strategy, you probably don't have to go as far as Python or R. Yeah, until you start to get really sophisticated, I don't think you need to know coding. I would prefer that you learn coding so that you can show whoever you're working for that you know coding. I made a TikTok a while back talking about automating tasks in the wealth management industry. And a bunch of people asked, like, what tasks did you automate? What tasks did you do? And my favorite one to talk about is that we had a data provider who they had 2 tiers. So they had a tier that was like $1,000 a month,
Okay.
and a tier that was like $10 a month. And the difference between the two was the ability to download the data or what's the word? API. So like actually plug into it with an API. And so my boss was like, I want this data Oh, sorry. You could download it with the $10 one,
Right.
but you had to go through and download it for each individual stock.
You're kidding.
So we had 9 strategies, like 40 plus stocks per strategy. So he would go through and
How many stocks is that?
Well, 40 times 9, so call it
Yep.
yeah, insane. Absolutely insane. So call it 360. Yeah, 360
Jesus.
stocks. And he would go through and he would click download, next stock, download.
I would pay some guy to
download,
do that as much as I would
stock.
pay someone to clean my AirPods.
And so he would spend 10 hours doing this.
Wow.
And so he was like, I think I was making 40 an hour, somewhere in that area.
Mhm.
And so he was like, I'll pay you for your Saturday, essentially. I will buy your Saturday for you to do this.
Huh?
I was like, bet, yeah, it's going to take about 10 hours, about what you did. And so I wrote a program, a web scraping program that went in, downloaded, tabbed to next, downloaded, and I would just let it run. And it took about 30 minutes.
That's crazy. And that's coming from so my coding experience is nil. And that is like the coolest thing.
I still have the program. I still use it occasionally. And so
that's awesome.
My boss, I ended up telling my boss about it. I didn't want to like rip him off, but
no, you should.
I was like, look, this takes me 30 minutes.
Right.
And he was like, cool, you still deserve that paycheck. And so instead of making whatever, 10 hours, $40 an hour, instead of making $400 on my Saturday, I made it in a half hour because coding allowed me to do that.
Yep.
And so that's why I think it's so important at work. Whether or not you use it in your own stuff, I don't know. How or who did program your website and the whole algorithm for Hoskin Capital? So
that was fun.
We used a graphic designer or a web designer because she was incredible.
Yeah.
Shannon Casey on Upwork. We literally used her.
Great memory, and she was a great designer too.
Yeah.
She basically set the tone, the theme for Hoskin Capital.
Yeah. And we found her on Upwork.
Yeah.
She's a master's student. And so she was just doing it as side work. And it was exactly that, like this is exactly what we're talking about. She was using her ability to design websites to improve her earning capacity.
That was back in end of June, early July.
Yeah.
And
God, forever ago.
Gosh, we've literally come so far since then. And not even that far at the same time.
Millions of dollars later.
Millions. But yeah, she was great. And it just goes to show that, going to Upwork or Fiverr, you can pretty much find anything.
Right. Yeah. We just found her and we interviewed her and we liked her. And so we did it. And it was that easy. And
she was the first person too that we interviewed.
Right.
Yeah.
And she was great. She killed it. She absolutely killed it.
Yeah.
So the next thing on my list is budgeting, because obviously you make the money.
Mm-hmm.
And if you're like me, you spend the money because you like going to festivals and things like that.
I mean, who doesn't?
Yeah. And so for me, granular budgeting has never really worked. And I'm curious to hear your thoughts on this as well, because I have tried all of the different budgeting apps, the Mints, things like that in the world.
Right.
And I don't end up doing it. I miss it. Sometimes I'll set up an alert and the alert will pop up and be like, you're $100 over budget.
It makes you feel worse about your decisions. It does the opposite effect.
Totally.
And if you're, good enough to actually follow the rudimentary like reminders and limits and budget that you have, good on you. That's amazing.
So if that works for you, do it.
Yeah.
But most people are not programmed that way.
Mm-hmm.
And so what I want to do is teach you guys the way, way easier way to budget. And the metaphor that I use is be a squirrel, be a chipmunk.
Squirrel?
Yeah. Because if you take your savings and you hide it from yourself for a rainy day, and then you forget where it is, that's when the acorns will grow into trees.
Yep.
And so that's exactly what I do. I have a brokerage account, I have a Roth IRA, I have a savings account. And anytime I get any piece of money, especially back when I had direct deposit, I was collecting a paycheck, it disappeared before I ever saw it. It just went straight into those accounts, and I don't look into those accounts. I would purposefully remove the the password memory from my Chrome and things like that, so that I would have to go dig for my password to get into those. And then I would just let it grow and let it accrue. And so I did that. And that's the reason I was able to quit and start Hoskin Capital and have savings on hand, was because I hid that money from myself. And of course, I'd love to invest. So all of it was prudently invested, and it grew. The S&P 500 returned like 80% or something insane like that over the time horizon. And so I just held on tight, kept moving, and it was great. Let's see, what questions do we have?
Everyone who's on our TikTok right now, you can hop into the Zoom and ask questions.
Freddie Finance is on. Yes, we miss you. If you have time, come do live.
You can hit the link in our bio and
that's fine. He's at work. He's tuning in. Freddie Finance was one of the guys we were gonna have talk, but I got to him way too late, so we couldn't schedule him in. Next time though, I highly recommend
there will be next time too.
So for any of you other guys though, we still have quite a few spots left in our Zoom meeting. So if you go to Hoskin Capital, hoskincapital.com/Veritas, the top button says join now. And so that's going to be your spot. And that's going to just hopefully give you the best.
Or just stay on the TikTok. I mean, it's
whichever works.
Whatever works.
For
but
now,
we're answering the most questions from
all the questions
Zoom.
Are coming.
Yeah,
from
we
Zoom,
got
so
we got a pretty cool thing.
Yeah, Carlo, I'll link it. I'm going to drop it in here as well, because I think I can comment, right?
Yeah.
I don't know how to do any of this.
Dude, I don't know what. Go back.
Hold on, wait, there it was. Comment. Beautiful.
Cheers.
Someone said you guys are twins. No, we are not.
How'd they know?
But we are wearing the exact same thing today. Okay, I just dropped it in there. That should be your spot. Is that your brother? No. So Cal is my co-founder. He's one of the two other members of Hoskin Capital.
Where's Tim at?
Ooh, how do you deduct? Oh yeah, Tim's back there. Tim's back there on his massive setup. You can't see him behind.
He's working. He's making the numbers work.
He has to make the numbers work.
Yes, sir. Crunch the numbers.
Right. Oh, cool. So I got a question. I was actually going to talk about this. So we talked about budgeting, because that is an incredibly important component of making sure that you are saving more than you're spending.
Okay.
And then, or not saving more than you're spending, just spending less than you're making is what I was trying to say.
Saving more than you're spending. Yeah. Spending less than you're making.
There you go. That's the move. That way you save something.
I feel like it's a subtle difference.
So once you've done that, you're going to have money, right? You're going to have something, whether it's $100 or $1,000, it doesn't really matter, because the goal stays the same.
Right.
The first goal is the emergency fund.
Okay.
I recommend 6 months for anyone who has a single stream of income, and 3 months for anyone who has 2 streams, or a wife or a partner that also provides income to the economy. And so if you have 2 streams, you can probably handle 3. I recommend just going to 6 to be super safe. So if you have
6 streams of income,
6 months,
6 months.
Yeah. 6 months of
zone out for 5
emergency fund. So if you spend $2,000 a month,
okay,
then you're going to need 12 grand, something like that.
Yeah.
And so that's your first goal. And then you can use that money. Once you have 3 months, you should pay down debt. So if you have consumer debt, like credit cards, that I would argue that that's either your first priority or your priority once you hit 3 months of expenses, because those just accrue insanely high interest. And so you just can't sustain that. You're going to end up paying double or triple what you borrowed initially. So those are your first 2 stages.
Let's use the poker chips.
Oh, bet. Okay, cool.
Yeah.
So,
and no, we're not twins.
Okay. So can you guys see this? Oh, they can see this. Oh,
yeah.
That's cool.
Yeah, both can see it.
Beautiful.
We've got this
So
down.
Let's say that this is the amount of money that you make.
Okay.
Right. And so you're going to want to set aside, because we talked about paying yourself first. You're going to set aside your savings, and then you can spend the rest of this. This is going to be your emergency fund. So you want to add to your emergency fund every single time until, how many are here? Perfect. That's 6. That's 6. What I wanted. So let's say you have 6 months worth of expenses right here. Then if you have some debt, especially credit card debt, but also consumer debt, like personal loans, things like that, you should pay off that debt. This isn't going to change your net worth or anything like that, but it's going to reduce your future interest payments.
And this is from my savings, right?
This is from your savings.
Okay.
And so you want to make sure that you still maintain three. Oh my God, that was so ungraceful. You want to make sure that you maintain 3 months worth of expenses in here. And so as long as you have those 3 months, your goal is to pay down all your consumer debt, which we did right here. But then your paycheck's going to come. So suddenly you have more money. So now the first thing you should do is you should replenish that 6-month supply. This is now your emergency fund.
Okay.
So what do you want to do next?
Well, so I've paid off all my debts, right?
Yep.
Like,
Not necessarily a mortgage, like some longer term debt is okay, but student loan or not student loan, that counts as long term.
like
Rent, car, anything you're behind on, credit card.
So the rest I can use.
So the rest you can use.
Well,
what would you use it for?
I would go party, right away.
No, you would not.
Yeah.
No.
So don't go party.
Don't go party.
Okay.
So the next step is investing. So there are a couple of different goals that most people have. The number one goal for pretty much everyone is retirement. And so retirement is where I recommend people put their money first, especially because if you have a 401k or a traditional IRA, this goes in pre-tax, which means that it's going to reduce your overall tax bill and you're going to have more money to grow. So if you do a Roth IRA, it's going to come out after tax, but it's still going to grow tax-free. And so that's also a great benefit. So you're going to save for retirement.
Right.
Then you're going to save for short-term goals. We're talking 3 to 5 years. So for instance, the most common goal is buying a house.
Okay.
So you save up for buying a house. And then I like to have a little bit on the side for play money, right? This is my festival tickets. These are my concerts. Yeah. Things that are too big to come out of my monthly budget, but are small enough that I can just kind of like throw dollars at it. And by the time I'm ready to go to the next festival, it will line up and be fine.
Let's move this.
You want to center it a little bit?
Yeah, center it.
Let's do it.
Yeah, that way it's kind of like that a little bit.
They can still see everything?
Yeah.
Okay. So then we have our emergency fund, and then we have our retirement, then we have our short-term savings, and then we have our play money. So then your next paycheck comes in, right? So our emergency fund is fine. We're sitting at 6 months of expenses. If you're at 6 months, you don't need to put anything else in your emergency fund, which means that you want to put some in retirement, some in short-term, and then whatever you can in play money. This happens at the beginning of the month or the beginning of the 2-week period, depending on how you get paid, so that what is left, you can spend. You have full autonomy to do whatever you want with this money. And this, in my brain at least, is way more freeing than trying to budget it out and figure out where each of my dollars are going. I just know that the money that ends up in my checking account, my spending account, I can just use for whatever I want. I can take my girlfriend out to dinner. I can go do whatever it is that I prefer. And I don't feel constricted in how I use that money. But at the same time, I already have all of my different nest eggs going.
Right. So what would you do with that extra money? I mean, besides invest,
Perfect. So then we have different goals, right? So this emergency fund needs to sit in incredibly highly liquid investments.
Yeah.
Cash, high interest savings account,
yeah,
or a money market fund. Your retirement, especially for most of the people watching, are going to be you're going to have like 30 years probably. I would go 100% stocks. That's usually the allocation that I recommend. 100% stocks, maybe diversify with some commodity allocation, some crypto, something like that. Then this is a 3 to 5 year time horizon. I like to go pretty conservative. I aim for a 4 to 5% return by allocating maybe 60% bonds, fixed income instruments, and then maybe some blue chip, very high quality equities. And then this, I'll probably just YOLO because I like to trade and because I like to do that. And because this is my play money, I have the freedom to do that, right? And you guys can see the theme that's arriving here where it's all about freedom of choice. It's not about being disciplined because discipline just falls apart. It's not something that humans are very good at maintaining. And so you have to make yourself feel free in as many ways as you can. That's the key to good personal finance. And so I feel very free to YOLO this on GameStop Doesn't matter because it's nothing. If you look at my piles, it's nothing. And so then if I win big, I can buy a festival ticket with it. And if I don't, fine, not a big deal.
Not a big deal.
Because when my paycheck comes around the next time, I'm going to put a little bit more in there. And then the next time it comes around, I'm going to put a little bit more and I'm going to get it back. But it's a small enough piece of my pie that it's not going to hurt me.
Wow.
Let's see. We have all sorts of new messages. I think it was just joining. Cool. So that's my trick on personal finance.
I love how we're using the poker chips, like
like the
in
poker
Vegas.
chips.
And also, like, I feel like there is a great way of using this when you're gambling too, you know?
Yeah,
especially
absolutely.
like on roulette, you know, yesterday. I mean,
Absolutely. So
if you split what you gain, you know, what you win into like keeping money and then spending it on like either riskier bets,
risking it.
Yeah.
Absolutely.
or just doing the less risky
And
bets,
so
you're
this,
going to have a better
my
chance.
play money, this is the type of stuff that came from that would go to Vegas with me because I have the freedom to do that. Did I have the tats at the hedge fund? Yes, absolutely. They didn't like it, but that was fine. I was like, I'm gonna have tattoos, and I kept getting tattoos over the course of working there, and they liked my work, so they handled it.
What percent should we be putting in each? Depends on the person and the paycheck and the time horizon.
Yeah. So personally, it will come down to cash flow. It will come down to what you have, but I like to max out my Roth IRA. So for me, that's $500 a month because then you hit 6,000 in 12 months. So that's my first goal. And then I have actually set up a savings plan. So I know exactly how much I need to save for a couple of my shorter term goals. And then finally, my play money is as much as I'm willing to put towards it, essentially. So my play money, I'll usually put like 200 in a month, something like that. And then I'll just like YOLO it or take it and go do something. It will depend on what my spending is like, because obviously I'm spending on Hoskin capital and things like that. So this usually is the first thing to lose out, and all of these guys will stick around.
Yeah.
So right now, in terms of my percentages, I mean, this is probably 10%.
Mm-hmm.
So the retirement's 10%. Then the short-term savings is like 5%, 250, 300, somewhere in that range. And then the play money is another 5%. So aiming for give or take 20% of my earnings goes into my savings. Did that make sense, or was that just complete gibberish?
Where can I find this data?
What data?
This data, I guess.
I don't know. I wouldn't even qualify.
I think he's just
I
talking about
understand.
what we're talking about.
He said, "Yo, guy on the left,
I know you're reading this.
What data?
Um,
I don't know. Well, we'll clarify. Happy to chat more.
yeah.
Okay, so we had a couple of questions. I don't know. Well, we're having a couple of questions come in about student loans and around education. So feel free to put questions in the chat on Zoom as well, because college is kind of a complicated subject, and the benefits that are available to people change based on how much money you make and how much money your parents make. So it all rotates around the FAFSA. The FAFSA is the thing that you fill out when you're applying for any sort of financial aid, and I think pretty much everyone does it when they go to school. And so if your parents are not necessarily lower income, but I would say middle class to lower income, like I think it's usually less than 60,000.
Yeah.
Then you can apply for Pell grants and education opportunity grants, things like that. So those are more like by person planning when it comes to college. But I think the things that are really interesting, which is one that we talk about all the time, is the American Opportunity Tax Credit.
Yep.
And the Lifetime Learning Credit.
I'm about to use one of those for my last semester, dude.
Yeah.
Because what I found out is you can only use it for the first 4 years.
Yeah, the AOTC.
I'm a fifth year,
Mm-hmm.
but
it's technically for the tax year of last year, and I still had one semester.
Yeah, exactly.
So I can just
so you got it.
use it.
So the American Opportunity Tax Credit allows you to deduct from your taxes the first 100% of the first $100% of the first $2,000 that you spend on tuition, and then 25% of the next $2,000 that you spend on tuition. And so it ends up being $2,500, and you can you can have refunded 40% of that. So you can have refunded up to $1,000. And so that's actually what I did my 4 years of school is I did that. And because I was working and paying taxes and overpaying my taxes, I didn't owe anything, which means that I just got $1,000 in my refund every single year I was in school, which was awesome. That helps so much when you're a struggling kid in school. Lifetime learning credit is pretty much the same thing, but you don't get any refund and you can use it for any school. So it's not just the first 4 years of undergrad. It will be anything, including master's degrees. And both of these are subject to phase outs. The American Opportunity Tax Credit, you can't claim above $160,000 of income, I believe. And then I think it's $118,000 for the lifetime learning credit.
Sick.
Yeah. I think that's about it on there. Those are the only things I would really recommend.
For education, right? Well, I mean,
does that work if you're a dependent? So if you're a dependent, your parents can claim it, which is big. So your parents can claim it, and then if you ask them nicely, maybe they'll give you some. But if they're paying your tuition, I doubt you're going to get any.
I mean, it's all just going to go towards tuition and like qualified expenses, anyways.
Right.
Yeah. If they were smart, they would have used an education savings plan, like a Coverdell or
right. Yeah. Then they could have set it aside. Here, let me see. We got people blowing up the chat. Let's see. Okay, cool. Okay. Make sure all that cool. Let's see.
What's the schedule looking like?
Yeah, we're still on track. What time is it?
We're still on track.
Yeah, 12:39. Getting a little tired. Things are settling down in the afternoon.
Yeah, so we are kind of transitioning between the key to making good financial decisions to impact
investing. Perfect.
And then we got a Q&A afterwards. This entire thing's kind of been a Q&A, but that's part of the point.
Well, we talked about increasing your earning capacity. We talked about budgeting and making sure to sort of hide money from yourself. And then we talked about asset location. So talking about where you should be putting money.
Right.
We can talk a little bit more about that. So if you're making less than about 130 grand a year, you can contribute to a Roth IRA. Mm-hmm. I highly recommend a Roth because your money's going to go in after tax and it's going to grow tax free. And so you won't pay a dime on any of the gains that you have. That is kind of overblown. Everyone talks about Roth. I feel like that's about it. So
not everyone understands it though. That's the thing.
That's also true.
Yeah. It's just about tax brackets it's just about where you get taxed and when you want to be taxed.
Right. And so if you're currently like 19, 20 and you're in a really low tax bracket, it makes a lot of sense to be in a Roth because you're going to pay a low tax percentage on the money right now because it's after tax.
Right.
And then when you're in a higher tax bracket later, you won't have to pay any taxes on it.
Right.
And so,
well, yeah, but most people would, if they're employed, be in a higher tax bracket, so they would go with the traditional. So let's say
that's big. If you're if you're making a bunch of money right now, or you're in your highest earning years, if you're maybe like 30s and 40s, then it makes a lot of sense to contribute to a traditional IRA because you might be making too much to contribute to a Roth, and because you're in a high tax bracket now, and you're going to be in a lower bracket when you retire,
because there's less income.
Then you'll be paying the minimized amount of taxes on that.
Yeah.
So then we can talk about HSAs because that's something I've been obsessing over lately. HSAs only work if you have a high deductible health plan. So for instance, if you have a deductible that's in the like $1,000 to $2,000 range, you can set up an HSA. You can set it up like I know Chase Bank, Fidelity has them. Like pretty much anyone will do an HSA for you.
And it just goes around with you. It's not like it doesn't stick with your employer.
It's your account. And the best thing, so an HSA is a health savings account. And the reason I love recommending HSAs is because the money comes out pre-tax. So it reduces your tax bill. And then if you use it on qualified medical expenses, completely tax-free.
Yeah.
But you don't pay a dime on that. So if you save $1,000, you can spend $1,000 on instead of like 700.
Right. But this is for people who like, is this for people who need like regular payments into like their health or whatever, or is this just for anyone?
So the cool thing is that it carries over year after year. So you could build up 100 grand in an HSA. It's going to take you a while. You can only contribute $3,550 a year. But if you contribute every single year and you don't have to spend, like I don't spend $3 grand on my health right now. I'm 22, but when I'm 40, that might be big.
Knees are going to go out first.
Everything's going to blow out. So who knows? And in those situations, I now have this nest egg that I can pull out completely tax-free to pay for those things.
Gotcha. Okay. So it is a good idea to get into an HSA.
It's huge.
Learning about it in the Kaplan Series 65 book, it just sounded like it was for someone who had like some sort of like chronic illness or something like that.
Which plays a role, but it's also a great thing to hedge against the chance that you're going to have a chronic illness in the future.
Right.
Because then you have this nest egg that is totally separate from your retirement and your other savings that is just dedicated to maintaining your health.
Yeah.
Which I think is cool.
Another thing you go into is life insurance, you know, and annuities. I hate annuities. I don't hate annuities. I hate learning about annuities because they're so crazy. Like they are very complicated. And honestly, it's that part of investing that, you know, I would say is one of the most important, you know, planning for retirement, but it's not my favorite.
Yeah. If you're trying to buy life income, which is in most cases what an annuity is doing for you,
right? You're
paying a lump sum to have them pay you like $500 a month forever. Then I feel like it makes so much more sense to invest in like a bond or something like that, or even better, a business that's producing income. Like if you could go buy 20% of your buddy's dry cleaner or something like that and just have that pay you income, I feel like that makes so much more sense than buying an annuity, because then you don't have to incorporate any mortality or any of the insurance tables that are involved that tend to just kind of not give you the best payout. And they're a little too good at predicting when you're going to die, I guess is how I would put it.
Really?
Yeah.
Wow.
Because the chances of you outliving it are very, very low. And so that's when you really start to make money, is when you live longer than they say you will. And because that's a serious monetary risk for an insurance company.
Oh yeah.
They're going to be really conservative about that.
Yeah.
Which means your payout is quite small. Whereas if you have a business or something like that, becomes way better. So let's see, who else has questions on the personal finance stuff that we've talked about so far?
Let's hit some questions and we'll go into impact. So we've got a few in the Zoom, which is awesome. So Andrew said, how would you recommend someone who is living on their own to go back to school? Are loans the only option?
So if you're living on your own, the main thing that you'll probably qualify is grants. So Pell Grants and education opportunity grants, those are going to be huge. And then so that will be your needs-based financial aid component. And then you can also do regular financial aid like scholarships and applying for those types of things. So that should cover a pretty good portion of your tuition. Everything else, especially if you're living on your own and you're lower income, then you should also do subsidized federal loans, because they have forgiveness, they have pay as you go, they have all sorts of other great things, and they'll have a much lower interest rate.
And obviously scholarships too, but
yeah, scholarships will play a big role.
This isn't something I've had to look into, like, I mean, you either that much, luckily, but there are a lot of opportunities out there if you look for them. Oh, Lauren.
Yeah, why don't you text me?
I don't know.
Let's see. I'll call her.
Okay. Nate's girlfriend, ladies and gentlemen.
Yeah.
So it's some practice, skills to HSA. Do you know how much control you have over the type of investment of the HSA?
Pretty much complete control. Some of them will provide you structured investments, so you might only be able to pick from a certain number of funds, just like you do in a 401k, something like that. But
you probably can't do margin.
You can't, you won't be able to do margin. You pretty much can't do margin in any tax protected account. So
covered calls.
You can do covered calls.
That is true. Thing. Yeah.
And so you can, at the very least, you'll be able to put it in stock investments, which I think is your main concern. So I think you'll be safe in having the control that you want over an HSA. If you were me and had $2,000 in a bank account and were about to turn 18, what would you do? Go educate yourself. As much education as humanly possible. What are your thoughts on the former head of ESG at BlackRock saying ESG has no real impact? What a perfect segue.
Well,
easy segue.
Funny you say that.
So the next thing we're going to talk about is impact investing. We'll probably just do like a half hour on it, something like that.
Yeah.
And then we'll do
SEC just like started releasing stuff about ESG, remember?
Yeah, they just started the task force to start monitoring
that is awesome
ESG and their commitment to sustainability.
That is so awesome.
So the question was, so apparently the previous owner or the previous ESG manager for BlackRock, which is one of the largest asset manager in the world, said ESG has no real impact. So I think in order to make that claim, you first have to define impact. And I'm not sure what he was talking about, because there are two big components of impact when it comes to ESG investing. There is financial impact. So does ESG affect the health of the company? And then impact on the actual environment.
So what do you mean by financial impact?
So like if a company pollutes, that qualifies as an ESG risk.
Okay.
Does that reduce the performance of the company? Or does it have no effect? There's a lot of analysis on it. We did a little bit ourselves. So we have a white paper on it.
So you can pollute from your company and not have it affect your company.
So that's the real question that's being asked with ESG for financial risk is that does the fact that a company is, if they're unsustainable, is that going to affect their performance long term? And then if they're really good, is that going to benefit them? Is that a source of alpha?
Right.
And so for me, the biggest thing that I'm seeing, and we're obviously impact investors, like I do ESG investing every single day.
I'm just learning about it.
But the biggest driver of ESG nowadays is consumer sentiment and regulation. So for instance, the cigarette tax.
Right.
How much do you think a case or like a 20 pack of cigarettes costs nowadays?
Dude, it depends on the state. California, it's up something crazy, like $14.
It's like $14 for a 20 pack of cigarettes, whatever. Like
it's
a
pack.
The word.
Yeah. And then I think here in like Nevada, it's maybe like $8.
Which to me still seems insane, considering some people smoke 20 cigarettes a day.
Yeah.
And so
wow,
this increase in price, even though the efficiency of tobacco farming and everything like that has become so much better, the price continues to go up because of this thing called the tobacco tax, which is the government actively disincentivizing investment in cigarettes because cigarettes are bad. Like that's the conclusion.
And that also comes to types of risk too,
legislative risk.
Yeah.
And so on the other hand, even without subsidy, solar and wind energy are the cheapest forms of energy available now. So with Biden, who was behind me on the screen earlier today, talking about this $3 trillion infrastructure bill that involves heavy focus into sustainable energy. That is the fiscal side of our government just pumping cash into the sustainable energy sector.
Right.
And so ESG in that case, the fact that those companies have exposure to the environmental component, the environmental factor of ESG, it seems like a no-brainer to me that they would perform better than the oil producers that are receiving more and more essentially emissions rules, not to mention having their shareholders stonewall them on certain moves that they're trying to make.
Right.
And so I personally, and I'm obviously biased, I think ESG has a very serious impact and is going to continue to be more important as investors start to become more interested and more engaged in that, as businesses start to separate and be polarized as either sustainable or not. And then also as companies start to use sustainability as a source of becoming a better company and gaining not only investor confidence, but also consumer confidence. Because as it becomes more of an issue with us, the people, the more they're going to be able to sell products if those products are sustainable.
Wow.
And so that's where I see alpha from an investor standpoint, not even from like a bleeding heart activist type of standpoint. We're talking about money here.
Mm-hmm.
And there is going to be money in sustainability.
So if I was a company and I sold water bottles that, if I was a company, I sold energy drinks.
Drinking out of plastic.
Right.
Thank God.
And I donated a certain amount of money to protecting the environment, but I had a lot of water bottles just kind of go to waste. Can I claim that I'm like ESG effective? If that makes sense.
Say that again.
So if I have more damage coming from my output than I have contributing to saving the environment or the earth or making a positive impact, can I claim ESG?
Well, now we get into measuring ESG, which is like the reason
why the SEC is creating a whole task force.
And the reason we put in so much time and effort into actually measuring ESG and measuring the impact and
which
using
is
all of these different data
why
points.
we also created ESI.
Right. Why we created our entire
for Hoskin Capital
proprietary ranking mechanism, because measuring ESG is really, really hard. Let's see, what else do we have?
Speaking of energy,
more coffee, something like that.
Might be switching over.
Let's see if there's anything new in the Q&A as well. Ooh, this might be a bit of a loaded question, but why are you doing this type of thing? You are essentially handing out a lot of information for free when many like you would attempt to tell people an overpriced, mediocre at best course to make money off of their audience.
Because we're awesome.
That's it. That's the only reason. God, I don't know. Why are you here? What's the point?
Well, besides the fact that this is kind of the come together / celebration of Hoskin Capital really after he passed his CFP and I passed my Series 65. But I would say we're doing this because we kind of want to like start making more moves with our marketing and, also just answer questions that a lot of people have had. And it started out as a day trading event. So we were going to have 100 traders day trade all day and then give us the results and basically compare them and decide whether or not day trading is a good idea or not.
Compare it to casino gambling.
Exactly. And we were even thinking at one point I was going to be playing roulette, which is my favorite game. We're in Vegas. And if I earned more money on roulette than, most of the people day trading, that would obviously be like a big red flag saying like, hey, you can go to a casino and earn more money. Or if I lose, it depends, but I'm pretty good at roulette. So
yeah,
it's
tough to win out. I feel like the reason we're doing this for free, most importantly, is because you guys are of no value to me as a paid service. I just don't like.
You almost said that really badly.
Yeah, you guys are of no value. Zero, absolutely nothing. No, at most, if I charged every single person in this room, we've had like 2,000 people, 2,000 independent viewers so far today. If I charged each and every one of you like $10, make 20 grand, and that's it, I'm done.
Mm-hmm.
Then I feel like the thing that I'm delivering doesn't carry that much value,
right? Because
this information exists. This information is available. You guys could go and grab it from any of the different platforms that are out there. Like you could go to Investopedia, you could go to the IRS website, sec.gov, and get 100% of what I'm sharing with you right now. There is nothing proprietary here. And so the reason we're doing VERITAS is because if you guys are more educated and you guys are better at making and saving money, then you become clients for us. Because right now, a lot of the people that we're talking to, there are 100 of you guys on our different streaming platforms right now. A lot of you guys probably don't have the money that would make you feel comfortable hiring a money manager, because you're like, I have 3K, what do I care? And so for me, I want to work with people who are just at the beginning of their financial journey, and I want to show them what they can achieve. And so if I can educate you guys and get you to a point where you realize the value of money management because you have money that needs to be managed, then that's where my payout is.
Watch this.
That's where that works. Is it going to echo?
No, I'm just going to mute this, turn off the video.
Okay.
And now we're looking at our audience.
What's going on?
Yeah,
What?
we're right
Oh,
there.
okay. Oh, I see. So you just changed the camera angle.
Yeah.
And now we don't have the fancy.
Now we don't have
microphones.
to. I mean, we were like looking down.
That's fine. We're kind of
Yeah.
considering wrapping up.
And
here
for those of you
anyways.
in our, what do you say? Way more intimate. Oh man,
so much more.
so
intimate.
much more.
That's been the theme of today. Why?
For those of you on our TikTok who are just kind of joining, we are also on Zoom right now doing a webinar, and you can actually jump in anytime through the link tree.
Yeah, it's just
Or
the
our
top.
website.
It's the top part of the link tree. It
Yeah.
says.
And we're answering questions, and everyone's having a great time in the Zoom chat. But
Yeah.
Yeah.
Wow, it's popping off. So
it has been popping off. So what were we just talking about?
yeah, we were talking about why we're handing out information for free.
Okay.
Like, what's the point? How do we get paid? And we get paid by getting a bunch of educated people who are interested in finance in the same room together, so that they can become wealthy enough that money management means something to them.
I mean,
because that's
yeah.
what we do. That's our business.
Think of this as advertising too, if you're really desperate.
Yeah, there you go. This is our inbound marketing.
But yeah, also just we're having fun with it. Like this is, I mean, I don't know about
You were explaining to us how we're worth nothing. Exactly. Zero.
Yes.
Absolutely zero. The big question is, how do we turn this into a drinking game?
oh
Every time I say,
every,
we have all
every
sorts
time
of
we
ways.
say impact investing, every time you say hedge fund, I take a swig.
We'd be drunk.
Hedge
We'd
fund,
be
hedge fund,
absolutely
hedge fund,
hammered.
Hedge fund.
What's an ideal return on my money with a Roth IRA? I mean, S&P 500 has averaged 10 to 11% in the last 60 years. You probably won't get that over the next 10 years, but I would say 100% equities, you're looking at 8 to 10% is a good return. Oh, wow.
Ooh, the battery's going
The
down.
battery's going down.
I can grab a charger.
Yeah, we'll be fine. Let's just do Q&As. Do you guys have questions?
You guys
We
wanna
talked
learn
we talked
about-
about so much
Yeah.
today.
Do you guys want to keep learning about impact investing, or do you just have questions? that you
Well,
wanna
just
say?
ask questions, and then if they're about impact investing, then we'll answer that.
I'm gonna do a poll.
How did you do your research to find, then cold email those 200 financial firms back when I was younger? I went on Google Maps, I looked up financial advisor, and I set the radius to 50 miles, and I created a list of all of them. And I went and found emails. I found like the MDs on LinkedIn or anything like that. I made a database of those 200 emails. I put it in MailChimp, which we still use. That's how we send all of our mass emails. Sent them all out, same email. Let's see. What are your favorite tools besides your sponsor? I love the FinViz market map. Honestly, that's a good one. I also I use finance.yahoo all the time. The rest of the stuff we use is all, it's all paid. It's all institutional stuff. So that's not really worth mentioning. Let's see. Do you need to look at REIT financials differently? Yes, absolutely. So a REIT is a real estate investment trust. You need to understand what they're holding. So a couple of them are going to hold commercial real estate like warehouses, which is one of my favorite investments right now. And then you need to understand how they're producing cash flow, because REITs are required to pay out, I think it's 90% of their earnings to their investors. So you need to figure out how they're earning money. You also need to figure out what their mortgages and other debts look like. And you need to understand what the interest rate is on all of those, because REITs tend to have pretty high leverage exposure. Let's see. Oh, I like it. You got to try the poll. How did I learn to code? I learned R in school. Tim Frenzel, our CTO, actually taught me most of the R that I know. And I learned it through our analytics program at Chapman. And then I just doubled down on it, used it in Hoskin Capital, and also used it for a bunch of different ad hoc projects that I did. That's how you're going to learn to code. You're going to get the basics from like Coursera or something that costs like $5. And then you're going to use that and apply it to a program or a project that you're really interested in doing. That's 2 shots, boys. Stanley really wants to be the coffee intern. Stanley, change your name to coffee intern. Let's see. Do you scrape data for your algorithm? We buy some of it from the source, and I scrape a bunch of data just because I'm curious in it. I use Beautiful Soup and Selenium on Python to do all of my scraping. I highly recommend learning both of those. Hoskin fans, the only fans but Hoskin fans. Do REITs have IPOs? REITs have initial offerings, so they will they're essentially stocks. So they do IPO. I think they're technically direct offerings, not IPOs, but they're very, very similar. Try the pole, another way to make money. I do not have the upper body strength for the pole. Are you kidding? I can't, this is my school email. What else do we have? Okay. If I have a 401k through work, how would I get advice from me? So I always advise on people's 401ks. You can schedule a financial consultation. Our rate is $100 an hour. And we literally would sit down for an hour and I would allocate your 401k and we would talk through how much you need to be contributing. We would also talk about your matching, any safe harbor provisions that you need information on. And then you would be able to essentially just automate your 401k so that you never have to touch it again. And then we can always check back in and talk about it. But 401ks are an interesting topic because setup for a 401k is rough. It's hard to know which fund you want to pick. So I actually, oh my gosh, what's his first name? Nick Meyer. He's another CFP on here. He is ridiculously smart, and he actually talks about 401ks in one of his most recent videos. Yeah. So he actually talked about the hidden fees of a lot of the different funds. So I'm kind of with him. I think in your 401k, you should just buy a super cheap index fund. And that's a really good place to start investment wise. How does one gain discipline?
Great question.
That's a tough one.
Yeah, you put yourself in an environment that basically will help produce the results that you want. So if you want to lose weight, you stop hanging out with people who eat like crap and party all the time. And if you want to learn how to invest, you start spending more time either in web forums that talk about investing, you attend webinars like this, yes. And you basically make it so that the goal that you're trying to achieve, you are faced with on a more regular basis. For me personally, achieving my Series 65, one of the easiest ways, the way that I did it was basically completely pulling myself out of the college environment that I was in. So that meant making a lot of sacrifices in terms of like my social life and my free time, but it paid off, obviously. Yeah. And also talking to Nate, who just knew like what I was going through and what I was trying to achieve. Just talking to you like on a regular basis helped me be like, all right, this is what I'm trying to do. This is how I'm